doing, my own thing with my own firm.
Yeah.
And you know how it is as a founder. And so we spun off and we found the world's greatest partner in TIAA, one of the largest asset owners, in fact, the largest investor in private credit in the world. And the rest is history. And here we are, $40 billion later. We started out, by the way, with $300 million and a small line of credit to make sure that we had enough to last us for a year.
Okay.
So it's all good.
Okay, so you're back to being founder status.
Yes.
And you play in your band. Tell us
Yes.
about that. There's not many people in the world that are as good investors and founders as they are musicians, and Ken is one of them. So tell us a little bit about that.
So I've been playing guitar since I was 7 years old.
You should have had that.
My son's a musician. My son is a musician too, by the way, and a really good one. But no, we started this band 12 years ago. We played 200 gigs all over Connecticut, including pretty much everywhere in Greenwich, including here. So look, I think at the end of the day, I think having a diversified and other things outside of work is really important, and that's my passion. So
It's true, and it's hard to find that, and it's a really good reminder to all of us. You found that. You're still playing.
yes,
Excellent.
yeah.
So what's coming next? What are you planning next for the business, especially given the environment?
Yeah. So, I would say a couple things. As we think of kind of the world and how it's evolved, I think that obviously we're grateful for the amount of capital we've raised, and certainly the environment right now is presenting lots of attractive, opportunities. We have our private equity and junior capital business, which invests alongside large private equity firms, really based on those 200 LP relationships. So what we are really looking to do is grow that business, and so we're going to be launching a $1 billion fund to invest alongside our private equity relationships. That business has a 15-year track record of 30% plus returns. But again, not just running around looking for deals, getting those deals from our private equity relationships. And I think that's really the key if you think about our business. And frankly, I think the successful model we've employed, which is to partner with the best, right? So if you think about the model, it's we're going to go out and look at the private equity universe and find the best performing managers, and we're going to invest in their funds. Right? And when we make that investment, we are going to say to them, look, we've done our work, you guys have a great track record, we love you guys, we've looked at how you invest the right way, ESG, all of those things are extraordinarily important to TIA as an investor. So it's really a full analysis of that firm. And then we go to them and say, look, we've made that call, we want to do other things. Can we finance your next deal? Can we co-invest with you? Can we see your next, holdco preferred, investment? So it's really a relationship-driven business that drives deal flow. I believe we are one of the few firms in the industry that have built our business that way. There are there are certainly firms that have, they invest in private equity and debt, but I think one of these few firms that do not compete with our private equity clients, where there's a partner. And so I'm a big believer in a partnership approach. Obviously, we have a phenomenal partnership with TIA as an investor. We manage over $20 billion for TIA, members and teachers and college and university professors and healthcare workers. That mission is incredibly important to me. And so there are probably many of you in the audience who have parents or others or friends who are teachers.
Teachers, parents,
exactly,
TIAA.
Right? Yeah. So, I think that as we invest, we want to keep that mission front and center. The Sonia Brown Duckett, our CEO, who I think is probably the most prominent African American woman CEO in the United States, has been very clear about our investing with a purpose, keeping in mind our members and our participants at TIAA, and so that's a big part of what we do. So private equity, so we'll grow that business, and then we continue to find great opportunities to invest in the current private credit market environments. We're more conservative for sure. We generally only do about 6%, 5% of what we see. But the positive message I would say coming out of this is that yes, we're going through some economic turmoil, but we've always invested thinking that there might be or could be economic turmoil. So there are plenty of great companies to invest in. I'm not a believer that the U.S. is on their down arc. I believe that we are still the greatest place in the world opportunity and upward mobility. I'm certainly an example of that. I'm guessing you probably are too. I was an orphan. My parents literally left me at the hospital when I was born. Grew up in Buffalo, New York, across the street from the steel mills. Still a big Buffalo Bills fan, as I said in the article. But at the end of the day, there are still great opportunities to invest in the current economy. And I think that the dynamic that is sometimes overlooked is that COVID created winners. And so the private equity firms that we work with are on the hunt for the winners. And what's fascinating about this environment is the losers or the challenged business, challenged companies are on the sideline, but the winners are transacting, are investing, and are growing, and those are the businesses that are the focus of our activity historically. So, and by the way, they're trading at pretty high multiples.
Yeah.
People are surprised by this. I mean, a good company today, private company, can still trade 15 times, 18 times, even 20 times cash flow, but it's got to be the right business. It's got to be in the right segment. It's got to be a proof of concept that in fact it has an ability to pass through price increases. It is not being impacted by supply chain dynamics. It has an underlying growth trend that is a long-term trend that investors can get comfortable with. So there are good companies, there are opportunities. You've got to be conservative and selective. We've certainly been that way. I think that's the reason that our performance has been where it is. We've received, as a firm, numerous awards for that. We have almost all the London boroughs are investing with us or going to be investing with us, so we have that whole pension system. Scandinavia, continental Europe, Asia, Japan. We've got very, very large investors, sovereign wealth funds worldwide that are looking for quality.
Some that are here in the audience.
Yes, some are here in the audience.
Yeah.
So I still think it's a great time to invest. I just think you need to be focused on the businesses that are going to benefit from the current dynamics.
You talked about your competition. I mean, it felt like a few years ago every private equity firm had launched a private credit arm. Is there enough room for you all?
Yeah, that's a great question.
Yeah.
Get it all the time. I think that what has happened in private credit, which I guess is a natural evolution, is that 10, 15 years ago, it was still in many respects in its infancy and somewhat of a cottage industry. But what has evolved over the last 20 years, and I've had the privilege of kind of watching this unfold, I've been doing this now 30 plus years, is that the private credit managers have gained so much scale and so much institutional backing that the fact that you have that scale and you have those relationships has basically led to a consolidation in the private credit industry. You're going to hear from some other folks today, frankly, all very strong competitors, excellent firms who we see all the time. And all of us have gained scale in the business so that when you think about financing a $500 million deal or $800 or $1 billion transaction, there are only a handful of firms that can do that, okay? I mean, if you're walking around with $25 million, great, you can find, there's lots of companies. But if you're talking to a company or a private investment firm that says, look, I need $500 million, all right? If I show up with 100, they're going to say, thank you very much, Jen. Can you come back when you grow up? Because right now, we need 500, not 100.
Yeah.
So scale matters a lot, and I would say that has led to a tremendous consolidation as the best managers have attracted capital. So you could argue that that process is actually a very healthy one. The banks kind of moving away from this business, more of a more conservative, lower risk profile, and the private credit managers competing for dollars based on performance. So the largest managers drive scale, they drive relationships, and ultimately, when you look at the competitive dynamics, there are only about 5 to 10 firms now today that I would say are truly competitors of ours when we try to do, when we're looking to do a transaction. Then if you overlay that with long-term history of doing transactions together, 10, 20, 30, 40 deals, if you're a private equity firm or a company and you need certainty in terms of a financing, are you going to take the firm that's done 30 deals with you and you're at the 10-yard line, with documents and covenants and everything else? Or are you going to take a chance with a brand new firm? generally what we're seeing is firms are saying, I'm going to go to the guys that I know and I trust. And if you overlay our LP relationships on that, what you have is a very powerful dynamic. So I think, yes, there's been a lot of capital raised in private credit. There's been a lot of capital raised in private equity. But there, I would say it's increasingly raised by a smaller number of managers who are institutionalized, who have proven track records, and I think ultimately have proven that they are, good firms to invest with over time.
And talk to me about ESG and private credit. It's a little bit tricky, and obviously with a TIA partnership, you probably have even higher standards. What does that journey look like for you?
So the first thing I would say on ESG overall, and certainly TIA has committed to carbon neutrality.
Right.
We were with Nick Leolis, our CIO, last night, and that commitment is very real and very strong. So I would say the first thing that we think about when we think about ESG is not as in some artificial amorphous concept, but just real world. ESG is good business.
Yeah.
Okay. I mean, if companies aren't paying attention to that now, are they really the companies that we want to finance? Are they really the businesses we want to invest in? Because it's here, and it's growing, and it's an absolutely critical concern. It is going to be increasingly difficult for companies to raise capital if they're not cognizant of that. So we are obviously very focused on ESG criteria going in on the credit side. I think the other dynamic that we have that maybe a lot of other firms don't think about is we're also a big investor in private equity funds.
Yeah.
Right? So as we're looking at, remember I described the partners that we look to invest with, as we're making that assessment, ESG is front and center to our assessment, right? So we're only partnering with the firms that we believe have a strong commitment to ESG. And frankly, the best private equity firms are all in on ESG. Their investors are making sure of that. So we have it from the private equity side in terms of who we invest with. And then from the credit side, I would say the other trend that we're seeing more and more is, and Europeans are ahead of us in this, Article 8 is, kind of the next step in ESG. And I think that what you realize when you get in the weeds on ESG, when you really start to look at what's required or not required, there's a lot of judgment on the part of managers. So it's really developing an ESG policy that is reflective of what your investors want to see. There's a lot of wiggle room, right? You can have an ESG policy, but when you actually look under, it's very, very nebulous, and it gets applied sparingly. So you really have to, from the top, and I certainly emphasize this with all of our people. We have a dedicated head of sustainability and ESG. We have a strong commitment to making sure that we are protecting the planet and making sure that the companies we invest with have appropriate governance. And again, it's somewhat easier that our private equity sponsors are focused on the same thing. So I think at the end of the day, we feel that we're on a good path, but it's a path that is continuing to raise the bar.
So as we head into potentially a downturn, well, we're ready. Some people say we're already in it. I've heard a lot of concern about management of portfolio companies, who are younger perhaps and haven't even been through a downturn, like even psychologically coming to the office every day and having to deal with that. You're a founder. You've been through different market cycles. What are you thinking about, or what's on your mind as we head into this, just running your business?
So people ask me this, well, how did you go from 300 million to 41 billion?
That's
and
great.
we have 1,600 investors today. We manage 32 separate funds in across various credit asset classes. So how does that happen?
Yeah.
And my answer is pretty simple and pretty straightforward. And I'm a big believer in this. I know there have been other CEOs who've said this. It's all about your people, 100%. If you take care of your people and you hire the best, and you certainly know this, and you've done an amazing job with your business. If you hire the best and you nurture them and you support them and you give them opportunities, first of all, they talk to their friends who say, I'm working in a phenomenal place. And by the way, it's a phenomenal place for women. 60% of our firm are women, right? How does that happen? Well, because you talk to your friends, they talk to their friends,
and
they
so
tell,
on,
and so on. So it means taking care of your people, building a culture of empowerment, diversity, which is critical in the investment business, and letting all of your people know that what they do matters a lot. Not just the front office and the investment side, but operations and finance, typically looked down upon a little bit in the business. Well, those are just the ops people.
Right.
Not in our firm.
Right.
Those people are front and center, and every time we have success, whether it's operations or finance, we obviously celebrate that. So we're very proud to have been named Best Place to Work by Pensions and Investments for several years now. And so I would say, number one, stay focused on your people and taking care of your people. Number two, always stay focused on doing what's right by your investors. At the end of the day, ask yourself the question, am I doing the right thing? We have an investor who's been with us now for a year, and early days we were building out their fund and we were kind of moving to their investment criteria. It took us a quarter to kind of get to where we needed to be. We just waived fees for 3 months. We just said, you know what? Until we get exactly where you need to be in terms of the regulatory requirements and all the filings and everything, we're not going to charge any fees. In the long run, much more important to have them know that you're going to do the right thing. So as we go through COVID, it's all about your people. It's all about your investors and making sure you're doing right by them and creating a culture and an environment where everyone understands that and knows that. And when you talk about the people, it's not just the people in your firm, it's your relationships with our parent company, with TIAA. We meet with them every year. They allocate about $5 billion a year to our business. We're incredibly grateful of that.
We'll
yes, a big one.
Yeah.
And we'll never forget that. We'll never forget what they've done for our business and for our people. And so, it's a people business, right? At the end of the day, and why some firms succeed and others don't, it all comes down to that. And I would say as we go through COVID and look forward, I think one of the things that gets harder to do is, as your firm gets larger, we're 150 people now, and you guys keep growing too, and and I'm sure you're feeling the same thing. It's like you try to maintain that personal touch with your people, and it means spreading yourself thinner and thinner. So you almost have to have like multipliers around you, people that think the same way and that can bring the message.
It's a culture. It's a
culture.
culture. Let me end with, Ken, you are an American dream story. Like you said,
I'm on the wall at the Milken
you're
American
part
Dream
of the
Center.
Milken Center for the American
Very
Dream.
grateful.
Are you concerned about the American Dream? Do you still see it alive today? Just
Totally.
give us a few seconds on that.
Totally. I am a huge believer. Again, as I said, I am not a subscriber to the American decline theory. I think America is always evolving and changing. There are periods of time when maybe things aren't moving quite as quickly in our direction. It's an ebb and flow. But I think that this experiment in democracy and a culture of underlying opportunity and upward mobility, it's the only place in the world, in my view, where all of that comes together with the amount of capital that's available here to create that opportunity. And I am, in many respects, a perfect example of that. My uncle who raised me never graduated from high school. When he first attempted to be my guardian, when his sister passed away, my adopted mother, they basically rejected him. They said, you're never graduated from high school, you work in Bethlehem Steel, you make $11,000 a year, there's no way we're letting you become the guardian of this child, right? And at the last minute, we were very fortunate. Jack Kemp, who was my congressman in Buffalo, I ended up working for, intervened, and the rest is history. And so.
Thank you for sharing that with us.
Yeah, no, it's. Well, I think at this stage you try to be an inspiration to me.
Yeah, well,
right?
that is an inspiration. Thank you to Ken, and thank you to the Greenwich Forum for having us.
Okay, sorry about that feedback. We just wanted to make sure everyone was awake. Okay, now we're moving right along to the next session. Thanks, everyone. We're moving right along to the next session. We're going to dive deeper into the credit markets with the co-president of Apollo, Jim Zelter, and I'm going to introduce He's going to be led in conversation by Sonali Basak, who's one of Bloomberg's star anchors and their lead Wall Street correspondent. Welcome, Sonali and Jim.
Thank you. Hi, everybody. Jim, thank you so much for having this conversation. I figured that we would leave on this conversation on a place that Ray Dalio a little bit earlier had left off. He talked about the debt markets being really unattractive right now with the trajectory of interest rates, and I thought that was a great place to start with you because this is the world that you've lived in since 1985. So, and at Apollo since 2006. So dive into that a little deeper. When you look at debt globally, overall, very simply, where will you never touch in the next couple of years, and where are you diving in hard?
Well, I mean, I think, he talked about a major paradigm shift. We've been in a regime where rates were artificially low for 10, 12 years. Everybody in the audience knows that. And we went through a radical transformation in the last 6 months about where rates are now. And what it really means is what's the cost of cost of capital has gone up dramatically. Purchase price matters. If you've been disciplined, it's really not been hard, other than if you were in the room and the Fed dot plots and you've miscalculated this thing massively. The fact is there are parts of the credit markets and the bond market which are getting interesting and exciting. Your previous speaker was talking about private credit. Private credit is a very, very interesting asset class right now. You're getting paid at the top of the capital structure for risk. If you ask most folks what they think about equity returns in the next 5 to 7 years or 10 years, they'll say mid to high single digits. And if you can make top of the capital structure 10%, you're doing okay. So massive regime shift. There's certainly areas where I think being in the US makes a lot of sense right now. We could talk about Europe, we could talk about Asia and Japan. But right now, you're getting paid for certain parts of credit. And we've been very patient and prudent, but certainly are getting offensive week by week. Well, it all depends about your business model. I mean, there's Ray Dalio has one business model, your prior speaker has another one. We have a really unique business model. People perceive us as a PE firm. We love PE. PE is a big part of our business, but it's around 85 billion of 550. So not everything we do is through the lens of PE. It's a very important lens. A biggest part of our credit business is just lending money to companies on a performing basis. So, in our mind, it's not only private credit for buyouts and sponsor deals, but it's aircraft finance, it's inventory finance, it's trade finance. We have a massive program with BNP, and therefore now Hewlett-Packard, where we're a multi-billion-dollar supplier of inventory finance. Those businesses are going to keep going. We're getting higher spreads on that paper. So for us, it's really about our business model and the machine we built, and our platform. So we play a much bigger role in the credit ecosystem than we did 15 years ago.
So that's the platform. What about the paradigm? When you joined Apollo in 2006, it was right before the financial crisis, and then you lived through QE. And now as we enter QT, what does that mean for how you change the way you think as an investor?
Well, I think for us, again, the firm back then was, 25 billion. It was a majority of PE. We approached the world in a much more risk-on, risk-off mentality about different cycles. Now it's really how you navigate the different markets in terms of much, much higher up the capital structure and regionally where you want to invest versus any particular name or industry, if you would. So, in my view, as I said, we are in an environment where purchase price does matter. If you've been disciplined the last 7 to 10 years, those who were not disciplined, have had massive drawdowns, whether it's in the equity short area, whether it's in the tech area, and you got to really think about the next 3 to 5 years. What's the economic backdrop? This regime shift to a higher rate environment, and how do you think about what your base case is versus the tails? And in that environment, if you can, as I said before, don't overcomplicate it. If you're making 9, 10, 11% top of the capital structure, really interesting opportunity right now.
Interesting opportunity. Maybe you could draw out your base case for the next year or so in the economy. What does a recession potentially look like? How deep is it? How long does it last?
Well, again, we talk a lot at Apollo about not predicting but preparing. So, we have what we call a common lens, which we ask the breadth of our firm to really look at through a common lens across the entirety of what we do. And in that common lens, I would share right now that probably the tails, so 1 out of 7, are a soft landing on one hand and massive stagflation on the other. And you've got your predominant case, 50, 60, 70% of a period where monetary policy and Powell want to make a stand. They're going to slow down the economy. Housing is going to take a bit of a brunt with mortgages going from 2.5% to 6%. And you're going to see probably a different kind of recession than you've seen in the past. It's not going to be in the broad brush recession. It's going to be one where there's going to be some economic growth in various parts of high-end consumer or other areas, but you're going to see it's going to be very diffuse by industry. Certainly the U.S. will probably be the tallest one standing versus Europe. The China zero COVID policy is really tough for economic growth. I don't see it as deep and nasty as '08, but I see it one you have to respect the economic impact of a very fast-paced economy changing and how funding and cost of capital dramatically changes.
So the probability then of a hard landing would be in your mind?
Well, hardly. I would say that I've been public for 6, 8, 10 months saying recession, 70% likelihood. The percentages aren't really matter. What really matters is that's the base case. It's probably the more likely case. And how do you price into you? How do you price liquidity? How do you think about getting paid for current risk in that environment? What's the duration of that? I don't suspect it's been widely publicized that we've been active in the CLO market. I'll just share a couple of anecdotes. To buy AA CLOs right now in Europe, those prices are implying 12 to 15% annualized defaults over the next 5 years. I'll take the other side of that trade. I've been around a long time. I'm not saying it's not going to get nasty, but put into reference what the numbers were in '08, '09. They were a third of that for 3 years, 4 or 5% for 3 years. So again, when you have a marketplace like right now where there's illiquidity in the treasury market, there's systematic concerns about the gilt market, you've got systematic concerns in other areas, which we'll talk about, there will be opportunities because investors either are tourists, it's not a mainstream activity, they have the wrong business structure or capital structure around their mandate. And so those are the opportunities that we look to find and be on the other side of.
We'll get to systematic in just a second, but first I want to ask about structural, because that CLO opportunity in part came because of that issue you saw among pension funds in the UK. There are a lot of investors out there that are feeling a lot of pain this year, margin calls, right? So what does that mean in terms of the opportunity that presents to buy in when perhaps things have overshot a little bit like you see in the CLO market?
I think it's really a lesson about that prepare, not predict. Many of those folks in this room knew a little bit about LDI. Some people probably knew a lot more about LDI. We've all learned about it the last few weeks. When you have unintended consequences of liquidity strain on a system. I'll take people back to Lyondell Chemical back in 08, 09, which we were very involved with. With oil jumping like it did, it created massive impact on their natural resource inputs. Like, you never know what's going to cause your next crisis. So we have a very, very interconnected financial world. If you've not been prudent about your liquidity or your funding, there will be surprises, but I suspect more of that coming along.
Speaking of liquidity, we were talking about QT to kind of kick off this conversation. Do you think investors are underprepared or overshooting the kind of liquidity impact that it'll have as so much comes out of the system?
I think there's a lot of investors that are somewhat new to the markets. They've seen 12 to 15 years of great economic backdrop. They've seen lots of liquidity. Valuation has not been the primary concern. So, the lack of historical reference or the lack of humility will probably trip a few people up. You got to stay at the table. That's the big lesson that we took away from 08, 09. You can be a brilliant investor but have the wrong type of capital. And so the ability to be very relevant during regime changes like we're seeing right now, that's a critical aspect of the business.
And I want to be very clear here. When you're diving into the market at a faster rate at this point, you're staying in the safer parts of the capital structure still. To what extent do you still see the opportunity to get into distress?
When COVID hit in March of 20 and really disrupted the markets, we thought distress was going to be an opportunity 12 to 18 months out. We're not, if you look at where we are today in the markets in yield and credit, as we've said and everybody can see, spreads are okay historically, yields are somewhat intriguing. I would say that we're not seeing a preponderance of distressed opportunities today. I think that's a solid 12 to 15 months out. And again, you have to differentiate between, companies that are having secular long-term declines versus companies that just get off sides because of liquidity or whatever it may be. So we're not seeing that. Now, with short-term rates going up so high in such a short manner, I suspect you will see some larger capital structure distressed in 23 and 24. You'll certainly see opportunities over in Europe because of the fundamental challenges they're having with energy prices and the economic backdrop. But it's not something we're seeing short term. And use the term dive in. We're an active player. When you have it's for us, it's like the ocean. Even though there might not be waves, the tide's coming in and out every day. Big platform.
So let's talk about systemic for a second, because every day sitting at Bloomberg, there's a new thing that comes up for investors that's of new concern. Today, a lot of people are talking about the dollar and what that would mean for the rest of the world. The stronger dollar has been a persistent concern for a while now. You also have the gilts market. There's the European banking system, there's the energy crisis, and then there's the great unknowns. There's China, there's you name it. There's a different concern every single day. So when you think about the systemic concerns that could be on the horizon, how do you parse what is something that will be a pressure on the market versus something that is much more sweeping?
Well, again, I go back, there's probably folks that are better at predicting the next global systematic risk. That's not something we spend a lot of time doing. You've mentioned a lot of concerns that probably have been around for quite some time. LDI has existed, the zero COVID policy and lower economic growth in China, the Taiwan chip policy. We can all list the 8, 10, 12, the strength of the dollar. Again, I think you have to get it down to basics. The reality is purchase price matters, discipline matters, free cash flow generation matters. If you're funding companies that generate free cash flow in a challenging economic environment, they have some degree of pricing power, they're not exposed to front-end commodity risks, and they have a proven business model, those are interesting. Out of the Hertz bankruptcy, we bought a business called Donlin, which is a massive fleet finance business for autos for corporations. We merged that with a company called Wheels. We're now one of the top 5 auto lease, bulk lease for large corporates in the US. Certainly a lot of those corporates are being much more price disciplined, but these leases have defaults over 35, 40 years of low single digits. That's a business you want to be in. A variety of the inventory finance, like I spoke to you about. Certainly the need for Unilever to secure ingredients for toothpaste, for Hewlett-Packard to secure product for their machines, for their copiers. Those are all critical parts of our economy that, yes, you want to be exposed to and understand those trade flows. So I don't think that's anything brilliant other than just saying to yourself, there's an evolution going on of how banks think about their ROE, how banks think about their business model, and where can we connect large global investors or global wealth with that intersection.
Now that banking shift has happened certainly since 2008 in a large way. I'm wondering how you see the latest shifts in the banking system really contribute to how you operate and the ways that you can kind of shift to fill the opportunity.
Well, if you're talking about, so right now, arguably the high yield new issue market is essentially shut. There was a couple of transactions last week in the U.S., a couple in Europe, one for the big Italian utility Enel. It took place, that was almost 400 over. So the new issue markets are essentially shut. The banks are long inventory on a handful of very well publicized names. So as you've got a fair amount of private equity dry powder out there, there's no doubt that we, amongst a handful of very large, diverse, well-capitalized firms, will be part of the solution with Wall Street and the banks, if you would, on ridding themselves of existing issue commitments, but also trying to source opportunities for 23 and beyond.
So there's a few things you've mentioned a few times, Apollo first principles, if you will, focus on free cash flow, purchase price matters. So where exactly does the macro come into play for you? Where does it matter the most, or do you have to kind of see through the macro? Perhaps you can use the UK just as one example of that.
The macro really matters in much more of your opportunistic business, especially in distressed and credit. Our PE business has solidified themselves as a great investor in traditional buyouts, but also corporate carve-outs and distress for control. Certainly our current fund didn't have as much distress for control because of the underlying marketplace. Certainly our newer fund, Fund 10, that will probably be a larger component of the opportunity set. So I think as you go down your attachment point, you have to be much more focused on economic cycles and where you're entering. As you get higher in the capital structure, you're really focusing more on pricing impact, not impairment or security, but really pricing and spread impact.
Now, we talked a little bit about the UK, the opportunity there. The other part of the world I'd really love to get your sense of is China. How do you see the opportunity there, kind of given all the greater concerns? You mentioned COVID zero, but certainly there are others for investors as well.
Yeah.
So how do you feel?
We historically have stayed away from China. It's not, certainly from a tech and growth and venture, it's been a very robust environment. That's not what we do. Certainly I think the housing crisis, which you're seeing right now front and center, and how the local municipalities funded the sale of real estate for the government coffers, I certainly think there will be a much more challenging economic environment in China. It's been bandied around about being the largest NPL market in the world 4 or 5 years ago. I suspect that may happen over the next 2 or 3 years. But just because it's a great NPL market and it exists doesn't mean it's a great investment environment for one to put money in. So we're not big believers that there's an opportunity set for our business model in China. I would counter that to other parts in that part of the Asia Pacific environment. We're big players in Australia. We think the capital markets there are going through a real change in the regulatory backdrop, very interesting for credit or private credit in that marketplace. The Japan PE market with what's going on as a dollar investor with the currency depreciating so much in the last year. Very interesting market along with what's going on with the transition of this generation in private capital. So, also places like, Korea and Taiwan are interesting from a savings and annuity and insurance market. So, that's that part. I'd also say in India, we see it as a very interesting potential credit and stress market, some really interesting offshore lending in commercial real estate. Those are 4 or 5 areas that we prefer to invest rather than China per se.
So you were talking about generational change in private capital markets. I think part of the way that's been reflected at Apollo is something that is kind of a newer thing that you guys are doing, that is taking interest in making partnerships with smaller asset managers. There has been a string of that. Another one was announced this morning with Brian former president of Vista. You've done one with a fintech private equity firm, Motive Partners. You've done this with a life sciences firm in Europe. So, what is the grand point of this? How does this kind of help Apollo reach new areas in terms of investing and kind of stay on the cutting edge, if you will?
Well, we know what we're good at, but we also know what we're not good at. I think there's an intellectual humility that comes from leading our business. And, when we can go out and we identify areas where there's some great talent that has built a business line, some overlap, some no overlap. So Motive Partners, Sofanova, Brian Sheth with Haveli, very little to no overlap, but we found it very compelling. We have a large alternative business because of Athene, and we can find great strategies, great investors who are great at their, if you will, niche strategy. We want to partner with them. Some folks like a Diameter, 20-year relationship, they're growing their business, they want to fund and finance, and we've done that not only really most in our credit business. We are a huge CLO originator and issuer and buyer. We've seeded 6, 7 external managers. So, in our view, there are certain firms that really do very, very well, and we want to be able to be a great economic partner to them. So there's not only one play in the playbook. Most things we want to have internally at Apollo, but if it's not something that we have an embedded advantage, we're happy to partner with great experts.
So can we expect more of these types of deals for you?
I think you'll see a few more, no doubt. I think as we think about our longer-term plans for our alternatives platform, we've found times and windows to expand. We did it in the single-family for rent product as well. So I think you'll see a few more of these. Certainly, we're in a market right now where the chances for companies to attract growth capital is more limited. The ability to go public, more limited. And so I think we're finding a preponderance of investment teams and strategies that are confronted with really interesting growth opportunities, but might not have the exact right capital for them to fulfill that. And for us, that's a potential win-win. And again, there's lots of plays in this playbook.
So when you look at the market today, this is my favorite question that I ask every investor I speak to. There's a lot of herd mentality out there as we look at what's going on. What's the biggest mistake? As someone who went through many cycles before, and now that we're going through really what's a generational change that many investors that we look at have never been through, as you've mentioned, what's the biggest mistake people are making?
Well, I think a great degree of overconfidence and lack of humility. You got to respect the markets. You got to respect what's going on right now in the gilt market. You got to respect what's going on in other markets where there was perceived to be massive amounts of liquidity, and things can change. So, a great degree of overconfidence or hubris sometimes always is a great enemy. So we try to make sure we always it's always what's lurking around the corner, but you got to be humble and respect that.
Jim, thank you so much for your time. Thank you all for listening.
Thank you.
Okay, thank you, Jim and Sonali, so much for that. We're going to stick with the credit space for this next session. We'll be welcoming Lawrence Golub. He will be moderated by Julie Siegel, who is the deputy editor of Institutional Investor magazine. Julie's an award-winning reporter and writer on finance, business, and technology. She now covers institutional asset managers, hedge funds, private equity, and trends in investing. Welcome, Lawrence and Julie.
Thank you. Great. Well, glad to be here. Conferences have become so exciting post-COVID, right? So yeah.
Don't sneeze on me.
Yes, I will not do that. Yes, I'm Julie Siegel. I'm thrilled to be here. So just a short introduction of Lawrence Golub. He is the CEO of credit asset manager Golub Capital, with about $55 billion in capital under management to invest. Most of you probably know him. You specialize in financing solutions for private equity-backed companies. So I just want to highlight a few of your outside roles because I do think that it gives you a unique perspective. You're a member of the Harvard Medical School Board of Fellows, a member of the Advisory Council of Harvard Kennedy School Center for Business and Government. You're also involved in Stanford Interdisciplinary Life Sciences Council and on the advisory board of the Impact Labs there. So I think that gives you a really unique perspective. And as we'll talk, Lawrence has been in the business for a long time, was a managing director of Bankers Trust, managing director of Wasserstein Perella, where you built the firm's capital markets group, and debt restructuring. And your first job was at Allen and Co. I guess that's where you really learned all these things with your 24-hour post there, right?
Only 22 hours a day.
22. Okay, good. So we don't have too much time. We've got a lot of ground to cover. So I'm going to let you do that's most of the talking here. So the current macro environment, right? We do live in interesting times, as they say. It's particularly complex for credit markets. So tell me your thoughts on the environment and what you're seeing, in the middle market.
Okay. So we're in a macro framework where we've come out of, in the United States, 2021 being an absolute boom year.
Right.
Boom year because of COVID catch-up, boom year because of general economic conditions. We always talked about it as boomflation. We saw the inflation very, very early. I think probably underestimated it.
Yeah.
Today, we're comparing performance now versus a year ago when it was booming, and the economy's still actually pretty good. The U.S. economy, the U.S. middle market economy, is still pretty good. We just issued our third quarter middle market report, robust growth in revenue, profit growth a little disappointing. U.S. companies still having trouble hiring all the people they want with the right skill set, managerial complexities in terms of dealing with higher input costs and passing through price increases. But outside the interest rate sensitive sectors, the economy probably is better assessed by the unemployment rate at 3.5% than it is by the profit growth rate in terms of just how robust things are.
Okay. So a little optimistic there.
Well, I'd say I'm not pessimistic. I think
Okay.
we're in for a period of overall muddling growth. I don't think we're in for a period of severe recession. It's
Right.
a great time to have recurring revenue. It's not an ideal time to be a home builder. So there's a lot of
Right.
growing disparities sector by sector and even company by company.
Right. Well, and go into the sectors a little bit more. I mean, this middle market report just came out today, right? So it's a picture right now. Go into the sectors just a little bit more. What's doing well and what's not? You mentioned home building, of
Okay.
course.
So in our business, we're very focused on floating rate senior secured loans to resilient companies that have recurring revenues.
Right.
That means we're big. We have hundreds of loans, but we lend to only about half the industries in the United States.
Mm-hmm.
So industries, we don't lend to commodity-oriented businesses, and energy commodity-oriented businesses are booming. We don't lend to interest rate sensitive businesses, and what the Fed has to deal with in part is reducing demand by raising interest rates, and that hits interest rate sensitive sectors. Within our universe, let's go through 4 different categories: consumer, healthcare, industrial, and software. Consumer revenue has held up surprisingly well.
Mm-hmm.
Real growth, even though, for example, gasoline prices in this quarter are $1 a gallon higher than they were same quarter last year. So the growth has held up surprisingly well, and consumer products businesses have struggled a little bit with labor costs if they have a retail orientation, or commodity inputs, food costs. So from a profitability point of view, growth in profits has not kept up with inflation, but growth in revenue has exceeded inflation.
Mm-hmm.
In healthcare, there is a similar issue of supply constraints on skilled labor. and costs on skilled labor that are holding back margins. On industrials, if you look back over the past few quarters, industrials have been the area of least strength in the U.S. economy. I think you had a lot of businesses that bought steel or bought other inputs, and because we hadn't had inflation for 20 plus years, managers forgot about putting raw material cost adjustments into their contracts. And so there was this pig in a python of low margin business that had to work its way through. Now you actually have some easing on, for example, steel prices, and end prices have gone up. Industrials were the strongest segment this quarter. In software, it's important to distinguish what I'm saying between business-to-business software and business-to-consumer software. Business-to-consumer software is outside of our purview. We don't have the expertise, a little bit of a fashion element. We just don't do it. Business-to-business software, which is productivity enhancing, has a lot of tailwinds, but they also have to manage their costs. And there's some indications that what's been years and years of rapid growth in both revenue and profit may be starting to slow down a little bit on the profit margin side. Too soon to say, but Q3 wasn't as strong as other quarters have been.
Got it. Good. So you've said before that, like a good credit guy, right? You can't be confident that you know how fast the U.S. economy, is going to grow next year, or other fundamental measures, right, that people want to look at. So how do you invest when you don't have that full transparency and it's so uncertain? I mean, how do you invest?
Well, a good lender is a scared little rabbit, and we want to focus on margin of safety first and foremost.
Yeah.
We also don't have such high expectations, so muddling growth, if you're a good credit underwriter, muddling growth is just fine. We're not making a loan where the business has to double in size to pay us back. Flat is absolutely good enough over time. What's changing in some people's perceptions is that base rates, LIBOR, what used to be LIBOR, now SOFR, is going up, and a unitranche loan to a private equity credit that might have had a pay rate, a cash pay rate of 6.5% annualized, a year ago, will probably have a pay rate of 11% come February or March. That swing from the base rate going up is actually bigger than whether GDP growth is a point or two higher or a point or two lower. And are we more conservative now than we were a year ago? Sure. We weren't super aggressive a year ago, and we're not super aggressive now, but the risk return is better now. The risk return now is one of the best I've seen in my whole career for a lender.
Which says a lot, because you've seen...
Because I'm old?
No, I didn't say that. You've just seen these cycles. You're mature, experienced. Your resume's long. Just got myself in trouble there.
Yeah.
Okay, so one of the best environments. So a little optimism, still a credit guy, but against this backdrop, right, especially in the U.S., let's go to the investor side. What's driving their interest in private credit specifically?
Okay, so insulation against inflation, insulation against where interest rates go. Those have been two of the best attributes of our asset class forever and continue to be. And as long as an investor is working with an asset manager, a lender who's got a broad set of choices, who's got a nice conservative track record, who has scale to be able to deal with, and every lender is going to have some workouts. We have 400 credits. I mean, every 3 months I get a 1 in 100 call with, bad news. It happens. Yeah. It's a particularly attractive asset class in a more volatile environment. I think that if I were in an investor's shoes, though, I'd also be thinking about the fact that we've had a benign credit environment for a decade, other than the little blip from COVID.
As private credit has been turning into this asset
to show up. 2023 is going to be the first report card in a long time where we as lenders are going to get good grades or less good grades based on how good a job we've done in our lending and picking our partners and deciding what's a satisfactory margin of safety, and most importantly, and this is the most important thing about being a successful lender, saying no. You can love a credit and love a loan, and the terms just get out of whack and you got to walk away. Those are the ones that really cause you to suffer if you don't walk away.
Yeah. But you have to say no before it's a crisis, right?
Oh, you have to say no to the loan. You have to not make the loan.
Right,
you have
right.
to tell the private equity firm who you've done 5 other deals with that, hey, you know, the terms on this one, we don't think you should borrow that much, and if you want to, that's great, but
Yeah,
pick somebody else.
yeah. And they still come back. That's the value of a relationship.
Well, that's part of the value of scale. We have 220 private equity firms we've done multiple deals with, but we don't do every deal.
Right.
I'd say if we do the absolute most that we probably do with a private equity firm would be half of the transactions that they close. And for most, it's a lot less, a lot
Yeah.
less.
Yeah. So talk more about those risks. Like, what should institutional investors, be focused on right now when they're thinking about either managers making new investments? Obviously, there's funds in the market that are doing fundraising. What should they be thinking about?
Well, I'd look at the default and credit loss statistics from the great financial crisis.
Yeah.
And that'll tell you one of 3 things. That'll tell you they did a good job of managing through the great financial crisis. That'll tell you they didn't do a good job. Or that'll tell you they didn't exist then and nobody knows if they're going to do a good job or not do a good job.
Yeah.
I'd ask, how many people do you have doing portfolio valuation? I mean, there are benefits to scale. We have a whole department that monitors our loans and does valuations and mark-to-market on our loans who are not even in the same chain of command as the people who are making the loans. You can't give your own child a grade and expect that grade to be realistic. If I were advising an investor, I'd ask, how do they handle workouts? Is there a workout department? How many workout professionals do they have? You need to expect there's some cyclicality in the intensity of how much you have to pay attention. And one of the biggest ways we've made money for our investors over the past 25 years is by avoiding losses. Sure, absolutely, the best way to do a good job for investors is to make a good loan. Second best way is don't make a bad loan. But
Right.
One of the other things that distinguishes us is we have a tremendous number of situations over time. They hit a bump, they get unlucky, you're paying attention and you do something about it, and you break even on the loan instead of losing money. There's a lot of texture, experience, scale, and confidence in your relationships with your partners that's needed to actually say, wow, this may be a problem, we need to do something.
Right. I remember thinking just even a few years ago, like those people in restructuring and workouts. I mean, there weren't that many of them, right? It had been a while since a lot of that activity was really prevalent.
Yes, and it's a different skill set. Some of it is just objectivity. On the one hand, we have, and something that should be important to an investor is, does the lender have a deep relationship with the borrowers, with the private equity firms? Because if a private equity firm wants to borrow money from you, you're going to get the picks of the litter. You're going to get better deals.
Right.
In just the same way, you want to look at how does the lender do with those private equity firms post-closing? Are they really helping with add-on acquisitions? Are they helping with delivering bad news in a gracious, partnerly way? Or, and there are some lenders who get super tough in a workout, and that might well recover a few dollars more in that one deal, but it isn't good for the fund. It isn't good for the overall relationship.
Right. In a gracious way. I'm going to remember that. I like that. Well, so speaking of private equity, talk about the macro environment and the effect on private equity. What's happening, right now? What kind of opportunities are there? I mean, that's obviously this is what you specialize in. So give us a sense of the private equity industry.
So 3 observations. One is that the pace of new transactions right now, new platform acquisitions by private equity firms, has slowed down some.
Yeah.
And that happens every 5 or 6 years. It's hard for buyers and sellers right now to really come to an aligned view on what run rate EBITDA is. And so you can't even have that sensible or gracious of a negotiation over what the purchase multiple should be if you can't even see eye to eye about what run rate EBITDA is. So I think we all as investors, lenders, participants in the community should expect somewhat slower pace over the coming quarters than we've had. Number 2, the opportunity for add-on acquisitions has improved tremendously. Because the M&A environment is a little bit weaker, healthy businesses that can grow by acquisition are able to acquire targets at much lower prices if they have the capital. And if they have the capital, to some extent, is good for us, it's good for our private equity partners, and we're making lots of follow-on loans to existing portfolio companies. Those loans are well priced. Those loans have large margins of safety because we know the borrower. Those loans are highly accretive to equity value because these acquisitions are coming in at attractive prices.
So it's just changed,
Okay.
More than anything, right? I mean, people talk about all the dry powder that the private equity industry has, but it's not so much. It's just a different focus for them.
For them,
Yeah.
to some extent. And then I guess another observation where things aren't so different would be, say, private equity acquisitions of software businesses where public values have come down so much
Right.
that companies, private equity firms in that sector might want to have purchased 2 years ago, couldn't make sense, couldn't make the numbers work, and now it does, and you're seeing actually an increased number of public to privates in the software area. There is a huge amount of dry powder, and it will eventually get spent, but the timing in which it's spent will be based on external factors to a certain extent.
Got it. So let's get back to one of your comments earlier about it being such a good time. So what are you seeing specifically? Are there examples, sectors, just maybe even deals you could talk about? What are you seeing specifically?
So I'm not going to talk about specific deals, but the category that is really most interesting to us now are add-on acquisitions, where we have borrowers who we've worked with for a few years, and maybe in an ideal scenario they've grown a little more slowly than they wanted because those add-on acquisitions cost 10 times EBITDA, and they really don't want to pay more than 7, and now all of a sudden they're available at 6. And we have to focus with them very carefully on adjustments. Margin of safety and paying a multiple of adjusted EBITDA are inconsistent with each other. The adjustments sometimes turn out to be real EBITDA and sometimes they don't, but you can only pay our interest costs with real EBITDA. So that gets a little more complicated when you have more volatility in the economic environment. But as a category, the ability to make loans at SOFR plus 650 at lower leverage levels than a year ago with fewer adjustments in the pro formas and old adjustments having burned off is a very appealing risk-reward part of the cycle.
Okay. You're not jumping for joy, but because you don't want things to burn down, but
well, I think I'm being a little measured for a couple of reasons, including it's not altogether clear what the pace of transactions is going to be. And we've got a lot of issues in terms of international volatility, the dollar. We have a really nice margin of safety. We're getting paid well. But the world has some balls in the air right now.
A few balls in the air, true. So the private credit industry has grown enormously since the global financial crisis, both in terms of investors and managers. some people say there is going to be a shakeout of some of those managers that haven't seen cycles, or as their mistakes become more visible. I mean, what do you think? What are you expecting?
So the industry has gotten bigger. It's gotten bigger because of investor demand, and it's gotten bigger because the solution set has gotten bigger. Yeah. There's been a migration of upper middle market and smaller large market loans from the broadly syndicated loan market to the private credit markets. Why? Well, private credit is a better solution. You might have to negotiate some covenants as a borrower, as a private equity firm, but you have more certainty, you have more flexibility. You can implement your plans to actually earn your return on equity over time. And one of the limiting factors on what deals would be handled in the private versus the broadly syndicated loan markets was just depth of demand. I mean, doing a $2 billion private credit deal 3 years ago was a very rare thing. Being able to do that today, not so rare. So the addressable market for private credit in dollars has actually grown considerably. Now, there have been a fair number of new entrants, and in any growing market, entering is one certain skill set, and then a market starts to mature and competitive advantages start to make more difference. Scale starts to make more difference. Right. I think that two of the things I mentioned earlier, which is the ability to underwrite and avoid taking too much risk, which paraphrases into the ability to say no to deals so that you're not just taking everything that comes along, translates into when you get to a muddling growth period, do your credit losses go up a lot or do they not go up a lot? I think that it is likely that not every significant credit firm that exists today will exist 10 years from now. But that's not anything that surprising. I mean, there have been plenty of cycles, and in a cycle, the firms that have scale, have alignment of interest with their investors, and who avoid doing things that are dumb, do well and grow. And the ones that are dumb or unlucky or didn't have the right business model fade away.
Right. And it's interesting too, all that competition, right, in the past decade plus has also changed the industry for the better too, right? Fees have perhaps dropped, and there's maybe
well, that's not a good thing.
Transparency. Okay. Well, I guess it depends on what's on the table, but you are on. But there have been changes, right? So even if it changes again, there's that kind of institutionalization and other things.
At a most basic level, having smart, relatively unregulated lenders who control their capital base, who are making long-term loans with a long-term point of view, is better for the investors and it's better for the borrowers.
Yeah. And the system.
Yeah, the whole system.
Yeah, although we'll get that first test. We thought the test was coming during COVID, right? But it did not.
COVID ended up being much more benign and short-lived from a financial point of view.
Right.
Than it looked like in March of 2020.
So we only have a few minutes. Oh, we only have 40 seconds. Talk about private credit 2.0. Just a glimpse of what's next from a product perspective, areas of opportunity.
So, area of concern. Every time we go through a long period of private credit doing well, people figure out ways to promise investors more liquidity than the asset class provides. If you're an investor and you think if you're an investor and you're investing in private credit and LBO credit and you think you have liquidity, you may have idiosyncratic liquidity if you yourself just decide to change your mind.
Right.
But you and all your brethren do not. That's a concern. It goes back to who some of the players are going to be. I think we're going to see a period of time of muddling growth where there will be somewhat higher credit losses than we've had because there'll be less of a tailwind, and I think you'll see a big dispersion. The best managers are going to outperform the less good managers by a much more dramatic difference than we've seen since the great financial crisis.
Nice place to end. I like that. Well, thank you so
Thank
much.
you.
This is great. No one me for them all the time. Okay.
Okay, thank you, Julie and Lawrence, for that. We are going to release you now for about a 40-minute break. We're going to reconvene here at 10 after 11, and you don't want to miss Cathie Wood. That's the next session, a panel moderated by Eric Schatzker. So enjoy. See you back at 11:10.
Our capital is helping to solve some of the world's most complex problems by securing retirement for millions of families, building and financing stronger businesses, and driving a more sustainable future for our communities. Bridging our economic present to our future. Empowering people to retire better, from teachers to firefighters and other essential workers, Apollo is creating retirement solutions for millions of families. We're investing across sectors and geographies to create jobs and support local communities, and partnering with businesses large and small to fund their growth and enable transformation. As we look to new generations, we are committed to making progress and to developing a more sustainable future as a leading capital provider accelerating the energy transition, from development to production, all the way through to consumption. Building a better future also means expanding opportunity across our ecosystem. It means deepening our relationships, broadening our network, and developing new connections every step of the way to better serve our investors and our communities. Through it all, consistently challenging convention, sparking new ideas, and fueling innovation. At Apollo, we are investing in tomorrow, today.
Surfing with waves of digital financial technologies. With the rapid development of digitalization and globalization of financial markets, Surfin has always been driven by digital technologies to invest globally. Surfin Group specializes on two major areas, digital finance and technology empowerment. Since 2017, Surfin Group has invested across 3 continents, which are Asia, Latin America, and Africa. With 20 million users in 8 countries and a total transaction volume of over $2 billion, Surfin invests digitally. Surfin Group focuses on digital investing to empower financial services and asset management globally. Surfin Group processes and develops tens of terabytes of data, hundreds of big data models, millions of feature vectors, millions of effective product models, and asset allocation portfolios. Surfin has global risk management experience. Surfin Group delivers risk management expertise in global asset allocation and investment. The investment and technology can be efficiently married by individually matching of dynamic asset allocation portfolio based on big data and personalized efficient frontiers, integrated with multi-asset classes, multi-trading frequencies, and multi-strategies through risk parity allocation. Personalized and diversified portfolios can be constructed to provide scalable asset allocations and across various market cycles. Surfin Group also develops a fully functional and convenient digital integrated wealth management and different markets, which can provide middle-class customers with digital smart financial services, including news and information, user forums, investor education, investment advisory, and financial planning services to enhance global investment experiences. Surfin Group develops 4 proprietary core technology systems that enables real-time online accessing, multi-ethnic group matching, and global multi-country servicing. Intelligent Risk Appetite System, EKYC System, Big Data Behavior Analytics System, AI Smart Voice System. Surfing Group looks for and win-win cooperation with various partners to develop an ecosystem to invest in emerging markets. Surfin Group has always been persevered, persistent, and passionate. Surfin shall stay focused and strive to serve more global investors with digital technologies and making life better with smart, open finance.
Companies of all sizes rely on us. Moving it across North America, network that covers 99% of all U.S. zip codes. When freight is put in our hands, it gets where it needs to go, safely and on time. Our customers are growing, and we are too, expanding our footprint and fleet, and certifying more truck drivers at over 130 XPO driver training schools. And we're constantly enhancing our technology, creating new network efficiencies to ensure a world-class LTL shipping experience from pickup to delivery. With industry know-how, local knowledge, and the hunger to keep improving results, when you ship with XPO, you'll find that our people are committed to your success. XPO, your freight first.
Over 250 million young people are not in education, employment, or training. But how you start in life shouldn't determine what you do in the future. In the last 3 years, Future Makers by Standard Chartered has supported more than 650,000 talented young people from low-income communities, transforming lives by empowering them to learn, earn, and grow. Because where others see problems, we see potential. We're Standard Chartered, and we're here for good.
What if you could invest in private equity, real estate, private credit, even art, with clarity, confidence, and help when you need it? Meet Yield Street, the leading platform for private market investing. We believe that private market alternatives, like real estate, private credit, and art, should be a fundamental part of your portfolio. In fact, investment professionals recommend allocating at least 20% of your portfolio to alternatives. So, how can alts create a more efficient portfolio? Versus traditional investments, alts reduce risk while maintaining your expected returns, or maintain your risk level while potentially improving your expected returns. We talked to actor and former White House staffer Cal Penn to help explain private markets.
If you're watching this video, it means you've been wondering, what are alternative investments? And why are all your So, alternative investments are basically anything beyond the stock and bond markets. You're probably most familiar with real estate. I know I love places. A beautiful resort. Or maybe just an office far away from your perfectly behaved children. There's also private equity, venture capital, and a few more that aren't as mainstream, like art and crypto. Basically, lots of cool things to discover. When you put alts in your portfolio, you're helping to ensure that you have investments that don't always follow the ups and downs of the stock market. Yep. Here we go again. That, my friends, is called diversification. In addition, people like alternatives because they can generally outperform
stock market? Invest in curated private market alternatives from top managers, all on one easy-to-use platform. Evolve your wealth. Yield Street, private market investing.
MFA exists to serve and represent the private fund industry, and we do this through advocacy and convening our members to address key business and operational issues.
So the MFA is a phenomenal partner of resources and peer groups and forums that comes together.
And this ability to bring people together is just so important because it just makes me better, makes my team better.
What the MFA does is the MFA sits firmly in the middle and is ensuring that as they take the inputs from the regulators, take the inputs from the policymakers, and then take the inputs from the manager, that feedback loop that they're bringing is going both ways.
If we have a growing and active membership, that provides MFA in the industry with more resources, more credibility to better advocate for those programs that support the industry's growth.
So when you join it, you're not joining an association, you're joining a group of peers that have common interests and really want to help you succeed.
There's no downside. It is truly all upside when you become a member of the MFA.
Surfing with waves of digital financial technologies. With the rapid development of digitalization and globalization of financial markets, Surfin has always been driven by digital technologies to invest globally. Surfin Group specializes on two major areas: digital finance and technology empowerment. Since 2017, Surfin Group has invested across 3 continents, which are Asia, Latin America, and Africa, with 20 million users in 8 countries and a total transaction volume of over $2 billion. Surfin invests digitally. Surfin Group focuses on digital investing to empower financial services and asset management globally. Surfin Group processes and develops tens of terabytes of data, hundreds of big data models, millions of feature vectors, millions of effective product models, and asset allocation portfolios. Surfin has global risk management experience. Surfin Group delivers risk management expertise in global asset allocation and investment. The investment and technology can be efficiently married by individually matching of dynamic asset allocation portfolio based on big data and personalized efficient frontiers, integrated with multi-asset classes, multi-trading frequencies, and multi-strategies through risk parity allocation. Personalized and diversified portfolios can be constructed to provide scalable asset allocations and across various market cycles. Surfin Group also develops a fully functional and convenient digital integrated wealth management platform across borders and different markets, which can provide middle-class customers with digital smart financial services, including news and information, user forums, investor education, investment advisory, and financial planning services to enhance global investment experiences. Surfin Group develops 4 proprietary core technology systems that enables real-time online accessing, multi-ethnic group matching, and global multi-country servicing, intelligent risk appetite system, EKYC system, big data behavior analytics system, AI smart voice system. Surfin Group looks forward to seeking mutual benefit and win-win cooperation with various partners to develop an ecosystem to invest in emerging markets. Surfin Group has always been persevered, persistent, and passionate. Surfin shall stay focused and strive to serve more global investors with digital technologies and making life better with smart, open finance.
Ensuring a bright, bold future means investing in tomorrow, today. And Apollo is at the forefront. Our capital is helping to solve some of the world's most complex problems by securing retirement for millions of families, building and financing stronger businesses, and driving a more sustainable future for our communities. Bridging our economic present to our future. Empowering people to retire better, from teachers to firefighters and other essential workers, Apollo is creating retirement solutions for millions of families. We're investing across sectors and geographies to create jobs and support local communities, and partnering with businesses large and small to fund their growth and enable transformation. As we look to new generations, we are committed to making progress and to developing a more sustainable future as a leading capital provider accelerating the energy transition, from development to production, all the way through to consumption. Building a better future also means expanding opportunity across our ecosystem. It means deepening our relationships, broadening our network, and developing new connections every step of the way to better serve our investors and our communities. Through it all, consistently challenging convention, sparking new ideas, and fueling innovation. At Apollo, we are investing in tomorrow, today.
Surfing with waves of digital financial technologies. With the rapid development of digitalization and globalization of financial markets, Surfin has always been driven by digital technologies to invest globally. Surfin Group specializes on two major areas: digital finance and technology empowerment. Since 2017, Surfin Group has invested across 3 continents, which are Asia, Latin America, and Africa, with 20 million users in 8 countries and a total transaction volume of over $2 billion. Surfin invests digitally. Surfin Group focuses on digital investing to empower financial services and asset management globally. Surfin Group processes and develops tens of terabytes of data, hundreds of big data models, millions of feature vectors, millions of effective product models, and asset allocation portfolios. Surfin has global risk management experience. Surfin Group delivers risk management expertise in global asset allocation and investment. The investment and technology can be efficiently married by individually matching of dynamic asset allocation portfolio based on big data and personalized efficient frontiers, integrated with multi-asset classes, multi-trading frequencies, and multi-strategies through risk parity allocation. Personalized and diversified portfolios can be constructed to provide scalable asset allocations and across various market cycles. Surfin Group also develops a fully functional and convenient digital integrated wealth management platform across borders and different markets, which can provide middle-class customers with digital smart financial services, including news and information, user forums, investor education, investment advisory, and financial planning services to enhance global investment experiences. Surfin Group develops 4 proprietary core technology systems that enables real-time online accessing, multi-ethnic group matching, and global multi-country servicing. Intelligent Risk Appetite System, EKYC System, Big Data Behavior Analytics System, AI Smart Voice System. Surfin Group looks forward to seeking mutual benefit and win-win cooperation with various partners to develop an ecosystem to invest in emerging markets. Surfin Group has always been persevered, persistent, and passionate. Surfin shall stay focused and strive to serve more global investors with digital technologies and making life better with smart, open finance.
Companies of all sizes rely on us for world-class, less-than-truckload freight transportation. We handle our customers' freight as if it were our own. moving it across North America
Testing,
on
1,
a coast-to-coast
2,
network that covers 99% of all US zip codes. When freight is put in our hands, it gets where it needs to go, safely and on time. Our customers are growing, and we are too, expanding our footprint and fleet, and certifying more truck drivers at over 130 XPO driver training schools. And we're constantly enhancing our technology, creating new network efficiencies to ensure a world-class LTL shipping experience from pickup to delivery. With industry know-how, local knowledge, and the hunger to keep improving results, when you ship with XPO, you'll find that our people are committed to your success. XPO, your freight first.
Over 250 million young people are not in education, employment, or training. But how you start in life shouldn't determine what you do in the future. In the last 3 years, Future Makers by Standard Chartered has supported more than 650,000 talented young people from low-income communities, transforming lives by empowering them to learn, earn, and grow. Because where others see problems, we see potential. We're Standard Chartered, and we're here for good.
What if you could invest in private equity, real estate, private credit, even art, with clarity, confidence, and help when you need it? Meet Yield Street, the leading platform for private market investing. We believe that private market alternatives like real estate, private credit, and art should be a fundamental part of your portfolio. In fact, investment professionals recommend allocating at least 20% of your portfolio to alternatives. So how can alts create a more efficient portfolio? Versus traditional investments, alts reduce risk while maintaining your expected returns, or maintain your risk level while potentially improving your expected returns. We talked to actor and former White House staffer Kal Penn to help explain private markets.
If you're watching this video, it means you've been wondering, what are alternative investments? And why are all your savvy investor friends talking about them? Or maybe that's gonna be you right after this video. So, alternative investments are basically anything beyond the stock and bond markets. You're probably most familiar with real estate. I know I love places. A beautiful resort. Or maybe just an office far away from your perfectly behaved children. There's also private equity, venture capital, and a few more that aren't as mainstream, like art and crypto. Basically, lots of cool things to discover. When you put alts in your portfolio, you're helping to ensure that you have investments that don't always follow the ups and downs of the stock market. Yup. Here we go again. That, my friends, is called diversification. In addition, people like alternatives because they can generally outperform the stock market. So, how can you get started? Before Yield Street, you probably would have had to pony up $1 million and tie it up in a single investment. Yikes. But now, the potential of private markets is at your fingertips.
Thanks, Cal. With $3 billion invested on the platform and almost $2 billion in principal and returns paid to investors, and 9.6 realized net annualized returns, isn't it time to diversify away from the stock market? Invest in curated private market alternatives from top managers, all on one easy-to-use platform. Evolve your wealth. Yield Street, private market investing.
MFA exists to serve and represent the private fund industry, and we do this through advocacy and convening our members to address key business and operational issues.
And so the MFA is a phenomenal partner of resources and peer groups and forums that comes together.
And this ability to bring people together is just so important because it just makes me better, it makes my team better.
What the MFA does is the MFA sits firmly in the middle and is ensuring that as they take the inputs from the regulators, take the inputs from the policymakers, and then take the inputs from the manager, that feedback loop that they're bringing is going both ways.
If we have a growing and active membership, that provides MFA in the industry with more resources, more credibility to better advocate for those policy outcomes that support the industry's growth.
So when you join it, you're not joining an association, you're joining a group of peers that have common interests and really want to help you succeed.
There's no downside. It is truly all upside when you become a member of the MFA.
Surf in with waves of digital financial technologies. With the rapid development of digitalization and globalization of financial markets, Surfin has always been driven by digital technologies to invest globally. Surfin Group specializes on two major areas: digital finance and technology empowerment. Since 2017, Surfin Group has invested across 3 continents, which are Asia, Latin America, and Africa. With 20 million users in 8 countries and a total transaction volume of over $2 billion, Surfin invests digitally. Surfin Group focuses on digital investing to empower financial services and asset management globally. Surfin Group processes and develops tens of terabytes of data, hundreds of big data models, millions of feature vectors, millions of effective product models, and asset allocation portfolios. Surfin has global risk management experience. Surfin Group delivers risk management expertise in global asset allocation and investment. The investment and technology can be efficiently married by individually matching of dynamic asset allocation portfolio based on big data and personalized efficient frontiers, integrated with multi-asset classes, multi-trading frequencies, and multi-strategies through risk parity allocation. Personalized and diversified portfolios can be constructed to provide scalable asset allocations and across various market cycles. Surfin Group also develops a fully functional and convenient digital integrated wealth management platform across borders and different markets, which can provide middle-class customers with digital smart financial services, including news and information, user forums, investor education, investment advisory, and financial planning services to enhance global investment experiences. Surfin Group develops 4 proprietary core technology systems that enables real-time online accessing, multi-ethnic group matching, and global multi-country servicing. Intelligent Risk Appetite System, EKYC System, Big Data Behavior Analytics System, AI Smart Voice System. Surfin Group looks forward to seeking mutual benefit and win-win cooperation with various partners to develop an ecosystem to invest in emerging markets. Surfin Group has always been persevered, persistent, and passionate. Surfin shall stay focused and strive to serve more global investors with digital technologies and making life better with smart, open finance.
Ensuring a bright, bold future means investing in tomorrow, today. And Apollo is at the forefront. Our capital is helping to solve some of the world's most complex problems by securing retirement for millions of families, building and financing stronger businesses, and driving a more sustainable future for our communities. Bridging our economic present to our future. Empowering people to retire better, from teachers to firefighters and other essential workers, Apollo is creating retirement solutions for millions of families. We're investing across sectors and geographies to create jobs and support local communities, and partnering with businesses large and small to fund their growth and enable transformation. As we look to new generations, we are committed to making progress and to developing a more sustainable future as a leading capital provider accelerating the energy transition, from development to production, all the way through to consumption. Building a better future also means expanding opportunity across our ecosystem. It means deepening our relationships, broadening our network, and developing new connections every step of the way to better serve our investors and our communities. Through it all, consistently challenging convention, sparking new ideas, and fueling innovation. At Apollo, we are investing in tomorrow, today.
Surfing with waves of digital financial technologies. With the rapid development of digitalization and globalization of financial markets, Surfin has always been driven by digital technologies to invest globally. Surfin Group specializes on two major areas: digital finance and technology empowerment. Since 2017, Surfin Group has invested across 3 continents, which are Asia, Latin America, and Africa, with 20 million users in 8 countries and a total transaction volume of over $2 billion. Surfin invests digitally. Surfin Group focuses on digital investing to empower financial services and asset management globally. Surfin Group processes and develops tens of terabytes of data, hundreds of big data.
Ladies and gentlemen, we'll be starting in just 3 minutes. Please make your way back to your chairs. We'll be starting in just 3 short minutes. Please make your way back to the chairs.
Is this on? You can hear me, okay. Welcome back. Thank you for getting settled. And can I have your attention? Thank you. If there are people that want to keep conversations going, absolutely more than happy to have you connecting and networking. We just ask that you do that outside because we're going to jump back into the program now. Thank you. Thank you, everyone, for settling. So we're going to turn it over. We're moving to a discussion about AI, innovation, and the new economy. We're going to be moderated by Eric Schatzker, who I'm sure many of you know. He is the editorial director of Bloomberg New Economy. Bloomberg New Economy is the division of Bloomberg Media dedicated to coverage of and engagement with the global transition to a more resilient, equitable, and sustainable economy. Welcome, Eric, and our panel, Cathie and Ulrich.
Good morning, everybody. Is this working? It appears to be working. This is Cathie. This is Ulrika. Let's get started, shall we? I want to begin this way, by rewinding the tape to February of 2021. Cathie, at the time, your flagship ETF, ARKK, was up 350% from the pandemic low. And cash, as you may recall, was pouring in so quickly, people wondered if you could deploy it all. And Ulrika, Tudor doesn't run ETFs, so I must imagine that your return profile is different than Cathie's, but you're a technology specialist, and so you were enjoying some of the same tailwinds. And since then, as we all know, it has been a bloodbath for investors in innovation. And of course, we think we know why, right? We think it's about inflation, we think it's about the Fed, we think there's some Ukraine in there. But Cathie, I want to start with you because you're often a contrarian and unconventional thinker, and I just gave you the conventional reasons for why what has happened from your perspective. What happened?
Well, I mean, we agreed that if inflation and interest rates took off, that would be a problem for high valuation stocks. But I do think what is happening now, we saw a dry run of it before COVID. So if you remember before COVID, as we realized what a problem we had on our hands, the globe had, I think the markets were down in 1 month's time 25%. We were down 46%. From those lows, as you just said, we from April 20 to 21, 350, 360%. Since then, just to keep the perspective here, down 75% at our low in May. Now we're probably testing it today as we speak, so we shall see. I think one of the things that has happened is during risk-off periods, we see a rush back into indexes. So a lot of the market's gone passive, but when we move into risk-off, this idea of career risk, business risk surfaces in discussions, and there's a movement back into benchmark stocks. We don't own the big benchmark stocks. Only one of our stocks has made it into the benchmarks, and that's Tesla. And believe it or not, Tesla's held up better than our portfolios, right? So I think there's been a lot of algorithmic trading. I felt it pre-COVID, the variables algorithms focused on, cash burn, cash cushion. And yet at the time we were saying, wait a minute, this makes no sense. This is COVID, and we need to solve this problem. Innovation solves problems. And so that was one of the reasons we had that swoosh, right? We were solving problems, global digitalization, figuring out how we sequence the coronavirus and so forth. I think the same thing now. We've had this incredible decline. We have so many more problems now. Supply chain, Russia's invasion of Ukraine. Innovation solves problems, and yet these algorithms and very short-term time horizons. Ours is 5 years. The market in risk-off goes to 1 quarter. Algorithms are dominating the market. It's very interesting. Most people don't know what our companies do. and they don't know the kinds of problems they are solving. But as we've gone through this period, this 75% decline, we've concentrated from 58 names to 33 names, to our highest conviction names. Typically, that's a very good strategy for the turn in the market.
Ulrika, would you agree that this isn't simply a matter of using a different rate to discount future cash flows, and there are, flows help to explain what's happened to innovation names, and technicals help to explain what's happened to innovation names, and the arrival, or at least the supercharging of certain kinds of other strategies in the market?
Well, I would say the biggest difference is, as you said, rates. We were in an environment of almost zero rates, and in that environment, a lot of things get funded, moonshots, Mars shots, maybe Mercury shots. But when the opportunity cost is no longer zero, that's a very different investment environment, and I think we have to brace ourselves for that. As much as I'm excited about investing into innovation, AI, and data infrastructure, if I actually apply exactly those vast amount of data, like the last 75 years of economic data and machine learning, you come to the conclusion that federal funds rates might have to go to well above 5% to get to the 2% PCE inflation that the Fed is targeting. And then that in turn is the second point, that GDP growth will have to decline next year. So I think we're at the point where the economic cycle and the innovation cycle are turning in opposite directions. And that's very different from the last decade, where those two wheels have been turning in unison. The innovation wheel is still turning, that's the good news, but it's going to be throttled by the economic slowdown that we are experiencing.
The prevailing view in the second half of 2020 and early 2021 was that the pandemic had brought the future forward, that the digital economy was on a different trajectory, a trajectory that was independent from the rest of the economy forever, and that the valuations of stocks like Peloton and Zoom and Shopify and CRISPR and Twilio were not extreme, but rather justified. Why, Ulrika, have the things that seemed so right then, that made sense then, turned out to feel so wrong now? Those explanations don't work any longer.
Well, I think, back to the two wheels, I think, the economic cycle has had almost a multiplicative effect on the innovation cycle. And so now we're just at a very different economic climate. And if we look at past stock market corrections, especially rate-induced ones, there are typically two stages. The first stage is where valuations, extreme valuations that we have seen, take a hit. We have seen this in the first 2 quarters of this year. The good news is we can check that box. We are through that. But we're just about to enter the second phase, where actually the economy is starting to weaken, where we'll see companies miss earnings, negatively pre-announced. We heard FedEx, also AMD last week. So we'll see more of that. And at the same time, we'll still see more multiple contraction going forward because there's more economic uncertainty. So this, unfortunately, is not a straight path down, because often, you see bear market rallies and results are better than feared. And the reason for that is that it just takes time for these rate increases to put their claws on the economy. The half-life is about 2.5 quarters, so we're still seeing the brunt of this economic malaise next year.
Is the core thesis to innovation investing still intact?
Yes, we, like Cathie, have a very long-term horizon in our investments, 5 to 10 years. But my take as an innovation investor right now, there's the short term, is the medium term. So in the short term right now, for me, it's all about hedging. And I know hedge funds tend to get a bad rap because apparently we're so short-termist, but to hedge actually means to protect. And hedging allows us staying power in those companies that we believe have the best growth prospects over the next 5 to 10 years.
Cathie, you were, I'm sorry, keep going.
But I think there is some really bright light at the end of this tunnel, which is that we will have a once-in-a-decade opportunity, I think, in the next few quarters. Right now we have to be patient, where we will, almost like time traveling back to 2001 and buying Amazon at less than $1 a stock, only that this time around it's going to be the next generation of the FANGs. But for now, prudence, patience, and hedging.
Cathie, this is more of a matter of curiosity for me than anything. You weren't blind to the risk of a correction. In fact, when you and I talked in December of 2020, I remember vividly you saying there's a really good chance that the correction is just around the corner, and of course, it did turn out to be just around the corner. Ulrika just mentioned the importance for her of hedging. Now, you run an ETF or a series of ETFs, and they are, for the most part, fully invested. There's occasionally a little bit of cash in them,
Very little cash.
but very little. I would like to know, and I think people here might like to know, if you were running a different kind of a vehicle, would you be managing it differently? Would you be investing differently? Would you be hedging? Would you be allocating more to cash? Would you be buying protection in the options market?
So so you're asking about the wrapper, separately managed.
Yeah.
Okay, we do run other accounts like that. But we're very clear about what we do and what we don't do. We are not an asset allocator. We are focused exclusively on disruptive innovation, transformative innovation, and I think we're fulfilling an unmet need out there. We are doing research and giving it away to help educate people on how our world is going to transform. And I think the underlying premise in your questions, Ulrika, is that inflation is the problem and might remain the problem. We actually think there are signs all around the world that deflation will be the bigger problem. And as I understand from this conference, I don't think the word deflation has been mentioned here. So I kind of like that. If everybody is sure something's happening and you have evidence brewing that might not be true, those are great calls. Now, I have a macro background. If I were running a macro fund, I think it would have done pretty well this year, but that's not what we do. We do have a point of view, though, on deflation from two angles. Cyclical, in the pipeline, commodity deflation is proliferating. And then downstream at the consumer end, and this is globally, we are being overwhelmed by inventories. So we believe in this holiday season that will become clear. It was interesting to see the online expectations for this holiday season, only 2.5%. That doesn't allow much room for real growth or inflation, right? Something's wrong out there, number one. And then the other thing is innovation, especially the amount of innovation that is evolving today, is inherently deflationary. There are massive deflationary undercurrents. And the base of these new ways of doing things is getting high enough to start moving the needle. So I believe in the next 3 to 6 months, you're going to hear more talk about deflation.
I want to point out one thing, which is that you've been very consistent. In my experience with Cathie, she is consistent. If you go back 10 years, if you go back 12 years, you will have heard her saying many of the same things she's saying today. But specifically on the subject of deflation, you were talking about deflation a year ago. Mm-hmm. Now, it's true, we lived through an awful lot of inflation since then. I'm curious to know why, not just that you believe deflation is important to talk about, but why you've brought this up in a very open way. You wrote an open letter yesterday that the Federal Reserve, speaking to the risk of what you called policy error, not the only person, by the way, who's suggested the Fed may be going too far too fast. Why throw it out in the open like that?
We were struck at the unanimity of the vote among the Fed governors. And that tells us that this discussion is not getting out there broadly enough. And so we wanted to raise some points, specifically the commodities I just mentioned, downstream, used car prices. Used car prices were one of the first indications that the supply-demand imbalance was going to become extreme. They went up 54% year over year, tested to 45%. Now they're down year over year. And we think they're actually going to go down a lot more. Why? Because of the shift, the consumer preference shift to electric vehicles. The residual values of gas-powered vehicles, we believe, is going to fall apart. Many people inventoried a car because they did not want to take mass transit. They didn't need that car. Mass transit is back. Now they were looking at prices saying, oh my gosh, I could get a nice profit. Now they'll have an inventory loss. Maybe they won't take it, maybe they'll keep the car. But we think the dealers are going to be in a lot of trouble. They already are. The stock market is telling us.
Ulrika, there are important linkages between economic conditions, the capital markets, and the innovation cycle. Do you worry that the rising cost of capital, demand destruction from monetary policy, and the risk of a recession, if we aren't already in one, will damage the funding model and maybe even the business model for transformative technology?
Yeah, for sure it will have an impact. Maybe just very, very briefly to your inflation point, if I may. If we look currently at the composition of PCE inflation, about half of it is demand-driven and half of it is supply-driven. So even now that we are seeing these supply chains loosening up, even if we were to go back to pre-COVID levels from a supply side, we would still get to a PCE about 4%. So I think, maybe just also tying this into your point, right now the Fed doesn't seem to have a choice but to go and target the demand side inflation, which means bringing GDP down and raising rates further. So yes, I do think it will impact, the cost of capital will impact what's getting funded. That innovation wheel is slowing. But the question is, there is bright light at the end of the tunnel. Every recession ends, every rate cycle ends, and typically the data shows that 1 to 3 quarters after the peak in rates, we see a bottom in the equity market. So I think what we are going to is transitory and will open up an incredible investing opportunity set into innovation as we are coming out of that.
Be careful, transitory has become a 4-letter word.
I think history will judge this. Transitory just took a little longer. I'll also make a point that what we have in the Fed is really a Keynesian Fed that does believe that inflation and demand are positively correlated. The history in the 80s, 90s, and the 2000s is that is not true. When growth picks up, productivity picks up, right? And that is a potent anti-inflationary force. The other thing that's going on, and it's been interesting to watch the surprise around the dollar's increase, 25% in the last year. That's another powerful inflationary, anti-inflationary force. So
in this country anyway.
In this country, but what the problem in the emerging markets, it's crushing them. Why? I remember, I've been in the business for a while, as most of you know. In the early 80s, the dollar did the same thing in response to monetary policy, and we ended up in the Plaza Accord and the Louvre Accord, where all of the treasury ministers around the world, including our own, decided to sell dollars and buy those other currencies because that dollar increase was becoming deflationary. Why? Dollar-denominated debt, right? As their currencies are falling apart, their ability to service dollar-denominated debt is disappearing, and that's why many of them are going to the IMF. You've got the IMF, the World Bank, and one other organization basically saying, do you understand what's going on out here? The US doesn't. It really doesn't. We are somewhat myopic, and we are the strongest economy in the world, but it's going to come back to bite us if we're not careful.
Ulrika, on Friday, as many here will have noted, the US government imposed a de facto ban on the exports of advanced technology to Chinese buyers. How much of a factor has geopolitics become in the innovation equation?
Yeah, we are headed to a bipolar world where the US and China are battling for global leadership. And for sure, data and AI, which is our investment thesis, maybe there's no surprise because data and AI yield power. And in the geopolitical context, it means industrial and military power. So that announcement did not necessarily come as a surprise. Clearly, in that context, the US has an incentive to slow down the advances in semiconductors in China, to also stall more advanced artificial intelligence. We can talk about the semiconductor sector maybe in a little bit more detail, because I think it's an interesting industry to showcase the geopolitical interdependencies that technology has created. And I think it's going to be a big factor if you think about the next few decades.
Well, where are we in the semi-cycle? On the one hand, some of the EV makers, notably Tesla and Polestar, are still having trouble getting enough chips. But in other parts of the semiconductor industries, I would point to DRAM, we're moving from shortage to glut very, very, very quickly. And in fact, companies, DRAM manufacturers, are talking about supply destruction. So it's a complicated picture, isn't it?
Yeah, it's really complicated. Like you said, there's lots of inventory built in certain parts, in memory. Obviously, we have seen the PC data that just came out again overnight. So there are certain parts that are oversupplied right now, and then there are still the golden screws, on the analog side, on the microcontroller side. So it'll take some time, to work out. But clearly, ultimately, when this cycle is over, all of these different components will be in a glut situation. That's how it always works.
I'm curious to know, Cathie, whether there are stocks you won't own now because of this growing China risk.
Well, we won't own Chinese stocks. In the flagship fund, we started pulling them out when Jack Ma was banished in November of 2020, after building up Chinese exposure quite significantly, because we liked the way China had responded both fiscally and monetarily to the COVID crisis. They had not gone crazy, but we've pulled out pretty much. I mean, there's anti-capitalist policy actions, and I think common prosperity suggests to us in China that any company, now in some of our more specialized funds, we do have very low gross margin companies. High gross margins are not compatible with common prosperity, as we're discerning, and we're looking for companies that that do fit this common prosperity theme. So, logistics, getting goods out to tier 3, tier 4 cities, electric vehicles, getting transportation, especially if they go autonomous. The cost for transportation will be much lower. So, but in terms of the semiconductor side of this, we've watched the league tables for years, and we were watching because of their surveillance economy. AI, they were making more breakthroughs, so we were watching the league tables. But I've been watching China since I was there in 1994, and one of their primary objectives was to become one of the leaders in global semiconductors. There's some DNA reason, I don't know what it is, why they're not there. The closest they've gotten is with AI. In terms of your question about semiconductors generally and our actions, the risk to innovation generally is regulatory and other action sanctions can slow innovation down. Why? We base all of our modeling, our top-down modeling, on something called Wright's Law, which is a relative of Moore's Law, but it's a function of units and unit growth. So if unit growth is going to slow down, then innovation is going to slow down. The other thing I'll say about bringing the industry back here, by some estimates, it'll take $1 trillion at a minimum. We know that Micron just announced a $100 billion plant in New York. That's over 20 years. So it's going to take a very long time to reorient this supply chain.
The X factor in the meantime, Ulrika, is Taiwan. What if China were to invade or simply put an economic blockade around Taiwan? Is that a COVID-like shock, or is that something worse?
Yes, as you said, Taiwan is the choke point in the semiconductor supply chain. Over 90% of leading-edge chips are being manufactured there, and they go into the most powerful processors, whether it's on the server side in the cloud, PCs, mobile devices, and are bought by companies like Apple, NVIDIA, AMD, Qualcomm, and others. So if something were to happen to Taiwan and its foundries so that they would be fully compromised, the economic impact would probably be pale in comparison to what we have seen with COVID, maybe actually look like a benign cold. We estimate, even though semiconductors are only 30 basis points of US GDP, they are critical to 34% of US gross output. So we estimate that the economic impact could exceed a negative 6% of GDP and also last for a longer period of time. I mean, the COVID crisis was very short-lived. So I think it's a real risk that, to Cathie's point, now countries realize that, companies realize that too. And the incentive here is to start to localize supply chains, and the CHIPS Act is obviously first step in that direction. But we'll see that over the next years, decades. It's going to take a long time. Ultimately, that's going to be successful. Countries are going to be more resilient. But I think the one thing that happens is that costs are going to go up. And so all these deflationary benefits that we have reaped over these decades of globalization will be reversed.
You're both big believers in the power of innovation and disruptive technology. While we still have a few minutes left here, I'd like to ask you both, irrespective of price, I mean, that's a fantasy land, right? But irrespective of price and irrespective of valuation, what excites you most right now? Cathie.
What excites us most is the convergence between and among technologies. That means that S-curves are going to be feeding S-curves, and we're going to see some explosive growth opportunities. You asked the question earlier about recession. Toward the end of a bear market and during recessions, our growth is far superior to that of the broad-based indices in terms of revenues and so forth. But some of the convergences, so genomics, so we have the intersection of DNA sequencing, RNA, protein sequencing, plus artificial intelligence, plus CRISPR. We're going to be curing disease. It's already happening, sickle cell disease, beta thalassemia, ATTR, and there are now attempts at diabetes as well, CRISPR therapeutics. Another thing is autonomous mobility. Zero in revenue today. We believe that will scale to 9 to 10 trillion in revenue by 2030. And that's the convergence of robotics. Autonomous vehicles are robots. Energy storage, they will be electric, and artificial intelligence. And in AI in particular, AI is the glue that's causing all of these convergences. Just in the last few weeks, we're seeing text to image and text to 3D. We've got Meta and Google, kind of putting papers out there and open sourcing this world. And the advancements are unbelievable, so that we're going to lower the barriers to entry in the whole gaming world. User-generated content is going to do that as well. But our lives are going to change completely. NFTs, even with blockchain, AI, NFTs, the creator community, our world is going to change in a way much more quickly than I think people now understand.
Ulrike, what are you most excited about?
Yeah, you're probably not going to be surprised. One word, data. So if there's one certainty, I think, in this economic environment, or maybe in life, is that the amount of data is going to grow. And we like to invest in the picks and shovels that translate that data into dollars. So data infrastructure, AI, and also semiconductors. And Cathie, you talked about these platforms, exciting new platforms like genomics, robotics, energy storage, I think you've talked about as well. And like you said, I think AI, data and AI are the foundational layer that are key to the success of all of these platforms. If you think about robotics, the brain of a robot uses sensor data and artificial intelligence to behave optimally. Then we have on the genomics side, that's actually the biggest of big data sets, 40 exabytes of data a year. We need to understand which genome sequences are responsible for diseases. And that's when we can start to think about gene editing. And then finally, energy storage. We need cheaper batteries, more performing, safer batteries. And again, data and AI can help us test different chemistries, their performance, and also see how energy is going to be distributed within a battery and in between battery packs. So for me, this is the most foundational layer to invest in that then drives innovation that you have laid out.
So if people want to get behind those ideas, what kind of time horizon should they be prepared to invest on? What kind of risk tolerance should they be prepared to have?
start.
No, you start.
I think our time horizon is 5 years, and in a risk-averse market, that's not most people's time horizon. However, we believe that most people are most investors, portfolios, asset allocators are truly short innovation unless they're highly involved with the private markets. Because we believe, and just to give some numbers, that innovation, truly disruptive innovation, will scale from 7 trillion in market cap today to 210 trillion by 2030, from less than 10% of the broad-based public equity market to more than 60%. And so if you're short innovation, you're going to be missing some of these unbelievable opportunities.
Ulrika, time horizon, risk tolerance?
Yeah, we have the same time horizon. We probably don't have quite the same risk tolerance, but we do try to be partners to our portfolio companies. We actually shared our bleak economic outlook with our portfolio companies early in the year to try to brace them for this environment. But they can only control so much, and that's their own execution. And I think it's on us as portfolio managers of an innovation portfolio to see how we can insulate that portfolio from macroeconomic conditions or changes in interest rates, which is really something the management teams can't control.
And for my last question, a fishing expedition. Cathie, do you want to see Elon Musk buy Twitter, or are you worried that if he does, it'll be way too much of a distraction for other companies you do care about, like Tesla, for example, and SpaceX?
I'm excited to see what he does and how he open sources the whole thing. I think he's going to change the model completely.
And the risks that people cite?
Well, we've watched him, how he's our Renaissance sounds man. You know, SpaceX, boring, Tesla, of course, and I think he's been able to not only multitask, but actually he's doing these things because he wants to protect us from ourselves in terms of the environment, and also wants to prevent censorship in the case of Twitter, and open source and take the bias out, and I love that.
Ulrika, do you have a view on Elon and Twitter?
Well, I think he has said that he is not going to decentralize the protocol, but that would be something really exciting to experiment. I think we need a new form of social media, and so who knows? I'm open-minded.
Do we think he's going to own it come October the 28th?
You know, I have no idea, actually. I have no idea. I just am excited at the possibilities. And the papers, the documents that were released as I guess they were preparing for court, suggest that he and Jack Dorsey do have open source in mind. And that would be very exciting.
Ladies and gentlemen, please join me in thanking Cathie Wood and Ulrika Hoffman-Bacardi.
Okay, now we're moving to the next session. We're going to welcome back Sonali for a conversation with the CEO of one of the world's largest providers of freight transportation services on the next big thing. Welcome back, Sonali and Brad Jacobs.
Thank you all for having us again. For those of you who don't know Brad, just a few facts about him that we'll talk about. He started 5 companies from scratch. He has started XPO with a $150 million investment, and it's now a global freight transportation logistics giant. He has made over 100 acquisitions throughout his career and raised $25 billion of capital. And the reason I bring all of this up is because we will certainly talk about what all that means in a very new economic environment. Brad, thank you so much for joining us. You know, the topic of this panel is the next big thing. What I promised you we would do is talk about your next big thing and then the next big thing in the economy. I think what's interesting is you're starting your next big thing at a time when a lot of people would be afraid to start a new venture. The economy is really rocky. How are you thinking about starting from scratch?
First of all, thank you for the opportunity to. It's the very best time to start a business is when things are bad and when valuations are low. You don't want to start a business up here. You want to start a business around here. You may not be able to time it to be right here, but somewhere around here you want to do that.
So some would say that, but the cost of capital is also rising. So if that's the case, then how do you start a business when financing becomes harder to come by? And as you've made the point to me before, you know, all tides are not rising anymore.
Cost of capital is definitely rising. You have equity values have compressed, so the cost is up. On the debt, when we spun off GXO, our warehouse business, a supply chain business, about a year ago, we got the debt done at about 1.5%. We're in the market now for the RXO spin-off debt. I'll consider a victory if we get 7 or 8% on that. And it's a great credit. It's a very low capex, high free cash flow conversion. So the cost of debt has gone up dramatically. Now, having said that, historically, I remember someone in your profile, Leon Black, saying what was on my board at United Rentals because Apollo made a big investment. And I remember Leon saying when high yield came down to 10%, he said, it's never going to go below 10%. We have to grab as much high yield as we possibly can. So in the long context of things, interest rates going back up is kind of where it was before they went down for that period of time.
Very simply, I mean, it's going to be more expensive for companies to finance their operations. That 8% that you're talking about, is that completely a function of higher interest rates driven by the Fed's rising interest rates? Or is this a function also of investor sentiment souring? If that's the case, if the latter is the case, then how do you convince investors to get on your side on something completely new and unproven?
Well, so there's two things. One is the RXO spin, which is far from unproven because it's got a long track record of generating tons and tons of free cash flow. It's a best in class. It's a great company. So I feel happy that we're part of the haves as opposed to have-nots. There's a lot of companies that the markets are closed for. In Europe, I mean, it's essentially closed for small companies. So I'm happy about that. In terms of my new thing, I'm not worried about raising capital. That's the last thing I'm worried about. What I'm concerned about is I got to find something that 5 years later, 7 years later, the revenue is much higher, the EBITDA is much higher, and during that period of time, we've generated a bunch of free cash flow, regardless of the economic cycle and how long this impending recession lasts. That's the main thing to focus on. If you run a business that's got good growth dynamics to it, and the financial model is solid, there's capital. I mean, look at this room. It's like $1 trillion of capital, trillions of dollars of capital just here.
So interesting, that optimism. It's funny because on one hand, you're starting something completely new. On the other hand, a lot of people are in this market. I wrote a newsletter just a couple of weeks ago saying that it's the grand possibility of new beginnings. People right now making the biggest changes of their career. So as you kind of look at the next phase of your career as you leave XPO, what are the industries, what are the sectors that you see most promise in to do something new in?
Well, so I've done this a few times before, and where I ended up was different than where I started. And I barely started the hunt because I'm still gainfully employed at XPO. So I got a few more weeks where I'm running that company. And I got to get the spin done, and a lot of things going on. But generally, I'm going to be looking at large businesses, large total addressable markets, so that even if there's a downturn, you're such a tiny percent of something so huge, you grab some share, you can still grow really fast. So I'm going to look at financial services, look at healthcare. And as we talked about before, I'm looking at, they're looking for me. A lot of inbounds have come from these SPACs that were $10 a share 9 months ago, and now are $1.82. And most of them belong at $1.82. But I'm not looking for a lot, just looking for one. So there could be some of those fallen SPACs where there's actually value, like a lot of value, but they're just in the wrong place at the wrong time, and there's no demand for them.
Well, is that a trading opportunity for you, or is that an investment opportunity where you can see the chance to take a prior investment vehicle and turn it into something new?
It's both. I don't think it's an either or. When you're building a company, timing matters because your IC and ROIC changes when you're getting in on the cycle. So I like getting in on the cycle here. And I think the opportunity to create a lot of alpha over a period of time is a lot easier when you're starting here. It's harder when you're starting here, well, much harder.
Well, to that end also, you're talking about SPACs. That's one example of kind of the market exuberance over the last year or so, let alone the last 10 years, if you will.
Yeah.
So, if you kind of look at the market all around you, at what point are things getting to the point that valuations are more realistic, that behavior is more realistic?
Well, valuations are certainly more realistic than they were even a few months ago because valuations have compressed. Have they gotten to, and a lot of the froth is out. You don't see a lot of these, the tech has come down, industrial's come down, consumer package, they've all come down. I mean, nothing's expanded, everything's contracted. So it's certainly more reasonable valuations. Could they get more reasonable over the next few months? They probably could, yes.
Reasonable, but can they overshoot as well? There's a lot of talk this week about Jamie Dimon's 20% drawdown prediction, 6 to 9 months of a recession. What do you think will happen next?
I think we're probably at the point, so when you get all the brilliant minds all agreeing that it's going to crash, that's usually what you see right before the capitulation. And then there is a crash, but it doesn't last a long time. Because then it overswings to the other. So there was this overvaluations for quite a long period of time. So now the pendulum has to swing. It's like physics. There's momentum for it to go back down, and it will overswing. And there'll be bargains out there. And you've got to be bold, and you've got to be courageous, and you've got to be decisive, and have conviction and make your move.
So to the extent that you see a sharp drawdown, what does it look like on the other end? Remember, we are still paying homage to the fact that we are going into a new economic paradigm with higher interest rates. How do you kind of map out the way out of a downturn?
I'm short-term a little nervous, a little pessimistic. I'm medium and long-term extremely bullish. And I say that because I have a little different echo chamber than here. My echo chamber is I'm talking to CEOs of large companies and chief supply chain officers of large companies and entrepreneurs of small businesses. And I'm talking with the 160,000 employees we have between GXO and RXO and XPO. And particularly here in the United States, the entrepreneurialism and the dynamism and the American dream, it is very much alive. And people are optimistic and they're thinking longer term. And there's so many people with so many great ideas, many more ideas than anyone can finance, that will create a lot of value. And as long as the government doesn't get too much in the way and overregulate and overtax, the entrepreneurial spirit in America is going to continue. And so I'm very optimistic. And I think short term is not going to be so nice. Long term is going to be very nice.
So in the short term then, what do the next 6 months look like? Do you think that if we experience a downturn, that it could rival the great financial crisis?
I don't know. But it could. I think it could. And the reason I say that is when you talk to investors, fear, it reminds me a little bit of summer 2007, when everything was great, and there was pick toggle, debt was basically free, and no covenants, that kind of stuff. It was like very frothy and crazy. And then suddenly everyone got scared. And then everybody got really scared. And I'm starting to feel that scaredness, that fright, becoming more intense and more pervasive, which is kind of what you see right before the final capitulation.
Well, it's interesting. You can say that free money causes irrational behavior, but so does fear in a lot of ways. What do you think in the next 6 months can be done to kind of save some mistakes in the investing community, in the entrepreneurial community, among the CEOs that you speak to?
Investing requires, and running a business requires, trying to be aware of your biases towards hope and fear, and trying to get out, trying to be aware that you're being too hopeful and too optimistic, and you're extrapolating from the present or the recent past that's going to continue to be really good, or the opposite, on the fear side. And then try to get in the middle zone, try to get in the center of that. So it's a psychological thing. Try to get divorced from the emotion of the whole thing.
So another part of this is also, you have a very interesting view of the economy from your perch at XPO, as you've been saying, not just from the CEO perspective, but from the employee perspective, as well as just a general supply chain perspective across all the companies you work with. So when you kind of look at the day-to-day operations here, how much concern is left when it comes to the supply chain, inflationary forces, and there's a huge CPI print folks are waiting for just this week. Do you think that there's still another shoe left to drop in terms of the economic pains ahead in the real economy?
Yeah, I do. Because we had a real good party there for a number of years, and now there's the hangover. You know, it has to be deep and it can't be nonchalant. It's the pendulum. It has to swing back and forth. This is life. That's the way it works. When I talk to a dock worker or a truck driver or a warehouse worker, inflation is killing them. Every 2 weeks they get their paycheck, and they're poorer after all their expenses than they were 2 weeks before. It's not sustainable. It's just simply not sustainable. Even with the significant wage increases that have taken place across the board. I'm not talking about even the middle class. I'm talking about the working class, people making 20 bucks an hour. That's not sustainable. When you have that large number of people who they can't pay their bills. They literally can't pay their bills. So there will be wage inflation. And there still will be price inflation because companies protect their margin, they pass it along. So it's a cycle that the Fed's going to have to deal with.
How do they get it under control while dealing with that other economic reality? You know, as the Fed tightens, so do economic conditions. But at the same time, you're painting a picture of a lot of Americans who are very strapped. So how do the two things start to correct itself over a longer period of time?
I think it's the same traditional way they always have. Economy overheats, quantitative tightening instead of easing, interest rates going up instead of go down, don't fight the Fed. And then the economy slows down and unemployment goes up. People come back to work again because we've lost so many people from the labor force. Right. So many people. I mean, so many people during COVID, they were making maybe 50, 60,000 bucks a year, and they downsized to like 30,000, 40,000. They did less vacation or a cheaper vacation. They did less travel, whatever. And they kind of like that lifestyle. And they've learned how to live more frugally, and they're not coming back to work. And there's a whole bunch of other people in the workforce that have just checked out. I mean, mentally, they've burnt out, and they're just not where they used to be. And they still want to work, because they have to work. I don't know if they want to work. They have to work, so they want to work less hours. So productivity is lower, as we all know, in the country. So there's challenges. There's absolutely challenges. But that makes opportunity, too. So you got to keep your eyes wide open, be very discerning, very selective, and not think that the same old tricks will work in this next phase that have worked in the more easy phase.
We'll ask more about labor in a second, but on the supply chain side of things, where are you seeing easing and where are you seeing problems that are maybe more sticky than we have the toolkit to deal with?
Supply chain has come unclogged a lot in the last 3-4 months. So air and ocean rates have come down dramatically, like 80%. It's big, big moves. Spot full truckload rates have come down 30, 35%. These are big moves. These are very, very. Contract rates not so much because people who were procuring capacity in the spot market have PTSD from the pandemic when they couldn't find a truck, and so they're locking in contracts. So there's kind of demand for the contract market. And of course, we play at XPO more in the less than truckload business, which has very consolidated carrier base. So there's actually firm pricing in that. So it depends what part of the supply chain we're talking about, but overall, air, ocean, rail, truck, it's gotten a lot, it's more fulsome. There's more capacity and the pricing is better. So the main thing holding back the economy now is not supply chain glitches, which was the case before.
So how do you view that issue kind of playing out in all of these concerns that many people have about globalization versus deglobalization?
Oh, globalization was big, as we all know, 5 years ago. Actually, for the last 30 years, we made China what it was. You know, we empowered China to be our biggest competitor and adversary. Well, we weren't thinking, we did that. But now, it's clearly, when you talk to customers, particularly the large manufacturers, we have a lot of OEMs or customers in the less than truckload business, big industrial franchise, they're lessening their dependence on China as fast as they can, going to Vietnam, going to Malaysia, going to Mexico, coming back to the United States in some ways. And they can't always afford that, but from a security point of view, people are taking that into consideration. So this globalization it's basically dead. The concept of globalization is off the table. Almost every company in the Fortune 500 is figuring out ways to be more deglobalized.
But I think that's interesting what you just said, because when you defined the changes in globalization, you still talked about work with a lot of other countries before you talked about work with the United States. To what extent do you think that there's a way for the U.S. to manufacture their way out of this, or do you think that there's real barriers to do things at home?
No, I think there'll be more onshoring here in the United States. I think there already is. I know even in our own company, we're looking at consolidating call centers, and we're evaluating. We have a big presence in India. The labor's so cheap there, and very bright workforce. But you know, when Russia-Ukraine thing came out, you know, India, which we thought would be a big democracy, would like side with the West, kind of sided with Russia, and not sided with, but was, you know, became a big customer of the oil that we were trying to embargo. So we're even thinking, well, what's the political risk in India, which we'd have never thought like a year ago. So I think every boardroom is absolutely focused on geopolitical risk, for sure, in almost every board meeting. And globalization is an enabler of risks. People are trying to de-risk that.
Political risk, if you think about the scale at which that's escalated over the last couple of years, last year really, given the war in Ukraine, how much more has it escalated in boardroom conversations, and how well equipped is a boardroom to deal with it?
It's top of mind. It's right up there with cyber, which is related. Every board meeting of every serious company has a presentation, every single board meeting about how we doing on cyber. Because cyber's a fatal risk. You can take lots of risks in business as long as you're aware of them and you know the size of them and you mitigate them and you cut your losses and address them. But you can't take bet the ranch kind of risks. And cyber is one of those. Cyber attack can actually take down a whole company. And when you talk to, when you go to Business Roundtable and Business Council and you talk to the government officials come in and present, they're all very worried about a cyber attack in a big way. Now, good news is America is actually pretty strong at cyber, so that's a good thing. But I don't know if we have the same dastardliness than some of the other countries to use it as aggressively as they are.
So if you kind of take a look around and, you know, all the things that have changed over the course of even running XPO, let alone 5 businesses in total, as you think about your next move and the next business that you want to run, you know, what are the tenets? What are the things that, you know, you've learned over the last 5 companies, things that have changed? We've talked about a few of them, including political risk to financing. What are the things that you have to take with you in your toolkit for the next business?
You have to have a way to grow a business. You can't create, I don't know how to create, so all the companies that I've run have been what we call 10-plus baggers. So I'm not a private equity firm trying to make 2 or 3x. I'm looking for 20x, 30x, I'm looking for hit it out of the park kind of stuff. And luckily, we've done that in every single one of the companies I started so far. So I'm looking for big ideas, ones that are very scalable. I don't know how to create immense shareholder value without immense change and transformation in companies, top line growth, margin expansion. So that's the key. How do we find things that we can either grow by M&A, which if done correctly can be very, very creative, or grow instead of by a roll up, a roll out. So by that what I mean is, like we did at United Rentals, we did a bunch of acquisitions and the media loved all that stuff, but where the real ROIC was on the greenfield cold start locations. We opened a few hundred de novo locations, and the invested capital was much, much less than when you bought a company. The risk was less, and it was all standardized. So something that can be rinse, wash, repeat, so to speak. We have a good template. We just keep opening all over the country or in Europe too or wherever. Or just good old-fashioned sales and marketing, something that there's a lot of demand for, and you can grow by price and volume. That's a little tougher because you're betting on you're predicting the trend, right, which sometimes is right, but isn't always right.
Well, also, how much more difficult is that kind of a formula in a world with higher interest rates as well as higher input costs? Do you have to accept lower margins given that the input is higher?
I don't know about lower margins, but your interest costs will be higher. I mean, I'm sure somebody has, but I haven't seen it yet. Someone should do a report on, take the S&P 500. How much of the debt of the S&P 500 is variable cost debt? Take out the fixed stuff, variable cost. And how much does each 1 point tax the country in terms of extra interest burden? I don't know the answer, but I know it's a big number. It's a very big number. And that's one of the things that is slowing down the growth of the country. But in terms of creating alpha, look, you can grow alpha when you have interest rates in the high single digits. It's not like it's Argentina here. It's a reason. It's still, but we were a little spoiled with very, very cheap debt. Okay, that's done. That's done at least for the foreseeable future. Maybe it'll come back actually in some number of years, but that's not going to happen in the next few years. That cleans. One healthy thing about this whole clean out is it cleans out. It cleans out the weaker players, cleans out the weaker competitors. It cleans out competitors in industries that were pricing irrationally just to get volume growth. So it's not all bad. A recession is like a big rainstorm. You know, it's not fun, but actually there's some benefit to rain. It encourages growth.
So, as everyone here already knows, my favorite question. You know, as you look ahead, start a new business, have started 5 before, as many others, as we had mentioned, are also starting a new time frame in their lives, new jobs, you know, navigating an economic environment they haven't seen before. What are the biggest mistakes? What are the biggest mistakes that you are seeing out there that you hope to avoid in your next role?
Look, I've made every mistake you can make on acquisitions, on people, on tech, on development. The good news is a percentage of mistakes of all the decisions we've made has been small, and there was no mistake that was life-threatening. So you have to make mistakes. Otherwise, you're not doing a lot of stuff. You're not going to create a huge amount of value unless you're doing a lot of stuff and being decisive and courageous. And you're going to get some stuff wrong. As long as you're honest with yourself, and recognize those mistakes early, soon after you've made them, and course correct with no ego. Just, okay, I messed up, let's fix that, let's get back on. And create a culture inside your company where you're not just saying everything's great, and you're actually focusing more on the things that are not great. The things that are not great give you the opportunities to create value. The things that you do. So going around and trying to find where is there waste in the process, where are the inefficiencies, where can Lean Six Sigma really go in there and optimize. That's how you create margin. That's how you create return on capital, which is what it's all about in the end.
Are we recommending Lean Six Sigma and analysis for more investors out there?
Lean Six Sigma is great. It's a great invention.
So final words on what your next act will be?
I don't know. It's going to make a lot of money, hopefully, but I don't know what it is yet.
Thank you so much for your time. What an interesting time to be interviewing you at.
Thank you
so
Sananda.
much.
Thank you very much.
Thank you.
At this point, it's sounding like the moderator is going to be all the way over here. Is that, or do you want them on the other side for your shot?
Okay, thank you. We're just getting the stage set for our next session, which is going to be the last one right before lunch. I loved Brad's analogy about a recession being like a rainstorm. It makes it feel healthy and positive. Okay, so we're going to welcome now, we're moving across the globe for a discussion on the risks and opportunities in Asia Pac today. Damien Sassower, who is Chief EM Fixed Income Strategist at Bloomberg Intelligence, is moderating this panel of leading experts from the region. Welcome, Damien and panel.
I can see it. Well, good morning. Thank you for joining us. Today's panel, we're going to focus a little bit on the Asia-Pac region. My name is Damien Sasser. I'm the Chief EM Fixed Income Strategist at Bloomberg Intelligence. Let me introduce our fellow panel members. Kaushik Rudra in the middle here from Standard Chartered. Sunil Singhania at the end, flew in all the way from Mumbai to speak with y'all. Jerry Wang, founder and CEO of Hi2, came all the way from Scarsdale, New York. And Dr. Yanan Wu of Meta. Hi. So thank you all for joining us here today. I think our time is limited, so let's kick things off. Asian central banks have trailed the rest of the emerging market complex as it relates to pumping the brakes on inflation, right? They started tightening with Brazil, Chile, the Czech Republic some months back, and now Asia is finally getting the message. Talk to us, Sunil, about Asian central banks, about the inflation dynamics in Asia. Why were they so long, why did they have the opportunity to wait, first of all? And then how far are they willing to go? How far do you think they're going to go? Please.
So obviously, coming first to India, and then I'll just touch upon Asia Pacific. I think inflation is universal right now. Every country has inflation. It's a combination of a lot of things. Obviously, the Russia-Ukraine issue has only added fuel to the fire as far as inflation is concerned. There were supply chain issues, particularly with closure of a lot of ports in China and so on and so forth. I think as far as India is concerned, we have been slightly fortunate because as a country we are self-sufficient, at least as far as food is concerned. And except oil, which we import 70% from, we are only 30% self-sufficient. Energy, generally, we are self-sufficient. So combination of coal as well as renewable energy. So inflation is there, but for the first time in so many years, seeing inflation lower than what we have seen in the developed world. Our view is that even overseas as well as in India, I think a combination of two things. One is the commodity inflation sort of looking like plateauing and coming down, and also a base effect should mean that by maybe April, May 2023, even inflation in US should be like 2.5%. And it's a simple mathematics. If you just extrapolate what is there in terms of today's prices and just hope that these prices continue till May, a base effect itself will lead to inflation coming down. And I think the same thing is happening in India. As a result of which the interest rate hike in India is again lower than what we have seen in countries like US. And particularly if you see the base, the percentage increase is much lower. So in US from 1% it has become 3%, which is a 200% hike. In India it's gone up from 6% to 7%, which is a 15% hike. So I think relatively, it's a little bit more measured, but we can only hope that stability comes back to the world, and by way of base effect, the inflation comes off.
Well, Dr. Wu, I wonder if you could expand on that. We just had the IMF this morning update their figures on inflation worldwide. I think they have inflation at 8.5% globally this year, falling to a shockingly low 6.5% next year, right? So someone finally got the message. Talk to us about not just India, the rest of the Asian region, those inflation dynamics.
Yes, thanks, Damien, for that interesting question. Let me just bring back what Cathie just in her wonderful panel about this big word, D word. And nobody wants to talk about D word, talk about I word, inflation. But what about deflation, right? So let me just echo what Pony just mentioned. I think my humble opinion, there will be a bifurcation of inflation versus deflation in developed world and developing market. So I would echo what Pony just said. I think in Asia Pacific is actually the growth phenomenon for the next 3 to 5 years. It's not inflation is not a big concern because I think the demand drives the growth. Here, I think I just back to Connecticut, last night. Within the last 2 weeks, I traveled from Philippines, India, Mumbai, and Indonesia, Mexico City. and then from to here, because we have surfing has, you know, business, global business in 8 countries. So it's last 2 weeks, I really witnessed, you know, how this bifurcation. You know, when I was in Mumbai, we participated in the Global FinTech Festival. Auto, right? The 3-wheel auto.
Yeah.
It's cashless society. You know, even auto drivers scan the UPI. Here, I pay my cab driver with cash, right? So I think this digitization, so once again echo what Cathie just made, digitization, fast forward, become a catalyst for Asia Pacific. So let me just bring back raise 3, if I paraphrase what's his message, 3 conflicts. One is the financial conflicts, the Fed conflicts. Second is the internal conflicts, domestic conflicts. And third is international conflict. But I think Asia Pacific is about 3 dividends. You have demographic dividend, you have the capital dividend, all the liquidity is going to there. And thirdly is the supply chain dividend. That's what you just mentioned. With supply chain, there will be infrastructure dividend, because India just announced $1.2 trillion US package. So for the infrastructure. So let me just echo your question. So I think what the economic forecast for the next year will be, personally, I don't trust any numbers because all these numbers just, you don't predict what's going to happen next year. Next year will be very gloomy because the war, I don't know when the war will end. And that will create inflation pressure. But then you have deflation pressure that Cathie just mentioned, because people don't consume regularly outside now. They consume online, right? So that kills that brings the deflation pressure. So this is the dilemma, I would personally think, yeah.
Well, I mean, I know you don't trust, you know, the numbers and the estimates of others, but you're sitting next to Kaushik, and Kaushik runs fixed income research for Standard Chartered. So we want to hear from you on the ground, boots on the ground in Singapore. We know what Steve Englander thinks. We know what Eric Robertson thinks. Tell us what's going on the ground in Asia, in Singapore, from an inflation perspective.
I think you sort of touching on the question that you asked at the outset, in sort of why did Asian central banks or Asia respond so late in the cycle in terms of the rate hike cycle? I think they can only respond to what they're seeing at that point. If you think about what was happening at the end of last year, there was no inflation. And then we get this Russia-Ukraine situation at the beginning of the year, all of a sudden commodity prices are off to the races. You have food prices which jump up significantly. Obviously, supply chain was a factor. I mean, that was an ongoing factor which at some point started easing off, and then of course we started seeing China again get into lockdown mode, which obviously resulted in supply chain coming back. So from having no inflation or very little inflation for most Asian central banks, all of a sudden you have 35-40% of their CPI basket explode.
Yeah.
And they have to respond. And so, you know, if I think they could sort of very comfortably sort of focus on the situation that they were in, and they felt we were very much in control. And all of a sudden they found themselves well behind the sort of, you know, the ball, and realized that they needed to catch up. And all of a sudden you have the US obviously hiking in an aggressive fashion, which meant the US dollar was sort of off to the races, which resulted in sort of second round impact of inflation coming back into Asia from the FX channel. You know, clearly I think there's been a real issue for Asia. But if you think about a lot of Asian central banks, they've been a lot more measured compared to what you would have expected. And the reasons for that, we sort of go into that in more detail later. But one of the things I would say is that when I think about Europe, I mean, our numbers basically suggest that 40% of the inflation is coming from demand conditions, and 60% is coming from supply factors. And obviously, supply has been a big factor because of the Russia-Ukraine situation. US is more measured, as was discussed earlier in this, you know, in this room. 50-50 is probably the right number for the US in terms of what's demand-driven and what's supply-driven. Asia, for most sort of countries, you would say something like 30-70. Or, you know, or even lower in some cases. Bank of Thailand is very clearly saying we will move very slowly because we don't really see our ability to sort of rein in inflation, which is all externally, exogenously coming to us with these rate hikes. So we will move, but we'll move very slowly, largely to ensure financial stability. So we can sort of talk about these things in more detail, but I'll stop there.
Well, I mean, look, I mean, you make a great point, Kaushik, in terms of this relentless dollar strength. And I mean, Jerry, I want to give you an opportunity to talk about the inflation dynamics in Asia, but I just can't help but ignore that relentless, that king dollar, what it's going to take to knock it off its pedestal. talk to us about the impact of inflation dynamics, how that's filtering out into currencies and into the dollar more specifically.
Oh, I mean, I'm pretty, actually, the Asian country has been really comfortable during the inflation environment. Part of the reason, as Sunil mentioned, they're self-sufficient. They produce the goods. And actually, India banned rice export, and Indonesia banned palm oil export during when they see the sign of inflation. They try to control the price, food price, and domestically. And that's why they're not moving really fast on the fiscal or monetary policies. And also, as Dr. Wu mentioned, growth in Asia is driven by innovation, by technology, besides all the demographic tailwinds. And inflation combining with growth actually is good for the Asian economies. And so you mentioned the dollar has been strong, and all the currency depreciation has been across the board. The rupiah, the rupee, the RMB, they're all down around 10 to 15% against the dollar in the past year or so. But we don't foresee another Asian financial crisis because the economy has been strong, and they all has strong currency reserves, and particularly the growth, domestic growth, and has been strong. So we're not very concerned. We continue to invest in Asia, particularly those large population, as I mentioned. And so, I mean, it will be continuing a big concern if US dollar continue to rise, but I'm not so concerned right now.
Well, I mean, Sunil, I wonder if you could expand on that. I mean, obviously, India is a little bit of a different animal. It's a little bit more of a managed currency, so to speak, the rupee I'm talking here. But, I wonder, are you feeling any impact, any residual impact of a stronger dollar in a country like India?
So, first of all, I think, we are in a very dynamic world where artificial control doesn't work. So yes, Indian rupee is not fully convertible, but it does get impacted by what is happening globally. I think the only thing which has changed vis-a-vis maybe in India of 10, 15 years back and today is the huge forex reserves we had. So, from like $30, $40 billion during Lehman crisis, is just 2008, we started this year with $600 billion. And to some extent, the central bank has used that huge currency pool to try and stabilize it. So rupee is also depreciated 8-9%. It is lower than the rest of the world, but it definitely has depreciated by 8-9%. And if you see the trend of rupee over the last 10-15 years, it moves in spurts. So you have 4 years of like a flattish kind of rupee, and then 1 year it just moves 10%, and then again it becomes flat. So I think the same trend is being followed. In terms of its impact, I think at the grassroots level, I don't think it has impacted too much, except some imported inflation. But it has got sort of countered by a sharp fall, like say commodity prices or crude prices, except the last week, crude prices have reacted quite significantly. And that is very important for India because that's the largest import product for India. It's almost like 30% of all imports of India are crude. At this point of time, India is not a very high export oriented economy, so it's not that it's benefiting us. At the same time, India has to be competitive, particularly with respect to the ASEAN countries and China, where the currencies have depreciated much more. So if we have a very strong rupee, then our exports will be like completely non-competitive. So it's a dilemma, and I think it's mostly got to do with dollar strengthening rather than rupee depreciating, because rupee against all other currencies is appreciated significantly, whether you take the British pound or the euro or even the Chinese yuan or the yen, But at the grassroots level, there has not been a major sort of impact of rupee being depreciated. Well, but there is generally, in the media and all, rupee at an all-time low and all. So, that sentimental impact it does create.
Right, like the psychological 7 handle on RMB, right? No, but Dr. Wu, what I really wanted to ask you is, you touched on FX reserves, Sunil. You touched on the fiscus. You touched on, the health of a country's sovereign balance sheet. And, with yields at historical lows for the better part of however long we can imagine, there has been no focus on that. Now the bond vigilantes are waking up, hence the UK, hence some of these other markets. We know that a lot of Asian economies were using their reserves, maybe not to intervene in the market directly, but certainly to subsidize this rise in commodity prices at the beginning of COVID. Talk to us about this impact of dollar strength. Talk to us about the health of the FX reserves, about what that means for some of these Asian currencies writ large.
Yeah, Ray mentioned this morning about the good currency and bad currency, right? So, so the way I take this is like this. Like Pony just mentioned, for GDP, you have the trio cards: investment, consumption, and export. So weaker currency for Asia Pac, for this rupee and the other currency, may be good for certain way, in certain time frame for good exports, as long as the consumption in Connecticut do not suddenly disappear. So I think I'm again emphasizing the supply chain dividend for this area. So once you have a good supply chain, China plus one, we have a secondary independent supply chain built up in Asia Pacific, then the export will pick up. So weaker currency within certain range is good for export. Once again, investment is there. I said, the Asia, the infrastructure is still very, has room of gap to grow. So investment will be there in this area, and consumption, once again, is the biggest consumption market in Asia Pacific. So all these factors, I would contribute the growth story in this area, investment, consumption, and export. But the only concern, and let me just echo your question, is I'm afraid is about the liquidity, about strong dollar. So what if U.S. dollar index goes to 120? Well, again, Ray doesn't ask us to look at that number very emphasized. But what if U.S. dollar, because Russia-Ukraine will go out of control next year, there's some nuclear issue coming up, so the sentiment of risk appetite will downgrade next year. The U.S. dollar index will for sure still picks up. And that will draw the liquidity out of emerging market. You are the emerging market strategy. So that reminds me of 1998, the Asian tsunami, financial tsunami in that. So that's the only concern about next year. If I want to mention about black swan, maybe that's the one thing about black swan, about the liquidity flowing into here rather than emerging market. So I think the dollar issue is good for the economy there, but the liquidity will be probably the killer for the economy in Southeast Asia and Asia Pacific. Yeah.
Well, Kaushik, I have to give you a chance to respond to that. Clearly, where you are at Standard Chartered and the insight you have to all of these different Asian economies, and further to that, Latin America, EMEA, developed markets, the impact of the dollar on these economies across the whole of the EM complex. What are your thoughts there? Are we on the verge of a black swan event or something of that nature, as Dr. Wu is pointing to?
I think obviously a lot is in the price right now in terms of where rates are headed, where the dollar, so what dollar is pricing in right now. But I think if we do believe that there is more upside to sort of the rate hike forecast and potential for inflation to stay very high for a long period of time, which will effectively mean that the Fed has to do more, the dollar stays bid for longer, I think we have a problem for EM, right? I mean, EM, local currency debt becomes uninvestable in this context of dollar strength. I think it can deal with a strong dollar as long as it's a stable dollar. But the minute dollar actually continues to sort of strengthen, EM local currency actually becomes very hard to invest in. And I think that's a big challenge for debt markets. And obviously, what we are seeing right now, this is creating financing issues for EM as well. And I think we've talked about that earlier, I think in one of the sessions. Clearly, that's going to be a challenge. I think particularly for the high yield segment of the market, that's next to impossible for them to issue debt at this level. If they actually, even if they were able to issue debt, I think investors would question why they're coming to the market at these sort of levels. So I think it becomes a real challenge for the high yield segment. IG paper obviously can access the market. So clearly a big challenge for EM. I think one thing I would say is that when I think about across the world, there are regions and countries which are better prepared to deal with this. And Latin America obviously has done a lot of work with rate hikes over the last 1 year, where they obviously are probably close to the end of the rate hiking cycle. Sort of, they may need to do more if the US does more, if there's inflation that's sort of more stubborn. But I think Latin America is in a much better place. Asia, as we started this whole conversation, Asia is sort of late to this whole game. But the good news for Asia, if I can say that, is Asia is not dependent on international money as much as other parts of EM, right? I mean, Asia has very rich and deep sources of funding within the region, whether you talk of pension funds, asset managers within the region, cross-border buying within the region, central bank involvement, which is, we can talk about that, but obviously that's been a very big part of some of the buying that has happened in Asia. That gives Asia a low beta status, relatively speaking, and allows these markets to trade with a slightly lower vol compared to rest of EM. But clearly, I think, if I think about preparedness and sort of, facing this tough mix, Latin America is in a better place from a local currency standpoint than Asia is right now.
Well, Jerry, let's tear up the script here. I mean, we've talked about rising rates and a stronger dollar and how that cocktail is not a good one for emerging markets. So let's create the bull case for emerging markets, if there even is one. What is going to draw a US dollar investor to reach into their pockets and invest in an emerging market economy today?
A couple reasons. One was Dr. Wu mentioned that the demographics, the young population, growing GDP, and also the technology adoption rate. In some emerging market, for example, like Kenya, they have higher mobile penetration rate than the US and China. So it's surprisingly. And I think those are all tailwinds and right now. But as you mentioned, the strong dollar and inflation, I think the biggest risk over there will be the sovereign debt. Look at those countries depending on imports, like Bangladesh and Pakistan. They're working with Paris Club and IMF and the Chinese policy banks and to working off the debt because the U.S. dollar is strong and their borrowing rates is going up and so I mean those are our biggest risks right now. But in terms of growth initiatives are still there. I mean, and I mentioned the roads, GDP growth are strongest in Asia and in India, in Indonesia, like Vietnam. Actually, they are leading the recovery from the pandemic. Also, the supply chain shift from China to Southeast Asia and South Asia. Like, I just bought an iPhone 14. Actually, it's made in India, not in China. So I think this is going to take over a decade to rebuild the global supply chain. But the trend is forming. So I think those are all opportunities and we're looking at, and that's where we're very confident. And some other traditional opportunities like NPLs and the previous panel mentioned. And a lot of people, investors made a lot of money in like South Korea and Chinese banks and Japan buyouts. But this round is not that obvious yet. But we're still betting on the strong GDP consumption and the production growth.
Well, Jerry, how many people do you think in this room have used M-Pesa in Nairobi outside of you and I? Sunil, Dr. Wu mentioned supply chains. You're in India. You know the impact of supply chains globally, how they've, we're hearing about reshoring. We're hearing about all this madness that's going on, substituting out of China, going to places like the Philippines, like to Indonesia, et cetera. Talk to us about that trend of globalization, about global trade. I mean, is it just taking a pause, or is this trend something that's going to last for some time?
So, I think, again, as Jerry mentioned, Apple phones, for example. I think globally, that trend is emerging. A combination of a lot of things, obviously geopolitical equations, what happened with Russia and Ukraine maybe opened the eyes of the world, and then you had this concern over China and Taiwan, and what would happen if we discussed in a panel of semiconductor, what will happen if semiconductors are not available. So I think to some extent crucial products would sort of go into again deglobalization. At the same time, when we interact with companies who have operations all over the world, I think there is a very conscious move to de-risk their sourcing. So if they were 100% sourcing from maybe China, they want to gradually move to Vietnam and the ASEAN countries and maybe to some extent even India. And I think the local governments in these countries realize that, and they've started incentivizing their domestic guys to be up there in terms of facilitating this production. So Apple, for example, has announced that 25% of all iPhone 14s manufactured in the world will be manufactured in India for the first time. and it will be like one of the global sourcing bases. And once the ecosystem develops, then it just grows on it, you know. So I think you will have some benefits of the global supply chain disruption in these countries. There will also be impact because, you know, obviously if you're not able to source products in a cost-effective manner, then you know your manufacturing is going to be impacted. So you can assemble iPhone, but if you don't get the chips and if you don't get the parts on time, then that benefit is not going to be possible. So I think it's going to be a little bit of a challenge. We have seen, you know, basic commodities like caustic soda. It's the basic of basic commodity which goes into almost everything we use on a day-to-day basis. The price has gone up from like $0.50 to $1, largely because shipping costs shot up so much, and it's such a cheap product that shipping cost as a percentage of the total cost of the product went up dramatically. So, you know, you have these kind of disruptions which are both headwinds. At the same time, there are opportunities, you know, because some industries would do really, really well, and that is what we have seen in India. Like, for example, you know, everything to make in Europe is now become expensive, particularly if it's energy intensive, because your energy costs are like 10-20x. And if you have energy available in your own country, you know, the cost of production combined with the cheap labor and educated pool of you know, resources, I think there can be a lot of benefits also. So near term, I don't know how this will play out, but medium to long term, at least, you know, economies which are forward looking, they will benefit from this supply chain disruption, or even the perception of supply chain disruption. So one is actual disruption. Second is you perceive that this might happen, and therefore you start to act in advance. You know, I think the second one is going to be more relevant.
Well, it's funny you mentioned the second one, because one financial instrument that captures the perception of geopolitical risk are sovereign credit default swap spreads, yeah? So Dr. Wu, I want to talk about that, because I just ran this morning the 55 sovereign CDS spreads globally, and not one has seen their spreads compress on the year. In fact, if you look at, and I'm not just talking emerging markets, by the way, Germany, the UK have risen fourfold. The cost to protect when moving money into these countries, the credit risk embedded in that has gone up fourfold in a place like the United Kingdom relative to that of the US. Talk to us about the geopolitical risk premium. Talk to us about, you know, the size of it. How do investors, or more importantly, how do operators and commercials really transact in that type of an environment?
Yeah. So my point is we have to embrace the new world, the new normal, post WTO globalization, post QE era. I think that's the two things we have to embrace probably in the next 5 to 10 years. The world is changing, I feel. So I think Suni just mentioned, you know, in the new world of globalization, I would call it regionalization or globalization. That's the word, the new fuzzy word, buzzword talking about. So we're seeing is rather than a WTO global treaty, you have a regional treaty, you know. So here NAFTA, right? And Asia will have different treaties as well. So I think regionalization was try to reduce the friction cost of this supply chain thing. So whether Asia Pacific can be itself become a closed loop of supply chain and the consumption, that's another story. Okay. So I think you're talking about the protection and the cost. So I think with the new regionalization, everyone, the risk appetite will be going down. Everyone seek for protection. So that's why credit swap as well, CDS going high. So, and we have to probably rationalize that. We're living in a different world. It's not printing money anymore. It's not QE anymore. You know, I didn't have a chance to ask really the question, who is going to pay for the recovery in the next decade? You know, US, Fed can print money and the emerging market can buy that debt. But now, since nobody probably want to, reluctant to buy the debt now. So who is paying for the recovery? That's my question, right? So I think, because we are an investment firm here in Greenwich, I think we have to rationalize the expectation of a return. The maybe risk premium is not rewarded as it was last decade. So the risk premium reward probably have to be rationalized in the next 5 to 10 years. We have to accept the lower return. We're talking about PE this morning. So I think the maturity of the investment spectrum will be longer, and the expectation will be lower. So I think that's mentality right now, I would say. But I think depend on new technology innovation, probably bring us a new globalization, I don't know, because that's what we hope for. But right now, without new technology innovation, we have to accept regionalization. Yeah.
Well, I share the same question as you do. Who is paying for it? Who is the incremental risk taker in emerging markets today? Kaushik? I mean, I know John Fell's listening, so let's go easy. But I mean, who is taking risk in Asia, in emerging markets? How are they doing it?
No, I think it's a difficult environment for investors right now. I mean, obviously, I don't think there are EM investors who are in the green, right? I mean, everybody is sort of in the same spot. There are obviously those who are doing slightly better than others, but I think we have to recognize this fact. I mean, besides everything, the macro headwinds that we all know and love now, I think we also have a QT program that is underway, right? And this QT balance sheet expansion that we saw from major central banks found its way into assets around the world, including into EM assets. So EM has been a big beneficiary of the largesse that we saw from various central banks around the world, largesse or whatever we may call it. But I think that definitely found its way into higher yielding assets around the world, and EM was a big beneficiary. And now when we see this getting pulled out, there has to be a byproduct. Where does it settle down? I mean, if it's getting pulled out of asset markets, we will probably see elevated levels of inflation for an extended period of time, probably gets into the real economy to some extent. But asset prices have to pay a price, and that's the challenge. I mean, I think we have to sort of combat that trade-off between what will happen on the inflation side and what we'll see in terms of real returns. And as you mentioned, I think real returns probably have to be much lower going forward. And we thought that should have been the case with such low interest rates around the world, but we actually got elevated returns during that phase. So I think something has to give, and that probably has to adjust in terms of lower returns to sort of squeeze it out of the system. Unfortunately, there are no winners here from an asset market standpoint.
If we knew the answer to that, we wouldn't be here right now. We'd be on a beach somewhere. Jerry, so I mean, from your perspective, same thing, right? I mean, this market is searching for a clearing price, yet the Fed is leaning against it, quantitative tightening. Clearly, we've heard all of we've experienced what liquidity bottlenecks can do here in the U.S. How do you see that impacting some of the Asian markets, the plumbing within, the Asia-Pac region? We saw total social financing data come out of China just the other day. It's fantastic. It was a huge number. How do you see some of those dynamics changing from your perspective?
I mean, there are going to be plenty, risk-seeking, return-seeking investors going to Asia. We mentioned NPL. I mean, the Chinese real estate developer, their bonds trading as like 20, 30 cents on the dollar. Distressed investors are going to pick them up. And also mentioned ESG, European investors going to go to Asia, invest in, financial inclusion and diversity programs. And there's another, wealth creation, money from out of China to Singapore. Those are going to be like $2 trillion in Asia, and some are going to come to the U.S., and some are going to stay locally, invest in local economies. I definitely see those are going to continue to support the Asian investment environment. Definitely liquidity is coming out and back to the U.S., but I see there's strong support from domestic, as I mentioned, Asian. Those are gonna be, more obvious in the next couple of years.
Yeah, I mean, Sunil, you're in India. I'm going to pick on them a little bit because the IMF has India growing at 6.1% next year, by far the highest in emerging and global markets, insofar as I could tell. Talk to us about the incremental risk taker in India. We know it's a relatively closed economy. We know there's a different playing field there. But we also know that India is opening up. We know that there's talk about Indian global bonds being added to many of the global fixed income indices worldwide. Talk to us about India. Talk to us about investors there. Is it a domestic-driven investor? Is it a foreign investor that's moving the needle? I'm curious.
So you're right. I think India turns out to be one of the more stable economies, and largely because it is 80% domestic.
Yeah.
Domestic demand driven, 1.3 billion people, and obviously aspiration of moving up the economic chain is very, very high. So very motivated population. And on top of it, what Dr. Yanan mentioned, the technology and the digital economy has actually made a lot of things very efficient. So we have more cell phones than maybe toilets. And everyone is connected on the cell phone. The farmers know the price of the produce. Transfer of money is seamless at the lowest cost ever. Our cell phone costs are like the average revenue per user for cell phone companies is $2. It's the cheapest anywhere in the world. Data is the cheapest. We migrated directly, without laptops straight into cell phones. So, more Indians use, internet on the cell phones and through the laptops. So I think that has made it very, very efficient. In terms of the economy, we are $3 trillion economy, growing at 6-7% real, almost 10% nominal. And actually, if you see the last 10 years, emerging markets is a very well-known term, and emerging market funds are also very large. But emerging markets as a whole has given zero return last 10 years in dollar terms, zero. And India has doubled in dollar terms over the last 10 years. So I think a lot of times, in the whole noise of being classified as one of the countries in emerging market, the strengths of the economy sort of gets negated. We had Ray Dalio speak about China in the morning, and he had 4 or 5 issues which he felt were headwinds. Actually, if you see each of those issues, India has tailwinds. So leadership and democracy. I think no one can dispute in this world that democracy is a big plus. And we have seen what economies which don't have democracies suffer. Demographics, 65% of the population is below 35 years of age. Nowhere in the world, maybe Indonesia has that kind of demographics, but no other country has it. Domestic economy, so we are not as dependent on exports as maybe some of the other Asian countries is, because we have this huge pool of domestic thing. And now domestic capital is also available. So last 1 year, from October 21 to July 22, we had the highest net sales by foreign investors in Indian equities, but entirely got absorbed by domestic investors. And we'll be surprised that year to date, India turns out as one market which is flat. It's not made money, but it's not lost money. And we're talking about 22, and it comes after very, very great 20 and 21 years. So I think the foreign investors is interested in India in varied ways. We look only on the public markets, but private equity is thriving. A venture fund is thriving. Yeah. I think a lot of bond investors are looking at India. Obviously, we don't have complete convertibility, so that might be a little bit of a resistance from the likes of JP Morgan to include them in their global bond fund. But I think things are working well. And as we move forward, even during COVID, if the country is growing at 6-7%, I think there's a lot of opportunity. And last but not the least, we have a forceful leadership now. And I think one good thing about Prime Minister Modi, for some challenges he might have, is the fact that he's recognized as a global leader. He's built friendship across the world, and we have seen even in this crisis, it's been a very delicate balance for India, because Russia or the erstwhile USSR is a long-standing friend. At the same time, we have Australia and Japan and US, which are the new friends in the Quad sort of a thing. And I think they have been able to maneuver well. So I think things are pretty decent. I might be biased being based there and being investing there, but the figures say for themselves.
Yeah. Well, look, we've made it nearly 40 minutes on an Asian Pacific panel, and we haven't mentioned China once. So, Dr. Wu, talk to us about COVID zero. Talk to us about common prosperity, the crackdown on big tech. Talk to us about the property sector. How should investors approach China today?
You give me the hard potato.
Yeah.
I still want to go back to China too. I don't want to lose a visa. I'm a little bit complicated. I'm a Canadian citizen, born raised in China, and actually got my postdoc research in New Mexico, Los Alamos National Lab in nuclear physics, and then now work in Singapore. I set up my venture in Singapore. So I'm a multi-personality, if you will. So back to your question. So I think Suni talked about India example. So we have 2 different models. So I think we'll see how this will eventually play out. I think Cathie and also Ray talk about China issues. So I think China right now is in this so-called middle growth trap. You know, used to be Latin America was the developed economy doing very well, but once their average GDP passed $10,000 US, it becomes a trap for the nation can really convert from a development nation to a developed nation. So I think the big dispute right now is the common prosperity. I think it's hard for the West to understand as well, and it's hard for me to understand as well. But anything, I think, anyways, is want to medium the gap between the rich and poor, because the structural problem right now in China also is something I have to deal with. So I think that's probably the policy, the mentality behind the policy. But other than that, I think if you look at Asia Pacific, that's why I agree with Cathie just mentioned. Asia Pacific is about a quarter or a third of the whole population, the world's population. So internally, capital is sufficient. There's liquidity is sufficient. That's why I'm not that worried about Asia Pacific liquidity like 1998. In 1998, George Soros made that big bet against those currencies, but may not repeat again because there's enough liquidity in India, reserve in China and the other areas. So internal liquidity may be sufficient, and also consumption market is sufficient, and the infrastructure supply chain will multi-located. So I think so my point is that we probably have a good opportunity to see how they can cooperate each other in this area. So I think this is Surfing has an investment in 8 countries in 3 continents. So you talk about infrastructure, Jerry talk about roads. Here the many family office and PE funds here. Let me advocate one thing: invest in digital infrastructure in Asia Pacific. That will change the whole area, because rather than road infrastructure, digital infrastructure will change fundamentally of this area. And I think you will get rewarded by that long-term investment. So let me just echo that question from now.
Well, Kaushik, similar question to you. We have Party Congress coming up. Can we expect maybe a loosening of the COVID-0 policy around that? Is that a possibility, maybe?
Yeah. Well, then I have to pick up the phone to talk to Mr. Xi. But I think probably early, my personal humble opinion, early spring, because they will finish. We're talking about October Congress, this weekend. So I think the government will try to relax. You look at Hong Kong, right? It's relax a little bit. So, but then they have to back and forth. So it won't be that one overnight shift. But I think early spring, China has to embrace the whole, open up the whole world. That's my suggestion.
Kaushik, same
question.
question.
I pretty echo that. I think our original expectation was that after the Party Congress, we'll see some relaxation. But with the winter coming up, and I think there is still some question marks on, so particularly the vaccinations among the elderly. And I think they will probably be a little bit more careful in how they open it up. So perhaps when we get to March, and by then you'll have the sort of transition in terms of new appointees, etc. After the Party Congress. So sort of handover will happen by then. And I think that probably will be the right time to sort of open it up, in a slightly more meaningful way. I think they need to open it up so that the economy. I think particularly the retail sector, the consumer sector, services sector. These are sectors that haven't really done very well in the last year or so, and I think that will really where the boost for China will come from. So we hope that happens, and then that gives a little bit of a lift to the Chinese growth outlook.
And Jerry, I guess we're getting short on time here. Final question. What do you think the market's reaction to that's going to be? Is it going to be, okay, this is great, the world is changing, we're back, supply chain bottlenecks are going to be alleviated, China's growing at 4, 5, 6, 7% again. I mean, is that reasonable? Is that sensible in this environment? How do you see the relaxation of COVID restrictions impacting financial market prices?
It's really hard to say because this is more like a top-down decision. It's up to just one man. And we're all guessing, what's happening during the winter, what's happening in the spring, and we're hoping for the best. But in terms of policy or tones, I haven't seen any changes yet. In this, because China put it this way, it's not about economy; it's more like political decision. So I don't really, I'm not very optimistic. Just gonna have a big change. So that's we're preparing for the worst, shifting the supply chain and moving out of China. One big trend we're investing actually is going overseas, and so we're betting on the Chinese entrepreneurs that bring their technology, bring their expertise to Southeast Asia, to Singapore, to Canada, to the US, and they're creating a new ecosystem outside of China. Actually, it's all Chinese money, Chinese entrepreneurs, Chinese technology, and but they're building, we call it shallow tech. It's not anything deep. It's like mobile payments, and it's e-commerce, digital supply chain. What they've been doing, helping Ant Financial, they're building in China. They're copying that to the other emerging market. That's the trend that we're betting on. So we're not going back to China anytime soon, not when everything's so clear.
Well, thank you. And thank you to all our guests. Thank you so much for joining us here today. Thank you to GF for having us.
Okay, thanks everyone. You can all stay where you are if you like. The lunch will be plated, so they're going to bring it to your tables, and we'll let you talk for about half an hour, and then we'll resume with the keynote speaker. Thank you.
Ensuring a bright, bold future means investing in tomorrow, today. And Apollo is at the forefront. Our capital is helping to solve some of the world's most complex problems by securing retirement for millions of families, building and financing stronger businesses, and driving a more sustainable future for our communities. Bridging our economic present to our future. Empowering people to retire better, from teachers to firefighters and other essential workers, Apollo is creating retirement solutions for millions of families. We're investing across sectors and geographies to create jobs and support local communities, and partnering with businesses large and small to fund their growth and enable transformation. As we look to new generations, we are committed to making progress and to developing a more sustainable future as a leading capital provider accelerating the energy transition. From development to production, all the way through to consumption. Building a better future also means expanding opportunity across our ecosystem. It means deepening our relationships, broadening our network, and developing new connections every step of the way to better serve our investors and our communities. Through it all, consistently challenging convention, sparking new ideas, and fueling innovation. At Apollo, we are investing in tomorrow, today.
Companies of all sizes rely on us for world-class, less-than-truckload freight transportation. We handle our customers' freight as if it were our own, moving it across North America on a coast-to-coast network that covers 99% of all U.S. zip codes. When freight is put in our hands, it gets where it needs to go, safely and on time. Our customers are growing, and we are too, expanding our footprint and fleet, and certifying more truck drivers at over 130 XPO driver training schools. And we're constantly enhancing our technology, creating new network efficiencies to ensure a world-class LTL shipping experience from pickup to delivery. With industry know-how, local knowledge, and the hunger to keep improving results, when you ship with XPO, you'll find that our people are committed to your success. XPO, your freight first.
Over 250 million young people are not in education, employment, or training. But how you start in life shouldn't determine what you do in the future. In the last 3 years, Future Makers by Standard Chartered has supported more than 650,000 talented young people from low-income communities, transforming lives by empowering them to learn, earn, and grow. Because where others see problems, we see potential. We're Standard Chartered, and we're here for good.
What if you could invest in private equity, real estate, private credit, even art, with clarity, confidence, and help when you need it? Meet Yield Street, the leading platform for private market investing. We believe that private market alternatives like real estate, private credit, and art should be a fundamental part of your portfolio. In fact, investment professionals recommend allocating at least 20% of your portfolio to alternatives. So how can alts create a more efficient portfolio? Versus traditional investments, alts reduce risk while maintaining your expected returns, or maintain your risk level while potentially improving your expected returns. We talked to actor and former White House staffer Cal Penn to help explain private markets.
If you're watching this video, it means you've been wondering, what are alternative investments? And why are all your savvy investor friends talking about them? Or maybe that's going to be you right after this video. So, alternative investments are basically anything beyond the stock and bond markets. You're probably most familiar with real estate. I know I love places. A beautiful resort. Or maybe just an office far away from your perfectly behaved children. There's also private equity, venture capital, and a few more that aren't as mainstream, like art and crypto. Basically, lots of cool things to discover. When you put alts in your portfolio, you're helping to ensure that you have investments that don't always follow the ups and downs of the stock market. Yup. Here we go again. That, my friends, is called diversification. In addition, people like alternatives because they can generally outperform the stock market. So, how can you get started? Before Yield Street, you probably would have had to pony up $1 million and tie it up in a single investment. Yikes. But now, the potential of private markets is at your fingertips.
Thanks, Cal. With $3 billion invested on the platform and almost $2 billion in principal and returns paid to investors, and 9.6 realized net annualized returns, isn't it time to diversify away from the stock market? Invest in curated private market alternatives from top managers, all on one easy-to-use platform. Evolve your wealth. Yield Street, private market investing.
MFA exists to serve and represent the private fund industry, and we do this through advocacy and convening members to address key business and operational issues.
So the MFA is a phenomenal partner of resources and peer groups and forums that comes together.
And this ability to bring people together is just so important because it just makes me better, makes my team better.
What the MFA does is the MFA sits firmly in the middle and is ensuring that as they take the inputs from the regulators, take the inputs from the policymakers, and then take the inputs from the manager, that feedback loop that they're bringing is going both ways.
If we have a growing and active membership that provides MFA in the industry with more resources, more credibility to better advocate for those policy outcomes that support the industry's growth.
So when you join it, you're not joining an association, you're joining a group of peers that have common interests and really want to help you succeed.
There's no downside. It is truly all upside when you become a member of the MFA.
Surfing with waves of digital financial technologies. With the rapid development of digitalization and globalization of financial markets, Surfin has always been driven by digital technologies to invest globally. Surfin Group specializes on two major areas: digital finance and technology empowerment. Since 2017, Surfin Group has invested across 3 continents, which are Asia, Latin America, and Africa, with 20 million users in 8 countries and a total transaction volume of over $2 billion. Surfin invests digitally. Surfin Group focuses on digital investing to empower financial services and asset management globally. Surfin Group processes and develops tens of terabytes of data, hundreds of big data models, millions of feature vectors, millions of effective product models, and asset allocation portfolios. Surfin has global risk management experience. Surfin Group delivers risk management expertise in global asset allocation and investment. The investment and technology can be efficiently married by individually matching of dynamic asset allocation portfolio based on big data and personalized efficient frontiers, integrated with multi-asset classes, multi-trading frequencies, and multi-strategies through risk parity allocation. Personalized and diversified portfolios can be constructed to provide scalable asset allocations and across various market cycles. Surfin Group also develops a fully functional and convenient digital integrated wealth management platform across borders and different markets, which can provide middle-class customers with digital smart financial services, including news and information, user forums, investor education, investment advisory, and financial planning services to enhance global investment experiences. Surfin Group develops 4 proprietary core technology systems that enables real-time online accessing, multi-ethnic group matching, and global multi-country servicing. Intelligent Risk Appetite System, EKYC System, Big Data Behavior Analytics System, AI Smart Voice System. Surfin Group looks forward to seeking mutual benefit and win-win cooperation with various partners to develop an ecosystem to invest in emerging markets. Surfin Group has always been persevered, persistent, and passionate. Surfin shall stay focused and strive to serve more global investors with digital technologies and making life better with smart, open finance.
Ensuring a bright, bold future means investing in tomorrow, today. And Apollo is at the forefront. Our capital is helping to solve some of the world's most complex problems by securing retirement for millions of families, building and financing stronger businesses, and driving a more sustainable future for our communities. Bridging our economic present to our future. Empowering people to retire better, from teachers to firefighters and other essential workers, Apollo is creating retirement solutions for millions of families. We're investing across sectors and geographies to create jobs and support local communities, and partnering with businesses large and small to fund their growth and enable transformation. As we look to new generations, we are committed to making progress and to developing a more sustainable future as a leading capital provider accelerating the energy transition, from development to production, all the way through to consumption. Building a better future also means expanding opportunity across our ecosystem. It means deepening our relationships, broadening our network, and developing new connections every step of the way to better serve our investors and our communities. Through it all, consistently challenging convention, sparking new ideas, and fueling innovation. At Apollo, we are investing in tomorrow, today.
Companies of all sizes rely on us for world-class, less-than-truckload freight transportation. We handle our customers' freight as if it were our own, moving it across North America on a coast-to-coast network that covers 99% of all U.S. zip codes. When freight is put in our hands, it gets where it needs to go, safely and on time. Our customers are growing, and we are too, expanding our footprint and fleet and certifying more truck drivers at over 130 XPO driver training schools. And we're constantly enhancing our technology, creating new network efficiencies to ensure a world-class LTL shipping experience from pickup to delivery. With industry know-how, local knowledge, and the hunger to keep improving results, when you ship with XPO, you'll find that our people are committed to your success. XPO, your freight first.
Over 250 million young people are not in education, employment, or training. But how you start in life shouldn't determine what you do in the future. In the last 3 years, Future Makers by Standard Chartered has supported more than 650,000 talented young people from low-income communities, transforming lives by empowering them to learn, earn, and grow. Because where others see problems, we see potential. We're Standard Chartered, and we're here for good.
What if you could invest in private equity, real estate, private credit, even art, with clarity, confidence, and help when you need it? Meet YieldStreet, the leading platform for private market investing. We believe that private market alternatives like real estate, private credit, and art should be a fundamental part of your portfolio. In fact, investment professionals recommend allocating at least 20% of your portfolio to alternatives. So, how can alts create a more efficient portfolio? Versus traditional investments, alts reduce risk while maintaining your expected returns, or maintain your risk level while potentially improving your expected returns. We talked to actor and former White House staffer Kal Penn to help explain private markets.
If you're watching this video, it means you've been wondering, what are alternative investments? And why are all your savvy investor friends talking about them? Or maybe that's going to be you right after this video. So, alternative investments are basically anything beyond the stock and bond markets. You're probably most familiar with real estate. I know I love places. A beautiful resort. Or maybe just an office far away from your perfectly behaved children. There's also private equity, venture capital, and a few more that aren't as mainstream, like art and crypto. Basically, lots of cool things to discover. When you put alts in your portfolio, you're helping to ensure that you have investments that don't always follow the ups and downs of the stock market. Yup. Here we go again. That, my friends, is called diversification. In addition, people like alternatives because they can generally outperform the stock market. So, how can you get started? Before YieldStreet, you probably would have had to pony up $1 million and tie it up in a single investment. Yikes. But now, the potential of private markets is at your fingertips.
Thanks, Cal. With $3 billion invested on the platform and almost $2 billion in principal and returns paid to investors, and 9.6 realized net annualized returns, isn't it time to diversify away from the stock market? Invest in curated private market alternatives from top managers, all on one easy-to-use platform. Evolve your wealth. Yield Street, private market investing.
MFA exists to serve and represent the private fund industry, and we do this through advocacy and convening our members to address key business and operational issues.
So the MFA is a phenomenal partner of resources and peer groups and forums that comes together.
And this ability to bring people together is just so important because it just makes me better, makes my team better.
What the MFA does is the MFA sits firmly on the and is ensuring that as they take the inputs from the regulators, take the inputs from the policymakers, and then take the inputs from the manager, that feedback loop that they're doing is going both ways.
If we have a growing and active membership that provides MFA in the industry with more resources, more credibility to better advocate for those policy outcomes that support the industry's growth.
So when you join, you're not joining an association, you're joining a group of peers that have common interests and really want to help you succeed.
There's no downside. It is truly all upside when you become a member.
Surfing with waves of digital financial technologies. With the rapid development of digitalization and globalization of financial markets, Surfing has always been driven by digital technologies to invest globally. Surfing Group specializes on two major areas: digital finance and technology empowerment. Since 2017, Surfing Group has invested across 3 continents, which are Asia, Latin America, and Africa. With 20 million users in 8 countries and a total transaction volume of over $2 billion, Surfing invests digitally. Surfing Group focuses on digital investing to empower financial services and asset management globally. Surfing Group processes and develops tens of terabytes of data, hundreds of big data models, millions of feature vectors, millions of effective product models, and asset allocation portfolios. Surfing has global risk management experience. Surfing Group delivers risk management expertise in global asset allocation and investment. The investment and technology can be efficiently married by individually matching of dynamic asset allocation portfolio based on big data and personalized efficient frontiers, integrated with multi-asset classes, multi-trading frequencies, and multi-strategies through risk parity allocation. Personalized and diversified portfolios can be constructed to provide scalable asset allocations and across various market cycles. Surfing Group also develops a fully functional and convenient digital integrated wealth management platform across borders and different markets, which can provide middle-class customers with digital smart financial services, including news and information, user forums, investor education, investment advisory, and financial planning services to enhance global investment experiences. Surfing Group develops 4 proprietary core technology systems that enables real-time online accessing, multi-ethnic group matching, and global multi-country servicing. Intelligent Risk Appetite System, EKYC System, Big Data Behavior Analytics System, AI Smart Voice System. Surfing Group looks forward to seeking mutual benefit and win-win cooperation with various partners to develop an ecosystem to invest in emerging markets. Surfing Group has always been persevered, persistent, and passionate. Surfing shall stay focused and strive to serve more global investors with digital technologies and making life better with smart, open finance.
Ensuring a bright, bold future means investing in tomorrow, today. And Apollo is at the forefront. Our capital is helping to solve some of the world's most complex problems by securing retirement for millions of families, building and financing stronger businesses, and driving a more sustainable future for our communities. Bridging our economic present to our future. Empowering people to retire better, from teachers to firefighters and other essential workers, Apollo is creating retirement solutions for millions of families. We're investing across sectors and geographies to create jobs and support local communities, and partnering with businesses large and small to fund their growth and enable transformation. As we look to new generations, we are committed to making progress into developing a more sustainable future as a leading capital provider accelerating the energy transition, from development to production, all the way through to consumption. Building a better future also means expanding opportunity across our ecosystem. It means deepening our relationships, broadening our network, and developing new connections every step of the way to better serve our investors and our communities. Through it all, consistently challenging convention, sparking new ideas, and fueling innovation. At Apollo, we are investing in tomorrow, today.
Companies of all sizes rely on us for world-class, less-than-truckload freight transportation. We handle our customers' freight as if it were our own, moving it across North America on a coast-to-coast network that covers 99% of all U.S. zip codes. When freight is put in our hands, it gets where it needs to go, safely and on time. Our customers are growing, and we are too, expanding our footprint and fleet, and certifying more truck drivers at over 130 XPO driver training schools. And we're constantly enhancing our technology, creating new network efficiencies to ensure a world-class LTL shipping experience from pickup to delivery. With industry know-how, local knowledge, and the hunger to keep improving results, when you ship with XPO, you'll find that our people are committed to your success.
Good afternoon, everyone. Hello. Thank you for settling down. We're going to start the program now for our lunch. Can I have everyone's attention? I'm sorry to interrupt. I know you're all having such wonderful conversations. I'm sorry to put a pause to it, but we do have to move on with the program. Before we start the panel session, I wanted to mention we have a really cool exhibit outside. I don't know how many of you have had the chance to walk outside and see it. We have Jeff Taylor with us here, who's the founder of Rover Trophy. I'm not even a car person, and I thought this was super cool. It's all these Range Rovers outside that have been like, Defenders, sorry. Welcome, Jeff, everyone. So it's just a really cool exhibit out there. Jeff's the founder of Monster.com. He spent a lot of time at Bridgewater working for Ray Dalio, so I'm sure he's got interesting cocktail conversation as well. So. I'd love to host you outside. Come visit, please. Thank you, Jeff. Okay, so we're gonna shift the topic now to something a bit more somber on addressing the worsening international hunger crisis exacerbated by Putin's war in the Ukraine. I'll let Tom do the introduction of our keynote speaker, but Tom Scott is moderating. I can't think of anyone else who's better prepared to lead this conversation. He's been working to change the world for many years through a variety of different tactics, but most recently, for the last 10 years, founded the Nantucket Project. If any of you haven't been to that conference, I went for the first time this year out in Nantucket a few weeks ago, and it's fantastic. So welcome, Tom. Oh, sorry.
Hi, everybody. Naven, can you come out now? Is that okay? Welcome, Naven Salem. I'll give an introduction that is very straightforward, which is I feel like I've had to do a lot of research to prepare for this, and the bottom line is there's an issue in the world that I think if we pause in our hearts, everyone in this room can identify with, and there's a solution for it right now, and that's what she does. So this is Naven Salem, and come on in, let's sit. Thanks for being here.
We have a little video.
Oh, there's a video. I'm sorry. Okay, so ignore us for a moment, and we're going to run a video.
Russia's invasion of Ukraine is deepening the global food crisis.
Extreme weather, supply chain disruption,
an apocalyptic global food shortage.
I feel like the world is on fire right now. Conflict, wars, climate change, the inability to grow crops. When you put those things together, you are for sure going to have a crisis of malnutrition.
I know what it means to be waiting for humanitarian aid. I experienced hunger. I've felt the pain, and I've seen children die.
$3 million children every single year will die from malnutrition, and 100% of those deaths are preventable. I know, you don't feel good today. "24 hours a day, we are making these fortified peanut butters that are used to treat all the different phases of malnutrition. It's like food by prescription. You're able to completely transform a child in just 8 weeks. The Odysseia community is full of former refugees from 26 countries. The majority of our team has lived through a crisis like this.
We have the logistics and manpower to get the shipment all the way to destination. We can directly relate. I have seen kids come from skin and bones to happy children that are gaining weight. They're talking, they're singing, they're dancing. I never thought I was going to be able to make an impact at the scope at which we've done today.
when you see the transformation in such a short time, that just fills your soul with hope. We can end malnutrition. That's what motivates us every single day.
So I want to hear more about how you got into this, but before we do that, right now, what's the number? What's the number of people who are dealing with malnutrition as a moment-to-moment problem? Children in particular.
Yeah, so we make products that deal with all the different stages of malnutrition. So you look at the most severe cases, there's 13.5 million children right now who are severely malnourished. And what that means is if we were to measure their arms, this part of their arm is the size of a quarter. And so we are trying to, these products that we make, gets out to here and then all the way out to here in 8 weeks. So we're trying to make this transformation in those 13.5 million children around the world. So they're in hospitals. They are struggling to keep their hearts beating, to breathe, and using all the energy that they have to keep their hearts beating. And so that's the stage of children that we're dealing with the product that we make called Plumpy Nut.
Tell us about this. You showed this as an example. Where do you distribute these and what do they do?
Yeah, so this food is very tightly controlled through healthcare systems. So nurses are working all across. So we're shipping these products to the Middle East, to Syria, Afghanistan, Yemen, across sub-Saharan Africa, and through Latin America as well. And so these nurses and healthcare workers are using this to measure, and so it's color coordinated. So we have products that are red, orange, yellow, and green, and they're all coordinated with that simple little tape that healthcare workers and even mothers, we're training mothers as well, to be able to measure their children and know when they need to come into the hospital. And so we're trying to reach them as soon as possible so they don't get to the red. We do not want children to be in the red. But at this moment, that's what we're dealing with, because what we were talking about in the video with this war in Ukraine has really elevated the situation way above where it was before. So we had climate change. It's been around for a while, right? But we have droughts going on for 4 years in East Africa. And we have conflict going on in 45 countries. It's not just Ukraine. 45 countries are dealing with conflicts right now. And so when you put those two together, then you're going to find children who have malnutrition. But I'm really not trying to ruin everybody's lunch by talking about such a serious topic. The exciting part about all of this is that we have a solution that works. We have every tool that we need to make this actually work and get better.
Okay, so let's go back though. You sort of discovered this unexpectedly. Is that a fair way of describing it? On a trip you took? Can you tell us about that?
Yeah, so my father, my grandparents, and great-grandparents are all from Tanzania. And one day I had 4 children under the age of 5. And my family accused me of going to extremes to get sleep. And I went to Tanzania to do some research and figure out, what is not being done in the world. And so I learned a lot about HIV, malaria, TB, clean water. But there were lots of people who were doing something about those important issues. And when I learned about malnutrition, it struck me that no one was really talking about this, and no one was really doing anything about it at scale. And I was seeing children that at age 2 were the same weight as a newborn here in the United States. Same. 8 pounds, you would think, is a newborn weight, and there where I was traveling was a 2-year-old. And so to be sitting there face to face with a problem that is something that we can solve. Children, no matter where they're born, need food and nutrition. And so there was no research that needed to be done. We knew what needed to be done. This product existed. So I saw Plumpy Nut in Tanzania on that trip, And then when I got back to Rhode Island, I saw Anderson Cooper on 60 Minutes talking about Plumpy Nut. I was like, well, this is very strange to see this product twice in the same week. And so it was that story on 60 Minutes that inspired me to, take a look and see if there was a way to be able to produce more of it and make sure that there's more access to this product all around the world.
The part of this story, well, among other things, but certainly one of the parts of this story that I find both hopeful but also confounding is how relatively straightforward what you're talking about is. You're talking about a lack of food, and it is a certain kind of food. It's not like we could just ship hot dogs over and solve the problem. Yeah. There's a certain set of requirements that Plumpy Nut fills, but in the end, it is raw material, manufacturing, shipping, distribution, saves lives.
Yeah.
We're not talking about scientific breakthroughs and medicine. We're talking about food delivered.
Yep. Although it is very evidence-based, the World Health Organization has endorsed this as the one way to treat severe acute malnutrition. One way that makes it easy to understand is this summer we had a shortage of baby formula. And so the shelves were empty. It was on the news every single night, and parents are getting nervous. Why? Well, because they realize you can't feed your child something else. There is no substitute to baby formula, right? It's the same situation with Plumpy Nut. There is nothing else that you cannot give corn to a severely malnourished child, just like you can't give corn to a newborn baby here in the United States. So when those shelves were empty, we had planes flying in from Europe to make sure that nobody here had a problem and that we had a supply chain. This is what we're doing the same way around the world where we have a problem of severe acute malnutrition. So those shelves can't be empty in the hospitals. If they are, it's very simply the difference between life and death. So when I was in that video, I was in Sierra Leone, and there was a mother there who had twins. And at first, she was told by the people in her village, don't go to the hospital, this will be fixed. It will sort itself out. And she lost one of her twins. So the second one, she said, I'm not listening to the people in my village. I'm going to go to the health center. She went there. She got Plumpy Nut, and that child's life was saved. And I got to spend 3 days with her just a few months ago in Sierra Leone. She's 6 years old now. She goes to school. She's doing well. So we're not only trying to save lives, but we have the micronutrients in this product that build brains. So that's the long-term development that's so important in this delivery. So saving lives is great, but building the brains so children can go to school, can be productive members of their society, that's also very important. So to see a girl 6 years old and to see the difference that mother comes in and the difference in treatment that she gets means the difference between her child's life being saved and not.
I actually, I've spent a lot of time throughout the continent of Africa, and many places. I did a long trip a number of years ago. And one of the things that blew me away is that pretty much wherever I went, by the way, this is true in other continents and nations throughout the world as well, I could find, not that I was looking for it necessarily, but Marlboro cigarettes. They were pretty much everywhere. And Coca-Cola was pretty much everywhere.
Yeah.
Like every part of every place in the world where I ever went. And I mention it because, the distribution of manufactured food and beverage, if you want to call it that, cigarettes, I guess, is a different thing, but that's not the issue. In other words, you can get products to these places. So I'm just curious, when you're there, well, just technically speaking, they find their way there. Now, the motives may be different and the systems may be a little bit different. But when you were there, this is the first time I'm asking, what was the missing ingredient and what was the hole you were trying to fill at that time?
Yeah, so funding. So there was a limited amount of funding in the space. And so most of our funding comes from the US government. USAID is the Agency for International Development. But something very fascinating happened 2 weeks ago. So we were in New York at the UN General Assembly, and they announced $500 million, $500 million to be allocated to Plumpy Nut. We make 8 products. They put $500 million behind one of them just 2 weeks ago. So now, I don't know if any of you guys make anything, Nantucket nectars, they just decided to add in $500 million worth of orders. What's the next problem? Building the capacity to be able to make an extra $500 million worth of Plumpy Nut. So some of that money went to the programs. That's an important piece. So we need the funding to buy the product. We need the funding in order to have the programs and those healthcare workers be able to be all over the world. We ship to 62 countries. And then you need to scale up that factory in order to make sure that we have the machines and the equipment to be able to put out that amount. So the world has recognized that there is a massive need. Food prices have tripled. This means that people cannot feed their families right now. What that means is you see violence in the streets. You see governments that are going to be overturned. It's already happening. This is not something that's going to happen in the future. It happened a few months ago. When those grains are held up in the ports in Ukraine, they're not being delivered to middle-income and low-income countries. So you're seeing hunger in places that we never saw before. And we're seeing it at a scale that we've never seen before. And that's why the world just woke up and is paying attention to this issue for the first time. I've been doing this for 14 years. It's the first time that we've seen everyone kind of come together. Other governments too, Canada, the Netherlands, other countries are coming together to say, if we don't address this situation, we are going to have mass famines. We expect a famine to be declared in Somalia imminently. But why are we watching it happen? We've been talking about this for months, and we know what's going to happen, and we're not stepping in and taking action on that. So now the funding is here, but now Adicia, my organization, we need to scale up immediately in order to be able to create all of these foods that are needed, that have the money, they have the programs, everything is in place to solve this problem. We want to make this famine that will be declared in Somalia the shortest famine in history.
Help us understand, though, you manufacture Plumpy Nut, among other things, in your own facility that you guys built from scratch. Like, how did you get into the actual manufacture of the product itself?
Yeah.
And was that sort of one of the first steps?
Yeah, so there's a company called Nutriset in France. And so when I saw that 60 Minutes piece, I did some research and found out where it was originally made. I started calling them. They hung up on me many times. So I flew to France. It's much harder to get rid of someone when they show up in your building. Yeah. And so anyway, we decided actually we're nice people and committed to this cause. And so we've been partners for 13 years. So I didn't know anything about manufacturing. And I actually started a factory in Tanzania first. So that was in partnership with Nutriset. That one was running for a couple years. And then I was at USAID at government meetings here. And they said, we actually need a factory in the United States. We have a grant that's available. And we need a nonprofit food aid manufacturing company. And there aren't any in the United States. So I was like, ugh. You know, the commute was better than to Dar es Salaam for sure, because I live in Rhode Island. So that was a little bit easier to be able to do. But so I ended up with 2 factories in partnership with Nutriset. They gave me all the technology transfer, so all of that information. Where do you buy the equipment? How does it all work? Because it's extremely complicated manufacturing process behind the scenes. So I have partnerships are something I believe in instead of trying to reinvent the wheel. Work with the people who are the experts. You can get to your end game a lot faster that way.
So you said, well, this is it, by the way. This is the product, right? And you said you had 7 other products. Are they other versions of Plumpy Nut?
Yeah, they're different sizes. There are different vitamins and mineral complexes in there. They're targeted. We want a very specific nutritional outcome to happen from this. It's not just food. So Plumpy Nut, if you have 3 a day, breakfast, lunch, and dinner, you cannot recognize a child when they come into the hospital versus 8 weeks later. You can't tell that it's the same child. So that nutritional outcome is very evidence-based, as I mentioned. And then, so we do the same for moderate malnutrition. We do the same for prevention. We do the same for mothers, pregnant mothers who are malnourished as well, and we also do a version for school children.
And
So
is
we're
it
looking at all those different demographics.
Under this brand name? Is it Plumpy Nut?
No, they call it
Different things.
Yeah. I
Okay,
won't bore
and you
with all the
said
different
I think you said not-for-profit manufacturing facility. Is that what you said?
Yeah.
And is that a stipulation within the way it's purchased through the different entities?
Yeah, so we are a nonprofit 501c3, but we're also run like a social enterprise. So I have a business background. So I want the numbers to work out, and I want to be able to see ROI, and I want to be able to measure it. So the social enterprise component is 95% of the business is I'm selling to UNICEF, World Food Program, and the US government, and maybe other governments, but those are my top three. Then UNICEFs of the world are giving this product for free to Action Against Hunger, Save the Children, Catholic Relief, all those kind of in the middle range, right? So you have your high UN level and then the middle guys. And so it's all given in kind for free for the beneficiaries, but they're paying me. And so then we take those profits and we're reinvesting in the equipment that we need. In normal times, this works fine. When the government puts in $500 million, we have a different situation where we need to do a little capital campaign, which is outside of the norm. Then 5% is traditional nonprofit. These are the small nonprofits that are outside of the United Nations. So we are giving product in kind free for those countries as well. So we do that in about 10 countries, and that's where they wouldn't have this funding that has come in. They're outside of that system. It allows us to deal with the tiniest situations going on in the world and the largest. As you can imagine, I couldn't fundraise to deal with Afghanistan. That's a fairly large situation we have over there. So that's something that the UN would handle. And then we're dealing with smaller situations in Uganda or Sierra Leone or something like that.
So do you, I mean, right now you're faced with a challenge that you have these massive orders. By the way, are these the biggest orders you've ever gotten?
My contracts, a normal contract was $2 million, maybe $3 million.
Wow.
In September, I got a $6 million contract, then it went to $13 million, then it went to 25, and then I just bid on one last week. It was $42 million. Now, the problem is I'm now winning 100% of these contracts. That means the world is at capacity. I'm not the only person who makes these products. In the United States, there's 2 of us, and worldwide, there's 20. That means that the entire world right now is at capacity. So what are we going to do about it? And so that's a problem that all of us are dealing with right now. So our first solution, one is obviously buy lots of equipment as fast as possible. And the other is add a 4th shift, right? We run 24/5. What about the weekends? It's 40% increase if we're able to work an additional 48 hours. That your overhead drops significantly, and you're able to, add quite an amount of volume that can happen fairly quickly. So by the first week of January, we hope to hire an additional 20 people and run 24/7.
So then I wonder, why isn't M&M Mars, no offense to any M&M Mars, but why aren't like candy manufacturers or peanut butter manufacturers, why aren't they making this?
Because traditionally, the profit margins aren't interesting enough for a multinational.
So it's price. It's like a per unit thing that doesn't pencil out for them.
No, because it's actually very competitive. Even though you're in the humanitarian space, that doesn't mean we have to fight to the death to win a contract, normally. This month of September, nothing normal about it. Normally, I can win and lose by 1/10 of a penny. So everything that we're investing, every decision that we're making has to be very, very mindful of cost. The lower our prices, the more children we can feed. So that's what is running through our brains as we're making these decisions on how to scale up and how to, constantly look for continuous improvement opportunities.
When they make these purchases, are they saying, my supplier in such and such a place can do it at such and such a rate?
Then they can win. That's fine.
And they'll say that to you.
Yep, but they can award it to whoever they want.
Got it.
Yep.
Wow. Okay.
Keeps us honest, I guess, right?
Yeah.
Competition is a good thing.
So when I have some degree of experience, limited, but made a lot of stuff over the years in factories, kind of like what you're describing.
Yeah.
And my version of it is I need more fillers, I need more tanks, I need more stuff to make more stuff. And is that the situation that you're in?
I need more stuff to make more stuff. Yeah, so if I were to add a vegetable oil tank right now, that's one of the bottlenecks I have. So if I have 8, I need 5 more. If I add 5 more, instead of 1 truck per day, a tanker coming per day, I can have 2. That means I can make more product. Then I'm going to find another bottleneck. And so each bottleneck that I find requires more equipment. So we have this plan that is basically phased. So every month we're increasing capacity somehow. We've tweaked something in the system or added something in the system or made it more efficient somehow to be able to increase the capacity. So in the last 2 months, we've increased 20%. It's okay. But we need to do more. So then we have the 4th shift, and then we have 25 other plans that will come into place.
You know, for me, one of the things I've learned through this process, I mean, one of them is sort of my surprise at I'm going to just use the word hunger, it might be the wrong word, but the broad scale presence of hunger on Earth today. You know, it's better than it used to be, but it's still a big problem.
Yeah.
Right? And okay, so that was one. Size of problem. Number 2 was, for me, what is malnutrition? You know, because I'm the guy who thinks you could just send, I mentioned before, hot dogs or whatever. Well, that's not true. It's a very specific and deadly problem, but it does have a pretty straightforward, I mean, I would argue this is a pretty straightforward solution. First of all, did everything I just say, am I right?
Yeah, I
am
mean,
I in the
think
right
that's what scares most people away is like, how do you solve world hunger? I mean, yeah, it's a little overwhelming, but we're really trying to look at, first of all, one child at a time, right? And when you're meeting those moms where they have the twins and one lives and one dies, right? Many of us in this room have children, right? And so each one is important. And so we can't possibly think, oh, this problem's too big to care about it. You know, it's just that one child, because I was constantly putting myself in those shoes saying, what if it was mine? And there was a solution that existed right over there, and I just didn't have access to it. Like, that's just, it's not okay.
Yeah.
And so the problem isn't too big, right? $500 million is actually not even that much money if we think about it in terms of what we put behind lots of initiatives. I mean, 40 billion went to Ukraine, right? And more and more and more and more is coming. So if we can solve a problem, so before we were reaching 25% of the severely malnourished children. Not great. It's okay. You know, we know what we're doing, we can measure it. But the first investment, they put $250 million in first. And I'm like, we could go from 25% to 50%. That's one of the biggest needle movers in global health that I've seen in decades, right? And then now we've doubled that donation to $500 million. We could go to 75%. And what's next? Like, we're actually getting so close to being able to reach. And so when we say we want to end malnutrition, it doesn't sound too big to solve. It sounds completely solvable. In fact, we have enough product to reach every child in Somalia right now. Every single one. We just have to decide that we want to do that.
You know, I was recommending earlier a documentary that I thought you should see about the earthquake. And part of the story is they outline these moments where, in the end, they send helicopters to save single lives.
Yes.
It's the same thing, right?
Well, except no one's going to send a helicopter to save.
But it's still a life.
Yeah.
This is way more efficient than a helicopter.
It is definitely cheaper.
Right.
I can say that for
but
sure.
But it's the same concept. I mean, I'm just trying to like humanize this on a certain level. I mean, I think we've all heard that thing that like if you can bring out an individual, well, we can feel it in our hearts. But if you use a statistic, it's easy for us just to not think about it. And the thing that I find so fascinating about your story and this story is, you know, one is the product is a version of peanut butter. I'm not trying to diminish the product. I'm just saying this is like the best medicine on earth to save people who are near death. There's a lot of them, and it's not beyond our capacity to solve this problem. It's just not.
No, I mean, Anderson Cooper equated it to penicillin, but for malnutrition.
Yeah.
And so that formula is super important. One of the things that it does is we used to use a formula that needed to be mixed with water and refrigerated. So those are two things we don't have in the developing world very much. So this allowed us, this is ready to eat. So you just open it and kids can feed themselves. So in malnutrition clinics, there used to be 3 children per bed. Now they all get to go home. So unless you have complications, unless you have pneumonia or HIV or something like that, you're going home with your parents and being treated at home. That opens up huge capacity in hospitals and clinics and cuts down on the cost to be able to treat. And so we're able to reach millions more than we could if we were just using a formula base.
This question may be either silly or unfair, but maybe neither. How long will you do this? Like,
I'm not
you're
tired.
going to do it tomorrow, I assume, but are you going to do it 5 years from now?
Well, absolutely. I mean, we have a goal to achieve, right? And we're getting so close. The closest that we've ever gotten, it's like people are finally listening, and that's a super exciting time to be in a space where you can watch a problem be solved that you've been working on for 14 years. So now is like the most exciting time that I've seen where we have the most potential. So will I still be here in 5 years? Absolutely.
Okay, and one of your challenges is capital.
Yes.
Which I'm just curious, in my head I'm thinking, well, can you do some form of asset-backed lending? Like, what are the different mechanisms you might use? In the end, the way these things are structured, you kind of need partners to help you build out your manufacturing capability. Is that right? Which kind of means donor partners.
Right.
Is that true?
Right. So DCA is looking to raise $12 million. So it's this one-time capital campaign in order to buy the equipment that we need. So those oil silos, palletizers, filling machines, conveyor belts, all these ridiculously metallic-looking things that need to come into the building immediately in order to increase our capacity. These machines that we're looking to buy will last 20 years. So if you do the math, a $12 million investment will mean that we can reach 120 million children. Not one day, this whole treatment, 8 weeks, some are longer than that. 120 million children's lives saved is the return on investment of $12 million of equipment that we put in the factory in Rhode Island.
Do you compare yourself to any, well, not you individually, but do you compare your organization to others? I'm struggling with it.
We're in a
and
weird
that's why I'm
space.
asking.
Not really. I don't know. I mean, I love the concept of social entrepreneurship. And this wasn't a class when I was starting at DCI. In fact, I was in Tanzania and I was looking at traditional aid organizations. And I told the person who was taking me around, I said, I want to go visit this factory. And they're like, no, it's not on the agenda. I'm like, I know, but we're so close. Can we just go visit this factory? I'm just curious. I don't even know why I wanted to go there, but I get there and I see a line of people waiting out front. And I said, what are they waiting for? They said, they're waiting for jobs. I said, okay, let's go inside and let's go see what they're making in here. Open the doors, there's 3,000 women who are sitting behind sewing machines. They are earning a paycheck. They can pay for everything that their family needs, whether it's shelter, it's food, it's medicine, whatever it is. But they happen to be making mosquito nets. So just by chance, they're solving a major global health challenge, but at the same time, they're addressing one of the root causes of poverty, which is job creation, right? So you're handing out paychecks, but then you're also being able to give out mosquito nets. And so maybe that's what I would associate closest with, is that we can take business and we can take doing good and we can combine them beautifully. And it's not making a choice between doing one or the other, but doing them both. It makes it self-sustainable, it makes it scalable, and it makes sure that we can have the most enormous impact imaginable, and it allows us to end a crisis like malnutrition.
Have you said yes to your big order?
I mean, I'm waiting for the answer on the $42 million one, you know.
From them?
This one's from UNICEF.
Okay,
yeah,
and
I'm hoping they don't take the whole thing. I mean, for once, I'm like, I don't.
So that's kind of my question. Like, let's say they say, we're in.
That's what I'm afraid of.
And you'd have to frickin' get your stuff together.
You're going to have to come work there, actually. All of you are going to have to sign up for a shift.
But it's that kind of thing. I mean, to deliver, you're going to have to make happen these investments.
We have to make magic happen, but here's the thing. We all have the power to make magic happen. This I know. We have all the resources that we need to make this magic happen. 100% convinced of that.
Yeah. There's something incredibly refreshing. One, it's like doing anything for 14 years is a long time, right? I imagine people can identify with that. Doing something like this is particularly challenging just by virtue of the fact that we haven't talked a lot about it, but I got to believe you had a lot of ups and downs.
Of course.
But I think the other part of it is that it's so easy to identify with this. This is a pretty straightforward problem that we've all known about really our whole lives, that hunger in the world is a real problem. But to be able to do something about it, I think is super refreshing.
Yeah.
And I give you huge credit for having the guts and the determination to do those things. And
but I think that's the key, doing. We can talk a lot, but in this situation, in order to unlock the money that has just come in, we need to be a community of doers that take action, that don't just hear it, but say, I'm going to step up and do something about that, because it's not me by myself. It takes more and more partnerships and people who believe in what we're doing, and that collective family behind that mission can make it possible.
Okay, so we're going overtime, but I'll go quickly. So if we do want to help, where's the woman who you were with?
Amanda's back
Where's
there.
Amanda?
We're a fundraising team of 1.5. She's the one, I'm 0.5.
So we can talk to Amanda, but do you have is there a slide with the URL or something on it? It's probably not that complicated. Is it Edisia? Okay, edesianutrition.org.
Edisia, she's the Roman goddess of food, Edesia. So you can look us up. Come and find me. I'll be here for the next couple of hours. So if you want to talk about anything more, if you have more questions, please come and ask.
Congratulations for what you guys are both doing. Yeah.
Thank you. Thanks,
Tom. I know we're all rooting for you, but I hope we root for you. But was that the thingy? Yeah.
Oh, yeah. No, that's next.
I saw one of those. What are they called? What are those things
called? The music's playing.
Whatever those things are called that you take a picture of.
The QR code.
QR code, yeah.
There we go.
There it is. There it is. Okay,
Scan
great,
that.
great. Thank you for everything you do, and I know we're all rooting for you and
Thanks,
love to
Tom.
help you. So thank you.
Tom.
Yeah.
Thanks.
Okay, so we're shifting topics. That was we're moving to a lighter topic, but an important one nonetheless. We're going to get some perspective from leading institutional investors, and I'm welcoming Jim Aiello, our own Jim Aiello.
Can everyone hear me? I think I hear the echo. It's good. So a lot of people here are from the investor community. A lot of people here are also from the GP community, the funds, and we thought it's time to hear from the investors themselves. So we're very excited to have, we're actually going to have 2 days of institutional investor perspectives. So this is day one. We've got a fabulous panel of very impressive allocators, and we thought let's put them a little bit on the hot seat and get some perspectives on what they're allocating to now, what they're looking at in the future. You know, there is a plethora of risks on the horizon and risks that are in front of us right now that we're all aware of. Let's see what's going on in their minds, what their plans are for the future. So let me start off. We actually have 4 distinguished people. We have Jay Madia from Axis Capital, Harshal Chidhari from GE, Paul Colonna from Lockheed Martin, and Mark Burgess from HESTA, which is an Australian-based public pension fund. What I'd like to do is first, if you guys could each go through and talk a little bit about your portfolios, just to kind of ground the discussion, then we'll go from there. So Jay, why don't you start it off?
Yeah, sure. Thanks, Jim. I think one of the important things for us is that we are a global insurance and reinsurance company. So that helps to determine some of our asset allocation of our portfolio. So we have about $16 billion in AUM. I'd say the vast majority of that, about 80%, is in high-grade fixed income, and that's really to match our liabilities and match our duration for our business model. And then the other sort of 20% is what we call risk assets. That's the area that I cover, and that includes everything from credit to equities, to private equity, and real estate. We do invest globally. I think one thing I might mention is that on the alternative side, you know, our investments are not programmatic in nature. They're really, every investment is just an opportunistic investment. We invest based on absolute return, and you know, we invest with the intention of, we think this is just going to be a great investment from an absolute perspective. So it's not that we have a set allocation to it.
That's great. Harshal?
Sure. So yeah, the GE Pension Trust, you know, we are investing for the corporate pension plan at GE. Corporate pension plans, I should say. So we have a little under $100 billion in AUM. Large part of that is in the US, in our USDB plan and the DC plan in the US. We also have some plans around the world, the largest of them being in the UK, which also a plan that me and my team, we oversee that. As far as our asset allocation is concerned, again, as being a pension plan and a corporate pension plan, we sort of have a dual objective. We do have a total return objective so that we can make sure we grow out of our funding deficit and hopefully build a surplus at the same time. And so that's our long-term objective, right? At the same time, our liability has an inherent interest rate risk, and that creates a volatility on the corporate balance sheet. So that's another short-term objective that we have, is to kind of hedge that liability. So, you know, it sometimes could be, you know, challenging and difficult to meet and match both of those objectives, but, you know, that's our mandate. Our portfolio, again, you know, broad, very highly diversified global portfolio. From an alts perspective, it's about 30% in alts. You know, it's across the asset classes: private equity, private credit, real estate, hedge funds. You know, as Jay mentioned, you know, we are similarly, you know, absolute return, total return type of investors when it comes to the alts portfolio. Our private equity portfolio is, you know, I would say predominantly middle market buyout based, you know, in the US and in Europe. Private credit is about equal parts specialty lending, direct lending, diversified credit, and distressed. And then real estate, I should say both the private and the public, private credit and the private equity portfolios. We have about a third of the portfolio, 2/3 is funds, and a third of the portfolio is direct investing, you know, co-investments, and we do direct investments as well. And then the real estate book is actually flipped. You know, it's predominantly direct, where we have direct allocation to multifamily and office, and then we round that out in other asset classes using funds. And then we also have a hedge fund program that is kind of growing at this point in time. The goal is to serve diversified absolute return.
Great. Thank you. Paul?
Yeah, a lot of similarities to to Harshil's portfolio. We're a corporate pension plan as well. 75 billion in assets, 25 billion in the pension fund, 50 billion in our defined contribution plan. On the pension side, it's a diversified portfolio as well. 35% alternatives, private equity, real estate, and hedge funds. Probably I'm going to say 75%. Return-seeking assets, so kind of growth equity type assets, and then 25% fixed income assets, as Harshil was mentioning, in terms of hedging our liabilities. Mostly, we're mostly in the U.S. We're probably 80% U.S. and then have global investments as well.
Great, Mark.
Yeah, so Mark Burgess, I'm from Australia, and you might know the Australian situation, but Australia has a mandated pension system. We're up to 10.5% of all salaries now get paid into the system. So $3.5 trillion in total. It's been going for 30 years. It's going to go up to 12.5% of salaries over the next 12 or 18 months or so, depending on the economy perhaps. The fund that I chair the investment committee of is HESTA. It's for healthcare workers. I did it originally because I thought healthcare workers were important. Little did I know how important they actually are. So it's super to help them out. That's the history of the industry. Is it's started with industry base. Now it's very competitive. Anyone can join any fund, and our fund is about 70 billion. In terms of asset allocation, very similar. It's all defined contribution in Australia. About 70% in listed equities, bonds, etc., and about 35 to 40% is in unlisted, things like PE, the standard things. PE, large exposure to infrastructures, an historic kind of focus of Australian funds, and also things like real estate. So pretty straightforward balance.
That's great. Thanks so much. This is great. So today's really all about asset allocation. Where are you now? Where are you heading? The confluence of wars, the confluence of other geopolitical issues, rising interest rates presents, I think, a very challenging situation for any kind of investor, particularly institutional investors who have very clear mandates and a lot of constraints. So why don't we talk a little bit, we can kind of just go down the row a little bit of where you stand in terms of current allocations. And I would think kind of basic categories, I think most of you are not sort of 60-40 equity fixed income anymore. It sort of seems to be out of favor. But big categories, where are you? Geographically, where are you? In terms of privates versus publics, where are you? And if you're doing any direct investments, what might those be? So why don't we just go down the row? Jay, why don't you start off?
Yeah, sure. I'd say we're pretty diversified across public credit, private credit, real estate, private equity, real estate credit. I'd say versus others, we're probably not as heavy in private equity, not by design, but just sort of how it happened. We're pretty low in venture capital. We have been over time. Again, not necessarily by design. And in terms of direct deals or private deals, we don't originate anything direct, but we do see a lot of flow of individual private credit deals that we're always being shown.
What about geographically? I know you guys are internationally oriented, so give us a sense of the geographic mix.
Yeah, sure. So, starting with the high-grade fixed income portfolio, we do have a significant chunk in Europe. Again, that's more just kind of matching our business model. In terms of our risk assets portfolio, we are mostly in the U.S. We have a fair amount in Europe, and we have a much smaller amount in emerging markets.
What about in China and India in particular? Anything in those markets?
Yeah, so we have some indirect exposure to India. I think a lot of folks have mentioned throughout the day that I think India looks like one of the bright spots today. Okay. China is an area that we're not actively allocating to right now. It's not that we don't like the underlying story. It's just the repatriation and some of the legal barriers are problematic for us.
Harshil, overview.
Yes, as I mentioned, our portfolio is about 70% in listed securities, stocks and bonds. The fixed income tends to be predominantly U.S. focused, and the listed equities is more of a MSCI equity kind of a market weight across the world. Talk about specific India and China. Again, similar to what Jay was saying. China has been, more of a market weight for us. We haven't necessarily gone and done anything specific in China other than a few private equity funds that we may have.
Okay.
India is coming up on our radar. It's an interesting opportunity, especially as some of the tensions from China that we're seeing right now. India and some of the other South Asian countries could be a beneficiary of that China plus one kind of a strategy. So we are paying attention there. We have some direct investments in India. We're looking to make some more portfolio investments there. From our portfolio, sort of a broader allocation perspective, on the alt side, in the private equity side, we actually we're underweight in technology and healthcare, and those are the sectors that we've been looking to kind of grow. We were lucky in a way that we were underweight coming into this crisis, and I think
better valuations, right?
Yeah, better valuations to kind of grow our portfolio there. And so real estate. Start talking about it. That's another place where we've been very active in that book. We've been actually, for the first half of this year and last half of last year, we've been monetizing a lot of our direct real estate assets, especially multifamily and office. Again, this was more of a portfolio rationalization that we were doing, but we were amazed to see sort of the marks that we were getting on our properties, and we were trying to get some liquidity where we can.
That's great. Paul?
Yeah, this is, we're kind of thinking about this. A lot of times you'll say, we're at an inflection point, but I think we actually are right now. I think this is actually true this time, and it's, the 40-year cycle, I think, in rates has been broken. From 1982 to 2022, and so I think that means we are in a different regime, and with higher interest rates and major rotations. And so for us, it kind of means three big things for us. It means more, fixed income, just across the board, and that can mean a lot of different things depending on where you are in the portfolio. It could just, the obvious returns on just cash fixed income instruments are there, but moving up the capital structure in private equity. Shifting from long-short equity to more credit strategies in the hedge fund portfolio. So there's a bunch of different ways we can really articulate that thought of higher interest rates and the regime shift there. The other piece is growth to value, and so that's happening really across our public equity books, and trying to make sure that we make this transition for the coming 5 to 10 year cycle that we believe is there. For value stocks in public equities, and then lastly, I think for us, in terms of geographics, I think it means more in the U.S. For us, we're definitely in China. We've been we've done everything in China in terms of public and private markets, hedge funds, public equity, real estate, A shares, and we're definitely doing less there. We just kind of feel like the risk premiums are significantly higher, and there's just better alternatives. Globally on a risk return basis to invest, and so more U.S., more fixed income, and probably more value versus growth.
What would you say the mix is domestic right now, domestic versus international in the current portfolio? You're moving towards more of the U.S., but what's the mix right now?
Yeah, and we're pretty heavily weighted to U.S. to begin with. We're probably somewhere between 75 and 80% U.S.
Okay, and
so
that'll be increasing.
I think so. And again,
okay.
this is a long term. This isn't tactically speaking. You say, hey, look, China's really cheap, Europe's really cheap. I'm thinking over the next 5 to 10 years, we're probably more U.S. focused than
so short term. 10 years is short term for you guys,
right? we like to think so.
Okay. So Mark, you're from Australia. So give us right off the bat, what's your mix of international, roughly by geography today?
Yeah. So international is a growing share, and what's really happening is it's good for diversification, but also we're crowding out our own market. It's a market of only 26 million people, and we've got $3.5 trillion. And you'll find over time it's projected to get to 7 or 8 trillion in relatively quick order. We have to be far more international, and so we're beginning to see, for example, the major pension plans set themselves up in offices around the world and do really the Canadian model, but we're particularly pressured on that front to more diversify outside of the country. There's also better growth opportunities outside the country because of exposure to things like technology. In relation to China, Australia has an interesting kind of relationship there, but 36% of all exports from Australia go to China already. So we get to play the China game indirectly. And so from a diversification point of view, some China exposure in portfolios, but we are absolutely pleased to see places like India and other diversifying asset classes emerging for us to find investment opportunities. Yeah.
That's great. Okay. Wonderful. That's helpful, very helpful context. You can see these are very global investors. But changing their strategies as they're rolling. Speaking of which, so given the overwhelming economic and geopolitical risks that are A, with us today, and B, certainly on the horizon. How are you and your investment committees thinking about rising interest rates, a stretched consumer, some stagnating economies, a strong U.S. dollar, and then all the geopolitical risks? So Mark, we're going to go back to you. We're going to work back this way. So give us, you're in the middle of it. You're right by China. You're right by India. You're the Switzerland of Asia.
If it wasn't for the fact that financial markets are going down in value, this is good news, right? And it's good news for a really clear reason. 18 months ago, the markets were terrible to invest in because all the markets had risen together and you couldn't find diversification. Now, in Australia, we found diversification because we're lucky in some ways. The Australian dollar weakens if risk gets taken off the bat. So we can up and down our foreign currency exposure. So for an $80 investor, that helps. But 18 months ago, the thing as we were providing governance to the investment teams was to stop them from doing silly things while the cycle was hot. And now that the cycle's less hot, now that things have gone back the other way and gone back at speed, there's enormous dangers with this, right? There's financial system dangers and other issues that we've all got to watch for, but it is beginning to create diversifiable assets. I guess our fear as we sit here today is that, say, the unlisted book is not yet priced. Real estate is just simply not mark to market. And so you've got to think really carefully about that. And then secondly, we think for the next decade that some of the themes have been talked about today, you're just going to have to be a really skilled investor. That the winds have been carrying us for the last 40 years really, but particularly the last couple of years. And so we're working a lot on skill because we think there's excesses in the system. We think there are excesses. So we love private equity, but we see lots of private equity managers raising lots of funds. I read the other day 75% of all PE firms, according to Apollo, are currently in fundraising mode. That's a short, not a long, right, in case you're wondering. And so we're working with our teams to try and make sure, because we want exposure to private equity, but are we with great partners, people who haven't got outside their lanes? We heard that in private credit, everyone's a private credit manager. So this is the sort of adjustments that we've been making for some time now. And in some ways I'm happy, except we've got negative returns, that the thing's being shaken out because at least looking forward, we can act more like a reasonable investor. And secondly, if we're skilled, we can add value.
Great. Paul?
Yeah, and maybe just picking up on that last point, and I think I gave you our kind of thesis for the next 5 to 10 years. But on the skill side, I would agree, and I think this is we've always been active managers, and we kind of were active managers through what I'll consider to be the hard days of indexation over the last decade, when everyone would question, why are you doing active management, and does it make any sense, and it's expensive and tends to underperform. I mean, we've had success with it, and we've had strong outperformance through active management, which is great. But I do believe that going forward, the differentiation in markets, across publics, privates is going to be there. And so I think it's going to be an even better time for active management. I mean, my general thought would be, if you haven't been doing active management, you should probably be pushing up that part of your portfolio and being even more active as we move forward. And then just tactically maybe, and we're not a big tactical firm, but we've been, given the volatility this year, we've been more tactical. And so we're pretty sanguine on the markets here. We usually do some portfolio hedging. We're doing more portfolio hedging than we've probably ever done for downside protection, and then also just tactically looking at really the U.S. equity markets. And so for us, we kind of feel like, not that the bottom is dropping out, but that you're going to get a weak earnings season for sure, over the next couple weeks. And the consumer's fine, and the macroeconomic environment is okay, but there's no catalyst. We're back to this regime shift. You're in a world now where it's not a buy the dip, it's stocks. There's really, there's nothing else that you could possibly invest in. I think you've got returns in a lot of the asset classes that I think people have talked about here today that are compelling versus long-term, risk premiums on the equity market. So I think that just creates a new dynamic for how you should be thinking about the equity market, how you should be trading the equity market. And so for us, tactically, we've just been more active.
What's the implication? You talked about geography. You're focusing more probably domestically, right? But what's the implication on industry segments and perhaps asset classes between, say, equity, debt, venture, direct?
Yeah, I mean, well, definitely, and so definitely for us, I mean, it's we're always trying to do more direct and co-investments, and that's just bringing fees down, and we have the ability to kind of be more concentrated. Definitely more more debt versus equity, and more kind of value, and Harshil was mentioning some of the undervalued sectors, and and we would agree. And so we're looking to find managers who fit kind of those, those.
Where do you see
specifics.
value right now, sector-wise?
Well, I think it in value, right? I mean, so I think it's
general value. Okay.
Yeah, so I think right. I mean, financials, energy. I mean, right, healthcare was mentioned. I mean,
classic.
those are sectors that, and again, we try to give our managers broad swaths to, play the market. But I think over the last decade, we've migrated to this kind of growth-heavy portfolio.
Right.
We're trying
You're
to
shifting
transition
out of
that.
it. Okay,
Yeah.
great. Okay. Arjun?
Yeah, agree with everything that was said. I mean, as we sit around our table in an investment committee and as a team has discussed it, right? I think you mentioned geopolitical risk. A lot of that is going on, energy crisis, all of those things, right? But we really think right now the most important issue that we need to pay attention to is inflation and what the central bankers are doing in response to the inflation. So that's really our main focus. Our thesis is, the Fed realizes that they were a little bit behind the curve when it comes to inflation fighting. They now have have shown a resolve to go and fix that, right? So I think that's right. There is a risk now that they probably over tighten on the other end, but I think on balance it feels like that may be a better situation for us to be in than to get a double peak inflation at some point in time, right? So this immature pivot is probably not sort of what we think we want right now, and so from that perspective, if you just look at sort of where CPI is, we're going to get a new CPI number 2 days later, and that's still kind of month over month, the consensus is 0.4. That's still pretty high. ISM, it hasn't bottomed out yet. Earnings, Paul was saying, starting to decelerate, but long way to go. So these are not the situations, these are not the indicators where the equity market bottoms in our view, right? So from that perspective, we think we've been pretty underweight equities in this situation. Fixed income does provide kind of an interesting place right now. It's finally you're getting paid to hold it. High yield bonds, or you can get 10% yield on those. And so even if we get some default cycle going forward, we think your risk reward is probably better on fixed income. And on the high quality fixed income.
So you agree with Paul on that?
Absolutely.
More towards fixed income. Okay.
And again, just positioning ourselves in a defensively, and having a quality tilt in everything that we do.
And mostly domestic fixed income or outside the U.S.?
Well, domestic. Our fixed income is predominantly domestic. So yeah, I'd say domestic.
Okay. Jay?
Yeah, sure. I agree with most of what was said. A couple extra points I would make is, so on interest rates, I think, we're looking very closely at real estate valuations, and we're also looking at interest coverage ratios on loans. And in real estate valuations, I think, there's potentially one leg where the private market, cap rates adjust to where public markets are, and then maybe there's a second leg where once rent growth slows down with inflation fighting, potentially cap rates take a second leg up. So that's a risk factor there. It's also noteworthy that the Case-Shiller index of U.S. residential housing had its first month-over-month drop, and I believe that was July. So we still haven't seen September since the financial crisis. So that's
though not a total surprise, because it went up so fast. It was unprecedented, the rate. So mean reversion, it's going to come down.
Exactly. So that's on the interest rate front. In terms of the recession and the consumer, during COVID, consumer delinquencies in just about every subprime asset class were like the lowest ever. They were zero everywhere because people were flush with cash with COVID payments. We're starting to see those rise. Everybody's scared of a recession. A recession is supposed to be bad for stocks. My opinion is actually the opposite. This recession is different for two reasons. One is it's the most widely telegraphed recession ever. And second is we are trying to fight inflation, which is the first time we've been doing that since the 1980s. And so this recession is actually good for stocks because this recession will keep rates at where they are and not have to go higher. If we don't get a recession, ironically, that would be bad for stocks in my mind. And then, finally, I'd mentioned, Jim, there's some room here for contrarian thinking. So, the British pound is at a 100-year low. If you think back 10 years ago,
what is it at right now? It's almost getting close to parity, right? 110?
Yeah, it had hit 105 at one point when the tax bill was in the making. If you think back to 10 years ago, people were saying the exact same thing about the U.S. 2011, the U.S. dollar was weak. U.S. had lost its competitive edge. the U.S. was going to be in decline, and people had an acronym back then, BRIC: Brazil, Russia, India, China. That acronym was used just about every day in every Wall Street research report. When is the last time in the last 2 years that you've heard the word BRIC be used, right? So
only in construction, I think.
Right. So people tend to people tend to pile on when things are bad, but those are 10-year cycles. The pound is at a 100-year low. So there is some room for contrarian thinking. And you asked about value. I agree with Harshal and the others on the panel that we do see value in private credit right now. You can make a very decent yield by doing a lot less work than you had to in the past. And we see value emerging in Europe.
Right. So let's just cue off of that. So right now, 100-year low, British pound, probably somewhat similar for euro, and probably many of the currencies, maybe the pound is the worst. So you guys run portfolios that are looking more longer term, but there is a tactical component. So if you're managing $15 billion, $100 billion, but you do have a tactical component, can you seize upon that strong dollar and take advantage of that maybe shorter term, maybe in real estate or other asset classes? Can you do that given that we are, everything is cyclical? If you're at a 100-year low, probably a pretty good time to be buying. So Jay, can Access Capital take advantage of 100-year lows and
I think the way
the answer is yes somehow, but explain how that is.
So, maybe not tactically, Jim. I think the way we would think about it is we wouldn't be as afraid to take because we have a long time horizon. We wouldn't be as scared to take that type of exposure, regardless of what the the short-term thinking is.
So what asset class would that be in?
Potentially European credit.
Credit, okay, but not real estate?
Potentially real estate as well. I think some of the other panelists and I mentioned that real estate valuations are something that we want to be a little bit cautious on right now. The private markets in real estate take time to adjust
right, so
versus
it's the private,
the public market.
So it's the mark-to-market part, okay. All right, so let's talk about sort of, given all these risks, if you had to pick one area that you find the most attractive, an area defined very broadly, and one that's the least attractive, let's just kind of do a quick round on that. So what's your favorite and what's your least favorite? You can define area as geography or asset type or direct, indirect, public, private. So you can pick what it is. So Jay, you go first.
Sure.
Favorite and worst.
Yeah, I think from a broad asset class, I think right now private credit does look interesting to me, just because you can get paid a very decent return for a lot less brain damage than you used to have to in the past. Least favorite area would be China.
Okay, Harshal?
Look at the world and how volatile everything is, and we got divergent policies going on, right? Japan is easing, Brazil's kind of way ahead in tightening. Those rates have gone from like 2% to 13% in the last 6 months. US is somewhere in between. We may be pivoting at some point. UK has scored a lot of self-goals. These type of situations, to your point about what's happening with the currency and all those kind of things, we don't go and make those direct investments, but one of the areas that we think is well suited to take advantage of all that is going on, the volatility, the dispersions, the inflection points, is global macro. And so that's really the area I would say, we are focused on. We've doubled our allocation to global macro in the last year, and we think will continue to do well.
Worst asset?
Worst, I would say at this point in time, probably, office real estate.
Manhattan, San Francisco, perhaps?
Probably worse.
Yeah, those two are probably competing. Paul, what would you say best and worst?
On maybe on the real estate side, and it's probably stuff that's already in the ground, but the rental market for sure is an interesting one. I think if you were able to get stuff in the ground over the last year, I think those are going to be great long-term investments, and I think it goes, and I was listening to some of the previous conversations today. The change again in this regime shift, which we believe is underway. The velocity in housing is collapsing. Right, it's already collapsed, but I think it'll stay muted for quite a long time, and so we're going to have people locked into their homes through their lower mortgage rates because we have rates up so high so quickly, and that is only going to press more and more into the rental market. So where you may get, I think we were talking about, Case-Shiller, moving down a little bit. To me, doesn't matter because I think the volumes and the velocity is going to be so low. So it's like, well, great, the one house that sold was down 20% because that was the person who had to sell.
Right.
But it's, the artificial, velocity was really, or the low rates, created this artificial low velocity for the last, 15 years or so. And so I think the rental markets and single family housing are in the ground stuff. I think is just going to, I don't think people can really understand just how much of an impact that's going to have, especially back to inflation. I know others were talking about potentially deflation, going forward. It's just hard to see that over the next 2 to 3 years because I think you're going to have this structural core inflation through through the rental market. So we like that, the in the ground stuff, and I think on the short side for us, or on the least wanted type investments, I think it's China for us, for sure. And it's not only just the risk premiums of geopolitical risk and what's happening there, in terms of the government, but then it's also just their macroeconomic environment's a tough one too. So that would be probably our
So Mark, don't get excited at me because I know you guys you're right next door to China, but would you agree with the sentiment on China right here?
I was just thinking about my best and worst. Can I do that instead? I'll mention China though.
Maybe China's the best and the worst, depending on the segment.
Yeah, look, China's at a really interesting spot, and we're going to do a panel on Thursday about this. But yeah, look, China. I think it was said earlier today, and I first went to China in 1983. Like a lot of people, been there a lot. I'm always so impressed with its sense of strategy. But boy, they're taking a lot on. We used to play a game as investors to make the analysts more interesting, rather than just write reports. I'd ask them if they'd like to be CEO of the company. Right? And to get an analyst to think like that, you have to really get them to think like they're going to put their career on the line. And I remember we first did this when Jack Welch left, and the analyst loved GE, but he didn't want to be the CEO, which is a bit telling, right? And China's a bit the same way. Would you like to run that country? They're being very brave right now, but they're actually doing stuff. They actually are trying to fix it, and the markets are terrible. And I get all the points about liquidity, but one of the reasons we run global portfolios is that there's always illiquidity risk. And do we really think capital is going to be shut off in China? That's possible, I suppose. But if prices keep going down, I think some degree of diversification into emerging markets makes sense.
Yeah.
But we prefer things like India, Indonesia, Philippines. They're the demographic plays and they're the places to be. And the other long, I'd say, just out of interest, and it's inverse for me, but if I was a pension plan here in the US, and who am I to say, but I'd start putting money into offshore currencies. Because I've got to say,
stop.
I've got to
stop or start. Stop.
The US dollar is absurdly expensive.
Right.
And if you guys all carried cash, there'd be a risk I'd mug you, because if I can take some cash home, and from my perspective, eating out here is absurdly expensive, which is just the inverse of the US dollars had this crazy rally.
So we should all be buying real estate in London right now, right?
Well, not even that, but if I was running a big pension plan here, I don't know the degree to which you can move it up or down, and I'd be looking to put a few % offshore, because it will give you bang for your buck in US dollars, I would think here. And for Australians, we're going to do the opposite. We're going to start buying back the Aussie dollar, although we've got a singular dynamic. So there's a...
That's a great discussion. Okay, good. All right, so now let's talk about, we're going to have some time to take some questions from the audience. We have a lot of fund managers here. We can ask some questions to you guys. So we have 12 minutes to go. We'll save 6 or 7 minutes for questions. Before we get to that, though, again, because we have so many fund managers here, so what are managers doing best in terms of offerings? I mean, you guys are courted constantly by GPs, and you say no to most, but you're happy to welcome the door to some of them. What are managers doing well these days, and then what are some opportunities for improvement? So, Mark, I'm going to start with you again. What do you like that you're seeing out there, and what could you see more of from managers?
Yeah, look, I think managers generally are very good at trying to customize and provide a service. So as you build a diversified portfolio today, you can go to a lot of great managers and get a lot of great offerings and do a lot of work with the portfolio that I'm old enough to remember 15, 20 years ago you couldn't. And I think that's faithful. The flip side, as I said before, is that certainly we're telling our teams, be careful the managers you choose, because I think some have extended themselves into areas that over time may not be as strong, but generally the servicing is very good. The one thing we haven't talked about today is co-investments. There's huge pressure from our side of the fence to do co-investments, and I think managers have responded to that. I live in fear that our side of the fence is not skilled at it, and I think we're going to have portfolios that if things get rough again and stay rough for a period, the co-investment environment is going to be difficult for us to manage. Not because our managers are bad, but perhaps we've got a little over our skis a bit thinking that we know what we're doing. And I think that's something that we're going to have to work with our managers on to make sure that's a smooth process.
That's great.
So it doesn't affect the relationships badly. If we have one or two deals, it's interesting, institutions, if you have one or two deals, can be much more meaningful than a PE firm that's doing multiple deals all the time.
Yeah, right.
And we'll have to see how that happens.
Okay,
Yeah.
great. That's great.
Yeah, I would say just taking off that point, certainly, we're looking for, managers where we can have a relationship, a holistic relationship. So not just, fund 1, fund 2, fund 3, but then how does it grow from there? Whether it's co-invest, whether it's financing opportunities, whatever it is. I mean, we're looking to create holistic relationships because time is a precious commodity too. And so I'd rather concentrate on managers and have more holistic relationships. And so I think the managers who view it that way, for us are providing a lot of value and are thinking about, their business in different ways as opposed to just how do I get my latest fund out the door, which by the way is probably, double or triple the size that it was, a year or two ago, which is also a whole nother issue, which maybe is the downside. And what are managers doing right now? They're focusing too much on the next fund and increasing big sizes, and it's just, our check size is not increasing, right? I mean, we're not going to follow big funds like that. So we're looking for focus, discipline, overall relationships, and it's the managers that are trying to get too big too fast. That and we've had some great relationships where we've walked away and said, look, this is just too big for us now, and it's just not. It's not what we signed up for a decade ago, and so that, and those are difficult conversations, but you have to have them.
That presents opportunities for other managers then, which is what you're saying. You can sort of bring in, yeah,
absolutely.
Okay. Harshal?
Similar themes. I mean, exactly what we're looking for is a partnership kind of a model, right?
Yeah.
Partnership kind of an approach. More and more, we're looking for solutions, right? So the point products may not always fit us, but can we construct something that may suit our need, right? So working together with a manager is important. The other way, strategic partner is a very misused word these days. It means a lot of things to a lot of people. But when we think about a strategic partnership, I think as Paul was saying is, how can we partner in a lot of different things? When can we treat the manager as an extension of our team, where we come to you with the projects, where we can be assured that we're going to get an objective response back, an objective advice back, rather than sort of just trying to sell the next fund you're selling.
Right.
So those are the things we're looking for. I think and those are where we build a very good tight manager relationships, and a lot of managers are good at that. Okay. Have gotten good at that today.
Okay.
I mean, where again, I think the short-termism a little bit, as what Paul was mentioning, is a problem, right? Just because you now have 3 products and you all of your funds are twice the size, we don't have 6 times the capital to commit to you, right? And so that's a hard conversation. We also get situations where there is sort of a bait and switch, right? Where somebody's talking about, here's a new fund, we really want you as a partner, this and that, and we say, okay, $100 million, and then they say, "Oh, sorry, I had to cut you back." Like that's not in good form, right? If you're trying to build a relationship, let's build a relationship on the right foot, right? So those things happen as well, and they work both ways.
That's a good point. Jay,
not much to add to all of that, Jim. I just repeat. Yeah, we like co-investments, one-off deals, founding economics in a new product, joint ventures on opportunities. Some of the areas of caution would be when we see kind of lack of transparency or lack of communication, and I think the size argument is also a good one.
Okay. All right, so let's open it up for some questions. We have quite a few. Steve, I knew you were going to ask a question. You were saying you were waiting for me. So go ahead. Just speak loud.
I got a mic.
Okay, great, thank you. He doesn't really need a mic, but that's all right.
We're involved in the Asia Pacific area, so I'd love to talk to you, Mark, later. But my question would be, we're running obviously at about 8% plus inflation rate. If with the change in administration that may come in November here, if oil, which is about 40% of our inflation problem, something in that neighborhood, if oil if we were to become oil independent again, the way we were before, what effect would that have on deflation, inflation, Federal Reserve policy, and your portfolio strategy? How would it change?
Who wants to take that one?
Well, I mean, I'll start. We actually believe that. So that you're really talking about headline inflation there with oil.
Yeah, right.
There's also food there too. So we kind of believe that, even if we take your thesis that look, we can become energy independent and oil comes down, we still think food is a problem, and we still think core inflation. I was saying on real estate side, so a third of core inflation, I believe, is rental housing and or owner's equivalent rent, and so we kind of believe there is a structural story again for the next several years. A structural story. So I don't think it's as easy as kind of quickly saying it's it's energy independence that brings down inflation. So for us, I think we're positioning for this notion of, hey, look, this isn't a midterm election kind of swing, and we're going to have a move down in energy prices, and that's going to cure inflation. I think inflation it may not run at 8%, but 6, 5, maybe 4, and I'm talking about over the next several years. And so it's 2% is a number that we can't get to, at least how we're looking at the world.
Go ahead.
Thanks, Jim. Rob Collerino with AIAC Group. On the other side of oil, I'll maybe speak a little bit about ESG and actually in particular defense and aerospace. I think that's one that was sort of non-ESG, and then post-Ukraine, Russia has become very needed. Also just things like food distribution and disaster preparedness. So we have some investments in that space, but I'd be curious if there's a panel comment.
Yeah, I mean, I'll take it. I think ESG is important, right? I think we all realize that we need to do something about climate change. We need to do something about diversity, inclusion, the social causes, all of those kind of things, right? Where I think ESG becomes a problem, in my view, is it becomes a checklist, right? And the checklist kind of keeps changing. Just like you said, something was bad before is important now, right? Energy was, fossil fuels was really bad. Nobody's kind of questioning the need for investing in renewables and growing that, but we're not going to get complete elimination of fossil fuels in the next year or 2 years or 10 years, right? So there has to be a transition strategy. So again, in my view, whenever you treat ESG as a checklist, that's a problem. When ESG becomes a product label, that's a problem. When you're thinking about ESG more holistically as an integration of your investment strategy and thinking about, evaluating the pros and cons, evaluating the good and bad, and other tertiary effects that happen that are caused by your decision, I think that's the way to go for it, right? So, again, if you thought about what's happening in the energy field, and going back to your question as well, right after the Russian war started and the energy crisis was upon us, none of the public companies announced any new production initiatives, right? We actually on our side, on some of our private investments, kind of went and approved some add-on investments to build more production capacity. So private investments can do these things much better and can be much more nimble. Unfortunately, on the public sides, some of these things with a lot of activism that is going on, it's harder to change and it's slower to move.
We have 2 more questions. Just gentleman over here.
Hi, I'm Keiichi Aritomo from FinCity Tokyo, extension of Tokyo Metropolitan Government.
Speak a little bit louder if you could.
Okay, I'm from Tokyo Metropolitan Government. So I have been listening to different panels and noticed that nobody talks about Japan, right? I have hearing that
you're feeling a little lonely, a little left out.
India, China, even Indonesia, Philippines.
Where is Tokyo again? Where is that?
Yeah, Tokyo is 51st
it's an island
state
nation,
of
right? Or something?
United States. No, I'm just kidding. But our mission is to turn around Tokyo as a financial center and enhance investment ecosystem. However, are we irrelevant, or we are still the 3rd largest economy in the world?
Yeah.
And one of the most democratic jurisdictions, at least in Asia.
I'm going to direct this to Mark first, Mr. International here.
Well, I don't know if everyone knows, but Tokyo, Japan's just allowing tourists in, right? And the most favourite place to go skiing is for Australians is Japan, and we're thrilled. So in that sense, it's a fantastic country. But yeah, I think it's been for a whole range of reasons. It's surprising we haven't talked about Japan, because Japan has great opportunities, and we're seeing it, right? We're seeing improving corporate governance, we're seeing great valuations, we're seeing great examples. But even if you don't want to invest there, you should also have a look and think about the demographics. there's been a thesis that with the demographics, the aging demographics, it's inflationary. And it's interesting, Japan is a bit of a leading indicator that maybe this is beginning to emerge. So Japan, I think, is an important market. You're absolutely right, it's a big market. And we should talk more about it. And if you look at some of the things that PE, great list of managers are doing, there's ways to make money in Japan. I think even Warren Buffett's on the record, right? And he's done very well up there. And so for some reason, it's just dropped off the radar temporarily, I think. And so yeah, we should talk about it.
So it sounds like a little bit of guilty conscience. You should have been paying more attention to Japan, and you're going to start going forward. Is that right? Something like that? Anyone else looking in Asia with Japan or no?
I would agree with Mark that there are very interesting opportunities in Japan. We've looked at some office real estate opportunities there. I think for us, one of the key risks was monetary policy. Their inflation rate has stayed lower than the West. They've been obviously much slower to respond, and but if that were to happen, it would be a very, very sensitive input into valuations, and so that's something that we're a little bit nervous about.
Okay. All right, one more question. Anybody? Yep, here we go. Final question. Make it a good one.
Building the investment team, formulating the investment process to cover the proliferation of asset classes, sub-asset classes, having some degree of domain expertise to be able to compete.
Okay. Go ahead, Mark.
Yeah, look, I think that's a crucial question. One of the number one questions for institutions is creating complexity in the portfolio. So we love diversification, but complexity. The example I give, I used to run the future fund, the sovereign fund, and we started with 60 billion of cash at the bottom of the 08 market. Beautiful. And then you build the portfolio from there, you make a lot of money. And I used to say to the team, we've got to stop complexity, because complexity is like a boat, right? You stick the boat in the water, and if you don't take it out and clean it, it starts to slow down because barnacles get on it. And I see a lot of funds getting a lot of diversification, doing lots of stuff, and there's complexity there. Then you get tail risk. You get PE holdings that you've still got to deal with after the event, and you can't hire good people just to do that, right? So there's a whole bunch of issues there. It's very hard for us to get high caliber people, and so then that gets to your investment process. Is the process levered up to the points of things that really matter, and do you outsource other stuff? Do you manage that in an efficient way? And I think in a debate we've had is that if we have 4 or 5 great investors in a large institution who are driving the place, and we pay them more, they'll carry the rest of the team with them better. If we spread all that money out across everyone and pay no one anything, then we'll have a really average output. So process inside institutional investing, I think, needs to be really revised and thought about a lot, because I think the bull market's carried everyone, and the next stage, your technique is going to be the value add, in my view. Yeah.
Okay. Why don't we end it with that? Thank you, Mark, for their full perspective. Final word. Thanks, everybody, and thank you, Mr. Chair. Thanks, everybody.
Okay, so we have a speaker now that from our last panel who's doing double duty, Jay Madia. Where did they just go? Oh, are you doing the... Sorry, give us 1 second. Do you want to do the... Okay, they like to keep me guessing here. Okay, so can I have your attention, everyone? Sorry, I know we're moving quickly through the program, but so I want to welcome back Jay Madia to the stage. He was just our last speaker doing double duty here. Jay is head of risk assets for Axis Capital, which is a global insurance company with $15 billion in assets under management, and he's going to be interviewing Kip DeVere, speaking about credit. Thank you.
Thanks, Katie. So before I introduce Kip, and I know he doesn't need an introduction to most of you, I'll just share a story with Kip and then maybe just another story about Ares. So you guys might not know that Jim and Bruce were kind enough to share the content of this conference with some of the local secondary schools in the area, one of which is a school that you know quite well. So I was actually speaking to some of the teachers. I was also speaking to my daughter, and I was telling my daughter, oh yeah, you got to watch this, and you got to watch GEF, and it's so exciting. And of course, everybody wants to watch Ray Dalio. So I kept trying to nudge her towards this panel here, and finally she turned to me and she's like, Dad, what the heck is private credit? Okay, so we have a little bit of a challenge, but hopefully we can cover that. And then one other story I'll just kind of share to kind of introduce Ares and to introduce Kip is there is a BDC in the public market called ARCC. If you looked in an academic textbook, what would be a higher return over time? Would it be credit, which is more senior, or would it be public equities, which is more junior? And I think most people would say equities are going to have a higher return over time than credit. If you look at the performance of ARCC, which is a purely credit-oriented vehicle from Ares, since 2004, the return has been 12% versus 9% for the S&P 500. And so that's just, and I think that's potentially one of the reasons that Ares has grown into a $330 billion AUM firm. So now to introduce Kip. Kip is the co-founder, director, and head of credit at Ares Capital, and really pleased to have you here. Thanks for your time today.
Happy to be here. Thanks so much, Jay.
So why don't we dive in? We've heard from other private credit panelists today. Kip, would you mind maybe just sharing with us what makes Ares different? And I know you guys have grown into other asset classes aside from just direct lending.
Yeah, sure. And you had to leave us last for the day. Huh?
Right. Not my choice.
No, I'm kidding. Everybody's always asked about competitive differentiation and advantages in the space. We like to keep it pretty simple in the private credit space. We've been in the business together as a management team, kind of 4 of us that are now surrounded by another 300 that we've largely hired over the course of the last 18 years. But consistency of team, consistency of approach, collaborative team that's been together a long time is really first things first. And what that allows for us to do is, we think, build more substantial origination engines. So we think we see better deal flow than most, if not everybody. We have some of the longest relationships in the space with those origination channels. And that's all important, although we're getting into a stage in the market, it sure seems, where the asset management, the risk management side, the portfolio management side is going to be increasingly important. And I think we've put more resources against that as well. So if I just think about the full spectrum of originating deals and being competitive and frankly being likable and building relationships, that continues all the way through the asset management process. So scale of capital, size of team, breadth of approach, and frankly, it hasn't changed very much. We've been fortunate because we've just continued to get larger over the last 18 years, and it's one of the few investment businesses where it's actually easier the bigger you get.
Now you've gotten larger, but you've also broadened the type of offerings that you have. Can you just touch on that a little bit in terms of the different strategies?
Sure. I mean, I've got a bunch of Ares people in the audience who will correct me when I'm done, but rough numbers, we have about $225 billion in our credit business. Okay. Only about $45 billion of that today is actually in CUSIP stuff, so loans, bonds, CLO paper, et cetera. The other 180 or so billion is the U.S. direct lending business, which we do in a whole handful of ways. Started like many did as a sponsor coverage business, but it's really diversified into going direct to company, to families, to entrepreneurs. We built industry verticals in each of these places where we have a tech and software team, we have healthcare and life sciences, we have oil and gas, power, project finance, you name it, to just keep trying to get broader and broader. The business in Europe, I think, is a very clear leader. We started that back in 2008. One of my partners and I spent a lot of time in London and in Europe from kind of 2008. I spent a lot of time there in 2012 to make sure we were getting it right, and have built a pan-European direct lending business there with a headquarters in the UK, and you'll keep hearing this from us, amount of people and amount of geographies is important. There we're in Paris, Stockholm, Frankfurt, Amsterdam, and Madrid, and just bought a business a couple of years ago called SSG, which we now call Ares SSG, which is our Asian direct lending business.
Okay, that's great. So just moving on to the current environment, when we were all together here last year, Kip was asked, how is your portfolio faring during the pandemic? And of course, the world was coming to an end, everybody was scared, the markets were extremely volatile, and private credit portfolios across the board were marked down about a point. Right? Now it turns out that things were just fine in the end, but fast forwarding to today, we have sizable problems just like we did last year. We have inflation, we have geopolitical risks, we have rising interest rates. How is that affecting your portfolio?
Yeah, I think just we were marked down a whole lot more than a point in Q2 of 2020. That was really an extraordinary period. Frankly, that was much more disruptive than the environment we see today. We try to position our lending activities for the most part into industries and into companies that we think are defensive, that we think hold up well during difficult environments. Guess what? I think we're either in or entering a much more difficult environment, so we positioned ourselves the same way. We see substantially fewer non-accruals in our portfolio today than we did back to the spring of 2020. The watch list is substantially smaller, and while we're actively managing assets and trying to be conservative about where we're headed, the period that we're seeing with our portfolio companies today is not remotely as disruptive, frankly, as the first, second, and even third quarters of 2020 was. That was just something that we couldn't have expected, frankly, didn't show up in any of our underwriting memos. Whereas now, the things that we're experiencing in companies, and maybe I'd asterisk it away from this inflation, which is new for many of us in our careers, it's the same story. You have a tightening of monetary policy, which makes servicing debt harder. You have a slowdown in demand in a whole handful of industries, even those that are the most defensive. And our expectation is that we'll see an increase in defaults in our market, in all of the credit markets through the back half of this year and into next year. And earlier in the year, there was a real hair on fire feeling in the public markets that I think may still be there today. But to answer your question directly, the credit quality in our portfolio is pretty good right now. Do I expect them to remain as good as they are today in the future? Probably not, based on some of those surrounding factors.
Yeah. No, I hear what you're saying. Just to challenge that a little bit, do you think the problems are? Do you think the credit quality is good because your LTV ratios are so strong, but really the underlying problems are in the private equity deals underneath, or?
Yeah, I mean, LTV is, you got to be really careful, right? Just because, and I'll take our LBO financing business, right? when a private equity firm pays 24 times cash flow for a company because interest rates are very low and that's where the valuation environment is, that doesn't make us feel better about over-leveraging companies. I mean, it gives us, I guess a little bit of comfort that we have other smart people engaged in that transaction who have, substantial amounts of capital that are subordinated to ours. But at the end of the day, when things go wrong, that equity is not always there. The good news is we've seen that it has been. It was in a massive way through COVID. I mean, I want to say our BDC alone did something like 75 or 80 amendments out of 400 portfolio companies in Q2 and 3. And every single one of them came with fresh private equity coming into those transactions. So that's huge amounts of support. But I think that's also the equity support that's saying, I have the option to continue to own this business or not.
Yeah.
I'm hoping COVID is reasonably short, and 18 to 24 months from now, that option proves to be very valuable. So we spend time on LTV, but to be honest, we spend much more time on company selection, evaluating management teams, thinking about leading and structuring our own deals, thinking about cash flow, in middle market names, thinking about covenants than we do necessarily the LTV. But I think your point's a reasonable one. The problem now is we see that being eroded, right? When rates go up, valuations come down. It doesn't matter if you're a real estate owner or you own companies or anything else we own. It's all worth less. That doesn't take my leverage multiple down at all.
And you mentioned that if they want an amendment, they have to put in fresh equity capital. So that's part of that relationship between you and the private equity firms. Can you just talk about that relationship for the audience's perspective? What's it like to be inside that room when you guys are having those discussions?
I mean, you're asking about competitive advantage, and it works most of the time.
Yeah.
And just to be clear too, it typically is only the case if a company's running out of money. So folks are always saying, what happens with a company that's offsides on a budget and they have a covenant default, what do you do about it? More often than not, we'll charge a fee, we'll amend pricing, and you move on. Right? Just those standard, not capital D defaults are pretty common in leverage finance, and you just sort of handle them. But the way that you handle them with private equity matters. It's all about repeat business there. And we've been doing this with the same firms and many more with the same group at Ares for almost 20 years. And the way that we handle people in good and bad situations, to your point about putting ourselves or yourselves in that room, is it's very delicate because I'm driving an origination business that needs new deal flow, but I'm not allowed to do that if it's creating bad fundamental performance for our investors. That's challenging. And figuring out how to juggle that over time is one of the key kind of elements, I think, of our success.
And then on top of that, you also have volatility in the public credit markets, right? The leveraged loan market, the high yield market. Do those markets ever get to a point where you tell yourself that they might actually be more attractive at a point in time than what you're doing in your portfolio?
Yeah, they did for most of the year.
Okay.
For most of March to at least September. In our lending business on the private credit side, I actually think we were one of the first people to pull back in March, because we do have a pretty substantial, as I mentioned, loan and high yield business. We also run distressed money for investors. So when you see that kind of a correction, you have to think about resetting the deals that you're doing in the private markets, because again, what we get paid to do as private credit folks is hopefully generate higher risk reward transactions. And if we've been able to minimize losses in doing that, we can attract more capital. If we're not generating that premium in the illiquid markets, no one's going to want to invest with us because they can buy bank loans or they can buy high yield or they can do whatever else that has daily liquidity. So we reset pretty quickly. We scratched our heads, frankly, a little bit throughout most of the late spring and summer around why our competition in that business was not quite as quick to pull back. And I think the good news is today we find ourselves with a relative strength of capital, and we also didn't book a lot of new assets from March to call it September that we'd be writing down this quarter because they were done inside of the current market. But that's fair. I think that lens into the public and private markets is very important. We're believers that another advantage that I didn't mention is the strength of our platform and the fact that we have a global view in different markets and different geographies.
That's really interesting. And then, when you look at new originations, are there certain sectors based on today's environment that you like more or are avoiding?
It's another hallmark of the philosophy. The answer is yes, and it's been the same for a long time. So you'll find that in most of our portfolios we have overexposure to things like healthcare services, certain aspects of business services, technology and software, companies that have pretty inelastic demand curves and generate good cash flows regardless of the economy around us. And it's one of the benefits of not being a benchmark investor. We can completely avoid industries. And if you actually go through the corporate indices and track defaults, most of the defaults happen in 6 or 7 industries.
Yeah.
Oil and gas, retail, et cetera, et cetera. So if you consistently underrepresent yourself in those industries, and it sounds stupid and simple, but it's what we've been doing for a long time. If you under-index those indices, you tend to do better than the mean.
Yeah.
So we're doing the same thing, probably with even more caution than we have for 20 years.
Yeah, that's interesting. And so when you think about the competitive environment, so Ares versus, I think there are a handful of other large firms that are at that same scale. Obviously, there are a lot of smaller private credit firms. What is competition like these days? Has it changed at all?
Not really.
Yeah.
The business is institutionalized a lot. I think one of the differences for us is, and some people may know this, some may not, we're happy to finance a $10 million EBITDA company in our U.S. business, and we're happy to get involved with, we've got borrowers that have 400 or 500 million of EBITDA. And we come at it with a pretty flexible set of products. So senior loans, unitranche, junior debt, we make equity investments and all of that. So I think that flexibility is also something that widens the fairway for us. Most of our competition is a little more narrow, not all, but most, where they have an inclination to either focus on larger company unitranches, where they're focused on junior capital, or they're focused on non-sponsored deals only. So I think one of the things that we've always emphasized is being as broad in our approach as we possibly can.
That's interesting. Maybe just stepping away from the U.S. for a second, I know you have sizable presence in Europe. How do you, you're aware of all the challenges going on in Europe currently. How do you view the opportunities in Europe versus the U.S.?
Yeah, it's a hard one. I'm not sure I know quite yet. My inclination is to be more cautious about what's happening in the UK and probably Germany in particular. We're really in what we think of as in Europe healthy companies and healthy geographies. So we're not out, financing bankrupt golf courses in Greece, right? I mean, that's sort of not what we do. But of which there are a lot.
Right.
And in Portugal too.
A lot of people financing them, or a lot of bankrupt golf courses?
A little bit of both.
A little bit of both.
Yeah, a little bit of both. Yeah. So it's sticking with that strategy of good companies and good geographies. That being said, I think that the U.S. is not the problem relative to Europe right now.
Yeah.
You should be seeing wider spreads in Europe, but you're not going to see that until defaults are up. And I think some of the current fundamentals there, whether it's the lack of natural gas in Germany and
so we haven't seen the wider spreads yet.
I don't think we've seen them yet.
Okay.
The issue that we have today, Jay, is in both markets, deal activity's slowed down a lot. So one of the things that the current environment's done is it has just slowed transaction activity. Yeah. Equity players are trying to reset what's an attractive valuation, and lenders are having to reset where you can finance companies. And unfortunately, some of the folks who work for us who are younger than I am are still getting models from folks at private equity firms saying, I used to be able to borrow 7 times in a company like this. Now can I just borrow 6?
Yeah.
And you're like, you still can't do that. And they're like, well, why not? And we're like, well, because if you look at your model, your company can't make interest payments.
Yeah.
Right? Because the cost of financing is that much higher.
Yeah.
So there's just a little bit of a resetting of everything right now, which is fine from my perspective and pretty healthy, I think.
Quick one on second liens. You do have quite a bit of second lien exposure in some of your products. Is that an area where you're being any more cautious these days given the market, or is it just business as usual?
Not really, not to sound cavalier. I mean, I think the opportunity today is that a lot of the second lien we do is in these bigger companies. And their alternative is the high yield market, which is not open today to basically anybody but a double B corporate issuer. So I think the market for folks like Ares, and we've been developing that now for years, is as wide open and as attractive as possible. So I don't want to sound cavalier about seemingly taking more risk, but we actually kind of like to risk on a little bit when there's less capital. We find less competition, and your notion that our competition might be scared of that today actually makes us sort of enthusiastic about being in that market.
That's great. So just stepping away from core direct lending for a second, asset-backed lending, or ABL, that's another area that Ares is focused on. Can you just talk, sort of high level about the benefits of that type of lending versus corporate lending, and what might be more attractive today?
Yeah. So we do have an asset-backed lending business that lends to companies, but what we're actually more focused on is a business that lends to asset pools.
Yeah.
We're calling it alternative credit because we couldn't think of a better name, but there's a lot of debate internally as to what we should call it. That was my choice, by the way. People can either like it or not like it, but I broke the tie at the end of the day, I think. Our thesis there is actually pretty similar to the thesis around corporate direct lending from a long time ago, which is if you're if you're Hertz and you need to do a securitization of rental fleet, you go to Bank of America, you get a deal rated, and you sell it to investors. It's not that complicated. If you're not Hertz, i.e. a smaller player in that space, what used to happen is you would go to the same bank, B of A, Wells Fargo, whoever, and they'd say, well, that's not a big enough deal that we can actually underwrite it, rate it, and sell it to investors. We'll just wave it on and we'll hold it on the desk. So all of these highly leveraged trading pools at banks that used to exist to basically play the securitization market are gone. The banks have been regulated out of those businesses. And some other folks who used to do it pretty actively, whether it was GE Capital or CIT or either, or just not what they once were, not active in those businesses. So thinking about the underlying assets that we're financing, consumer assets, lease payments, royalties, almost any secured cash flow that generates cash without actually being a company. Yeah. And what's great is we can come in and we can buy all of the assets, i.e., be the portfolio buyer / equity owner. And we think as we go back through the research and look at the composition of that market, we think it's a $3 or $4 trillion market. And we've got roughly 20 billion of assets against that opportunity today. By the way, that business has grown 100% a year for the last 5 years in a row because we think there's a massive market there. And we've been fortunate because we've been able to go out and hire a lot of people. No surprise, most of them have come either from hedge funds that are no longer in the illiquid asset business or large banks that no longer have principal trading desks that actually will play these types of names. So we think it's a super exciting opportunity. And again, the parallel is used to be bank business, senior secured cash flows with short duration, high income, covenants, security, and an unbelievably high velocity of capital. So we've done a lot of education for our investors about why we think it's an exciting place to play. But I think there's a lot more to come.
And just have to ask the question on that. I know on the corporate side, if there were a default and you were forced to take the keys, you guys would be equipped to work that out or to handle that. Do you have that similar bench of talent on the asset-backed side?
It works almost exactly the same way.
It does, okay.
Yeah.
Okay, great. So last question for you, Kip, before we open it up to the audience is, can you just give everybody your macro views? No specific questions, just what's your view on macro right now?
Yeah, man. We've all been joking around that the crystal balls in our offices are not quite as clear as they sometimes are. I mean, so we touched on this a little bit. I have more concerns about Europe than I do about the U.S. Okay. I actually think the U.S. will either, in an attempt to get inflation under control, create a very slow growth environment and/or a modest recession. And with higher rates to do that, we're going to see depression in valuations, and that's the stock market, real estate, private companies, and everything else. And like most credit cycles, you're going to see defaults go up. I think most of us can handle that, right? That's like manage through, get through, set a new baseline, and hopefully start to grow from that. And the question will be how the Fed responds in terms of policy on rates. The fear, and I don't really see it, the fear, as I was talking to one of my partners about earlier today, is that the Fed continues raising rates 200-300 basis points because inflation just won't come down.
Yeah.
And you get a base rate to 5 or 6%, which will bring enormous stress/distress to the corporate and real estate markets, and then inflation doesn't come down in line.
So would you agree with what I said before, that it's probably better to have the recession so that that scenario doesn't happen? Yeah.
I would.
Okay.
Yeah. You know, Europe's trickier, and I think Asia's a whole different ball of wax, frankly, in terms of the impact that it's had from COVID. I mean, we've got about 150 people in Asia right now. It's been a really difficult couple of years for them.
Yeah.
I mean, partners of mine have been coming over to New York and then having to go back and, you know, live in hotels for 10 days before they were able to go home. We're all fortunate to be here. I mean, they're experiencing life still pretty differently than we are, so we'll see. But again, I'm concerned. I'm thinking more with my risk management hat on than I am with my growth hat, but I'm not in sort of a hair on fire feeling that the world's coming to an end or anything like that.
That's great, thank you. So I think we have time for at least one from the audience. Makiko?
So you went through great financial crisis, and your financial institutions, including similar companies like the balance sheet issues and credit issues, and they all had the credit market frozen and all that. Do you feel the financial industry is a lot healthier looking at the competitors and what they have on their balance sheet? And because I feel like for the economy to completely melt down, like you were talking about, with Fed to go up by 100 basis points or more, I feel like the financial industry is healthy and may be able to withstand. And do you see the big difference?
My simple answer is I would agree with you, yeah. The good news is that the banks are in a much different position in terms of their health. The way that most assets are financed these days are financed more conservatively by longer term holders of those assets. And what really happened back during the GFC, in my mind, was more of a banking crisis created by forced selling. Some very highly leveraged, you know, large institutions, but also institutional investors, whether it was, you know, everybody always says it's subprime, but it was corporate credit too. It was a little bit of everything all at once. Without good term financing, almost everything that we have today is less leveraged and longer financed in terms of the liabilities that we put against them. And I think we were one of the best in class during the GFC as a firm that never really used TRS to buy assets. You know, we weren't buying 3-year assets with 1-year financing. It's something that our firm, I think, has done better than many, but most have caught up and learned the lesson from that period of time, which was pretty difficult.
Do we have time for one more question? No, we don't.
No.
We don't. Well, with that, thank you very much, Cathie, for your time. Appreciate it.
Thank you, Bud.
Break, but we have a quick raffle to do right now. So, can we get this mic? Oh, you can hear me. Okay. Who do I give it to? Stay in the room if you want to win. So this is the raffle for the Liverpool Football Club signed jersey. So it's signed by the whole team. If you have dropped your card there, now is the time. So we're gonna call the person twice. If it's not here, we're gonna draw it again. Okay? Matt Walsh is our head of sales.
Okay, the winner is Diana Quach of Gopher Asset Management. Is Diana here? All right, someone else getting it. On to the next one. Sorry, was that a little harsh? Anil Dewan. Is Anil here? I'm going to mispronounce it. Nanoveracides. Nope. Okay. Still going. Douglas McGrath from Wafra. Doug. I see him. He's coming. All right. He's running. Oh, he's your boss. It's all right. You get the picture, though. All right. Enjoy. Thank you.
Okay, thank you. We'll give you until 3:30 for the networking break, and we'll see you back here at 3:30. Oh, sorry. Is it 3:30 now? Okay, we're giving... that said 3:30, so we're giving you another 20 minutes.
Ensuring a bright, bold future means investing in tomorrow, today. And Apollo is at the forefront. Our capital is helping to solve some of the world's most complex problems by securing retirement for millions of families, building and financing stronger businesses, and driving a more sustainable future for our communities. Bridging our economic present to our future. Empowering people to retire better, from teachers to firefighters and other essential workers, Apollo is creating retirement solutions for millions of families. We're investing across sectors and geographies to create jobs and support local communities, and partnering with businesses large and small to fund their growth and enable transformation. As we look to new generations, we are committed to making progress and to developing a more sustainable future as a leading capital provider accelerating the energy transition. From development to production, all the way through to consumption. Building a better future also means expanding opportunity across our ecosystem. It means deepening our relationships, broadening our network, and developing new connections every step of the way to better serve our investors and our communities. Through it all, consistently challenging convention, sparking new ideas, and fueling innovation. At Apollo, we are investing in tomorrow, today.
Since 2017, Surfin Group has invested across 3 continents, which are Asia, Latin America, and Africa, with 20 million users in 8 countries and a total transaction volume of over $2 billion. Surfin invests digitally. Surfin Group focuses on digital investing to empower financial services and asset management globally. Surfin Group processes and develops tens of terabytes of data, hundreds of big data models, millions of feature vectors, millions of effective product models, and asset allocation portfolios. Surfin has global risk management experience. Surfin Group delivers risk management expertise in global asset allocation and investment. The investment and technology can be efficiently married by individually matching of dynamic asset allocation portfolio based on big data and personalized efficient frontiers, integrated with multi-asset classes, multi-trading frequencies, and multi-strategies through risk parity allocation. Personalized and diversified portfolios can be constructed to provide scalable asset allocations and across various market cycles. Surfin Group also develops a fully functional and convenient digital integrated wealth management platform across borders and different markets, which can provide middle-class customers with digital smart financial services, including news and information, user forums, investor education, investment advisory, and financial planning services to enhance global investment experiences. Surfin Group develops 4 proprietary core technology systems that enables real-time online accessing, multi-ethnic group matching, and global multi-country servicing. Intelligent Risk Appetite System, EKYC System, Big Data Behavior Analytics System, AI Smart Voice System. Surfin Group looks forward to seeking mutual benefit and win-win cooperation with various partners to develop an ecosystem to invest in emerging markets. Surfin Group has always been persevered, persistent, and passionate. Surfin shall stay focused and strive to serve more global investors with digital technologies and making life better with smart, open finance.
XPO, your freight first.
Over 250 million young people are not in education, employment, or training. But how you start in life shouldn't determine what you do in the future. In the last 3 years, Future Makers by Standard Chartered has supported more than 650,000 talented young people from low-income communities, transforming lives by empowering them to learn, earn, and grow. Because where others see problems, we see potential. We're Standard Chartered, and we're here for good.
What if you could invest in private equity, real estate, private credit, even art, with clarity, confidence, and help when you need it? Meet Yield Street, the leading platform for private market investing. We believe that private market alternatives like real estate, private credit, and art should be a fundamental part of your portfolio. In fact, investment professionals recommend allocating at least 20% of your portfolio to alternatives. So how can alts create a more efficient portfolio? Versus traditional investments, alts reduce risk while maintaining your expected returns, or maintain your risk level while potentially improving your expected returns. We talked to actor and former White House staffer Kal Penn to help explain private markets.
If you're watching this video, it means you've been wondering, what are alternative investments? And why are all your savvy investor friends talking about them? Or maybe that's gonna be you right after this video. So, alternative investments are basically anything beyond the stock and bond markets. You're probably most familiar with real estate. I know I love places. A beautiful resort. Or maybe just an office far away from your perfectly behaved children. There's also private equity, venture capital, and a few more that aren't as mainstream, like art and crypto. Basically, lots of cool things to discover. When you put alts in your portfolio, you're helping to ensure that you have investments that don't always follow the ups and downs of the stock market. Yep. Here we go again. That, my friends, is called diversification. In addition, people like alternatives because they can generally outperform the stock market. So, how can you get started? Before YieldStreet, you probably would have had to pony up $1 million and tie it up in a single investment. Yikes. But now, the potential of private markets is at your fingertips.
Thanks, Cal. With $3 billion invested on the platform and almost $2 billion in principal and returns paid to investors, and 9.6 realized net annualized returns, isn't it time to diversify away from the stock market? Invest in curated private market alternatives from top managers, all on one easy-to-use platform. Evolve your wealth. YieldStreet, private market investing.
MFA exists to serve and represent the private fund industry, and we do this through advocacy and convening our members to address key business and operational issues.
And so the MFA is a phenomenal partner of resources and peer groups and forums that comes together.
And this ability to bring people together is just so important because it just makes me better, it makes my team better.
What the MFA does is the MFA sits firmly in the middle and is ensuring that as they take the inputs from the regulators, take the inputs from the policymakers, and then take the inputs from the manager, that feedback loop that they're bringing is going both ways.
If we have a growing and active membership, that provides MFA in the industry with more resources, more credibility to better advocate for those policy outcomes that support the industry's growth.
So when you join it, you're not joining an association, you're joining a group of peers that have common interests and really want to help you succeed.
There's no downside. It is truly all upside when you become a member of the MFA.
Surf in with waves of digital financial technologies. With the rapid development of digitalization and globalization of financial markets, Surfin has always been driven by digital technologies to invest globally. Surfin Group specializes on two major areas: digital finance and technology empowerment. Since 2017, Surfin Group has invested across 3 continents, which are Asia, Latin America, and Africa, with 20 million users in 8 countries and a total transaction volume of over $2 billion. Surfin invests digitally. Surfin Group focuses on digital investing to empower financial services and asset management globally. Surfin Group processes and develops tens of terabytes of data, hundreds of big data models, millions of feature vectors, millions of effective product models, and asset allocation portfolios. Surfin has global risk management experience. Surfin Group delivers risk management expertise in global asset allocation and investment. The investment and technology can be efficiently married by individually matching of dynamic asset allocation portfolio based on big data and personalized efficient frontiers, integrated with multi-asset classes, multi-trading frequencies, and multi-strategies through risk parity allocation. Personalized and diversified portfolios can be constructed to provide scalable asset allocations and across various market cycles. Surfin Group also develops a fully functional and convenient digital integrated wealth management platform across borders and different markets, which can provide middle-class customers with digital smart financial services, including news and information, user forums, investor education, investment advisory, and financial planning services to enhance global investment experiences. Surfin Group develops 4 proprietary core technology systems that enables real-time online accessing, multi-ethnic group matching, and global multi-country servicing. Intelligent Risk Appetite System, EKYC System, Big Data Behavior Analytics System, AI Smart Voice System. Surfin Group looks forward to seeking mutual benefit and win-win cooperation with various partners to develop an ecosystem to invest in emerging markets. Surfin Group has always been persevered, persistent, and passionate. Surfin shall stay focused and strive to serve more global investors with digital technologies and making life better with smart, open finance.
Ensuring a bright, bold future means investing in tomorrow, today. And Apollo is at the forefront. Our capital is helping to solve some of the world's most complex problems by securing retirement for millions of families, building and financing stronger businesses, and driving a more sustainable future for our communities. Bridging our economic present to our future. Empowering people to retire better, from teachers to firefighters and other essential workers, Apollo is creating retirement solutions for millions of families. We're investing across sectors and geographies to create jobs and support local communities, and partnering with businesses large and small to fund their growth and enable transformation. As we look to new generations, we are committed to making progress and to developing a more sustainable future. As a leading capital provider accelerating the energy transition, from development to production, all the way through to consumption. Building a better future also means expanding opportunity across our ecosystem. It means deepening our relationships, broadening our network, and developing new connections every step of the way to better serve our investors and our communities. Through it all, consistently challenging convention, sparking new ideas, and fueling innovation. At Apollo, we are investing in tomorrow, today.
Surf in with waves of digital financial technologies. With the rapid development of digitalization and globalization of financial markets, Surfin has always been driven by digital technologies to invest globally. Surfin Group specializes on two major areas: digital finance and technology empowerment. Since 2017, Surfin Group has invested across 3 continents, which are Asia, Latin America, and Africa, with 20 million users in 8 countries and a total transaction volume of over $2 billion. Surfin invests digitally. Surfin Group focuses on digital investing to empower financial services and asset management globally. Surfin Group processes and develops tens of terabytes of data, hundreds of big data models, millions of feature vectors, millions of effective product models, and asset allocation portfolios. Surfin has global risk management experience. Surfin Group delivers risk management expertise in global asset allocation and investment. The investment and technology can be efficiently married by individually matching of dynamic asset allocation portfolio based on big data and personalized efficient frontiers, integrated with multi-asset classes, multi-trading frequencies, and multi-strategies through risk parity allocation. Personalized and diversified portfolios can be constructed to provide scalable asset allocations and across various market cycles. Surfin Group also develops a fully functional and convenient digital integrated wealth management platform across borders and different markets, which can provide middle-class customers with digital smart financial services, including news and information, user forums, investor education, investment advisory, and financial planning services to enhance global investment experiences. Surfin Group develops 4 proprietary core technology systems that enables real-time online accessing, multi-ethnic group matching, and global multi-country servicing. Intelligent risk appetite system. EKYC system. Big data behavior analytics system. AI smart voice system. Surfing Group looks forward to seeking mutual benefit and win-win cooperation with various partners to develop an ecosystem to invest in emerging markets. Surfin Group has always been persevered, persistent, and passionate. Surfin shall stay focused and strive to serve more global investors with digital technologies and making life better with smart, open finance.
Companies of all sizes rely on us for world-class, less-than-truckload freight transportation. We handle our customers' freight as if it were our own, moving it across North America on a coast-to-coast network that covers 99% of all U.S. zip codes. When freight is put in our hands, it gets where it needs to go, safely and on time. Our customers are growing, and we are too, expanding our footprint and fleet and certifying more truck drivers at over 130 XPO driver training schools. And we're constantly enhancing our technology, creating new network efficiencies to ensure a world-class LTL shipping experience from pickup to delivery. With industry know-how, local knowledge, and the hunger to keep improving results, when you ship with XPO, you'll find that our people are committed to your success. XPO, your freight first.
Over 250 million young people are not in education, employment, or training. But how you start in life shouldn't determine.
Okay, welcome back, everyone. I know we still have some people straggling in, but we're going to continue on with our session. Come on in, have a seat. I want to welcome back Damian Sassower from Bloomberg Intelligence, who's going to lead a conversation on the new era of access in private market investing. Can you not hear?
All right. All right. All right. So welcome, everyone. I hope Hope you had a nice snack. We won't be too long, but what I am hoping to do is share with you some interesting information. I mean, look, I'm going to take my emerging market hat off, and we're going to talk about structuring, fund structuring, alternatives, and all the fun things that go hand in hand with that. So it takes me back to my 10 years on the buy side, and I can't wait to grill our panelists. Let me introduce Matt Brown over on the far left, founder and CEO of Kais. Milind Meher of Yield Street, founder and CEO of Yield Street. Anna Snyder, head of Manager DD at Bank of America. And of course, Stephanie Drescher, partner and Chief Client and Product Development Officer at Apollo. So welcome, everyone. With that in mind, let's begin. Look, guys, accessing the leading fund managers and alternatives has always been a struggle, right? Specifically from the perspective of small and medium-sized LPs. So take me through what you're seeing today. You know, Matt, I mean, is it still that hard to access top-tier talent, top-tier performance in the fund or fund structure that actually delivers it? Because as we all know, some of these fund families have grown significantly. They have many different vehicles, many different shells. How are you guys providing access to those small and medium LPs in today's environment? Matt, please. Oh, yeah,
Great,
sorry.
thank you. Is this on? Nope, there we go. Well, first of all, thanks for having all of us. This is not only a great panel, honored to be amongst this group, but also what a beautiful day in Greenwich here. So I thought before I answer you directly, I just wanted to kind of level set with the group here on kind of what the industry and the arena we're kind of playing here. So U.S. wealth management, meaning the amount of money that financial advisors manage in America, is $40 trillion. Quite a big number. Actually, if you were to add up the 20 largest wealth markets globally, they're still not that big. That number is going to go to 60 trillion by 2030. But what's interesting and why a lot of us are on this panel and very focused on this topic is that wealth management has an allocation rate to alternative investments today less than 5%, most likely 2 to 3% on average. While at the same time, institutional investors on average have between 30 or 40% allocated to alts. And that gap right now is closing rapidly. And as a result of that gap closing, and we can talk about the factors in a minute or two, is that there's going to be a complete reallocation of capital in the tune of $5 to $10 trillion coming into alternative investments from US wealth. That is an enormous amount of capital, and it's making wealth management the #1 pool of capital for alternative asset managers to target. So what we have here is this really interesting moment in time where people have been talking about bringing access to financial advisors or to end clients, but it is really actually happening now. The SEC is making changes to make it happen. Technology is driving that. Complete disappointment in the 60-40 portfolio. And then you have firms, great firms like Apollo, who are really innovating, creating structures and products that make sense for wealth. You know, they have the tone at the top from leadership that it's important, dedicating resources. So it really is an exciting moment. Happy to be here, and we're going to see a lot over the next 3 to 5 years in this space coming.
Thanks, Matt, for avoiding the question. No, I'm just kidding. No, so Milind, I'm wondering if you could just expand on that, obviously. You know, I know, you know, at Yield Street, what you're focused more on are the true alternatives. I mean, litigation, art, you know, real estate and other things. But, you know, again, it takes a fund manager that knows how to traverse that environment, you know. How do you view it? How do you, you know, advise that clients access it? And, I mean, how do you add that sort of ever elusive manager alpha when they're trying to do it so that they can make money over and above their benchmark and relative to their peers?
Yeah, absolutely. So first of all, thank you for having me, and it's a great panel here. So excited to be here. I think on the heels of what Matt said, which is the market and allocation of dollars is massive, and the gap between retail and institutional investors in terms of access to alternatives is also very massive. And so where Yield Street stands is we are a direct-to-consumer digital investment platform, and our thesis is that access to and distribution of alts is fundamentally broken, and the 60-40 portfolio is dead. So how do you kind of give access to people that need that access? And so that's really where we are focusing on education, the digital first experience. And what we are really saying is that you should look at a 360 view of alternative investments. And so what we have here at Yield Street is access to top fund managers, but also direct investments. And so our consumer is coming and saying, hey, I want access to that SFR portfolio within real estate, or that multifamily portfolio in Nashville, alongside top investment managers. So you have both those options available to retail investors. And we have 500,000 consumers on the platform that have invested over $3 billion. And the idea of that self-serve ethos has really accelerated since even when we started the company 4 or 5 years ago. And that is purely because consumer behavior has completely changed. Look at the power of iPhone in your pocket. You can do everything from hail a cab to find love. And so I think the financial services industry really is stepping up. Bank of America app and JP Morgan, just tremendous improvement in the last 2 or 3 years. And I think that trend is going to continue when people think about investing. And we know what Robinhood was able to do in the last few years in terms of getting new investors on the platform. So I think that's really where Yield Street is focused on, is that how do you create that digitally native experience and give consumers what they want.
So Anna, I mean, if you could expand on that, I mean, look, let's roll up our sleeves here. You're doing due diligence on managers each and every day. You're looking at the business risk, which can be upwards of 80% of the equation. I mean, forget the investment risk, forget the 60-40 portfolio. If you invest in a fund manager and he's committing fraud, or you haven't done the proper due diligence, you're a fiduciary, you're at risk. How do you protect the Bank of America from that? How do you protect your LPs from that? And what are you looking for when you're doing that, that deep dive into some of these fund managers today? And more importantly, with the top tier fund managers, are they even allowing you that type of granularity, that type of look through?
Yeah, I mean, so there are a couple of themes around sort of this access theme, and then how that intersects with due diligence. But the growth of alternative investments on the private client side has a huge amount to do with the 60-40 portfolio not doing it for people. I mean, though, to be fair, beta was a pretty good trade for the last 13 years. But yield, right, which is what people live on, they needed that. So so you have the banks, right, coming, pulling back a bit on credit, the private markets stepping in with that, and a whole new set of products that were created. So I can talk about how I do diligence on sort of GP, LP structures. Yes, I think fraud is certainly something that we don't want to have happen. But it's a failure to me if a manager doesn't meet their investment objective.
We'll call it benchmark creep. We'll call it benchmark creep.
Right. So most of our days are spent on that, and we have always received access, and I think that's gotten better over time, but we don't have a problem with access or transparency. If you're not going to give us access or transparency, down to, by the way, how many women you have in investment positions, and how that's changed over time, we're not investing with you. Right. So you fill out all the information, or you don't go anywhere else, right? So that's not been an issue for us, right? I know it was an issue probably like in the aughts when I first started investing in alternatives, but not anymore. But to go back to sort of this driver of alternative investments and the growth and where wealth management has come in, these private credit strategies, which are sort of, it's a new market for the private markets and a very new market for then people who haven't accessed alts, but that is where they're actually starting a lot of their access and have been because of the need for yield. And I'll talk about this in a bit, but doing due diligence on perpetually offered strategies versus GPLP structures in the private markets is not completely different. There's a other whole layer of things you have to know and consider, even above and beyond fees. Which again I'll go into in a bit, but that those things are amazing for this industry, and I think will help drive these open-ended, perpetually offered strategies. But there are a lot of risks embedded in them, especially in a market like this. So I'll talk about that in a second. Put a pin in that.
Well, Stephanie, let's take it from a different perspective, right? The demands that are placed upon you, upon Apollo, by investors, who have to conduct their due diligence. How has that evolved? How has that changed in recent years? And how's Apollo evolving with it.
Look, great to be here and to see everyone. And for those outside, you're really missing out. I know you can hear me.
We are serving drinks inside.
Exactly. So look, I think I've been at Apollo now for 18 years. Actually started my career at JP Morgan in the private bank, so saw the wealth side for the first nearly decade before joining Apollo in 2004. And I think the transparency and access to information has improved dramatically. And when we think about the arc to your earlier question of the early days where alts were principally designed and available to the institutional market, and that was the lion's share of access to the asset class. And at that point, if we think about the traditional definition of alts, it was also pretty narrow. Private equity, hedge fund, maybe some real estate. It wouldn't have necessarily included your reference to yield. And so when we take a big step back now and think about, is it accessible? Are kind of the individual investors getting access to managers like Apollo and others? I'll answer your question, yes. And importantly, it's not one size fits all. So I think what's pretty amazing and exciting about the industry right now is that we're not only delivering that best-in-class performance as it relates to what the institutions have been able to get over the years, but it's bespoke for this market, for families, for individuals, for the needs of their portfolios. And let's face it, that's different than your typical institution and what they face in terms of portfolio allocations. So I think it's not only getting easier to access, but the structures have evolved. And I know from our perspective that we're innovating, and it's not kind of what you've seen historically. Certainly kind of chapter 1 for the institution, chapter 2 kind of the REITs, the BDCs, which still have their place and are relevant, but now there's so much innovation that we in particular are focused on, and it's a lot of fun.
Well, I mean, Matt, why don't we expand on that innovation, right? The automation of subscription redemptions, performance reporting, data security, how KAIS kind of addresses all those issues and how it's really, evolving the asset class. But at the same time, you mentioned at the beginning here, alternatives are really underinvested in most people's portfolios. So, how does KAIS kind of improve that? How do you see that evolving? How do you see your investors responding to the service you're providing them?
Yeah, there's kind of been a 1.0 version of this, which is like any fintech company, which case is automating any manual process. But for those of you who, from a family office or a financial advisor or a pension you've allocated to alts, it's a very cumbersome process. We kind of break it up into 3 areas, kind of your pre-trade moment, your trade moment, and your post-trade moment. Your pre-trade moment is let's learn about it, let's make it easy to understand. And technology plays a really big role there. We can scale education on our tech platform to tens of thousands of financial advisors across the United States, and that's the first step, getting them fluent in alts. The trade component, where I think you kind of dug in a little bit, is really critical. Unlike a large pension fund that might stroke one check for $100 million to, I'll just pick on Apollo, which would be a very good place for $100 million to go, in my opinion. But if you're looking in the wealth management community, that might be hundreds and hundreds of individual investors. So that paperwork moment of filling out a 100-page subscription document. So what we've done is completely just automate it. Profile filled out once, subscription document inputted once, and it's really just a click and go moment. So if you make it easy for a financial advisor, at least from our perspective, it has an impact on how they're going to utilize alternative investments. And of course, you have that post-trade experience. Does it show up on your statement at your custodian? Like, these are very kind of plumbing and piping issues, but really making it easy, understandable, the way the mutual fund industry did for their products is where this is all going. I'll stop short of kind of tokenization. I know it's getting a lot of airtime these days. I think blockchain has an enormous role to play. I think it's actually probably even underestimated, but I think we still are a few innings away to see the industry transform to a point where an investor can, get a digital representation of the return stream of a fund. we have some time to go there. But just a lot of innovation in a lot of different areas. But making it easy and accessible have to be gonna go hand in hand.
Well, I mean, and education, right? I mean, so Milind, I wonder if you could expand on that, because I'm an emerging markets guy, and when I think about art and litigation and all that stuff, I think of, you know, the same sort of corollary I make to frontier markets, right? Yeah. I mean, you're living and operating out along the frontier. How do you educate investors about some of these more esoteric asset classes? How do you value, you know, a piece of artwork or a potential lawsuit? Like, how are you speaking with clients? How are you educating them on that front?
Yeah, I think the best way to do that is to actually sign up and experience the platform yourself. but in all seriousness, I think when you're running a direct-to-consumer platform, as Matt said, education plays a very, very important role. And I think what has happened is technology has given us tools to simplify the process than ever before. And so the question really is, what we've been able to achieve at Yield Street is that we have 7 or 8 different, you know, kind of big, you know, your food groups, so as to speak. So private equity, private credit, venture capital, frontier assets, and then real assets. That includes kind of real estate and art. And then within those food groups, you have various different strategies. And I think what we have really found is to simplify the message to the consumer and then meet them where they are. And so I think that has really been a very critical component for us. And so whether it's webinar or whether it is newsletters or whether it's like education series, consumers are willing to learn that. And that's really where we have found a ton of success. The other thing also is that the world has changed quite a bit, as I was alluding to earlier. Transparency is playing a very, very critical role. So when you actually get a text alert that says, hey, this fund paid X dollars, that's really affirming trust. And then when you can go on your portfolio and see dollars and cents transactions transparently displayed, that's really, really very, very important. The other thing what Yield Street has done is we've done over 400 investments across these food groups. You can go to yieldstreet.com/statistics and you can look at investment by investment performance. What was the target return, and then what's the actual return. 92% of our realized investments are within 0.5% of performance. So I think that really, for a direct-to-consumer platform, obviously is very important. Different, you know, dynamics for institutional investors, but I think for our consumers, that's very important to do. And I think that's really what technology has enabled us to do and connect with our consumers.
So Anna, I wonder if you could expand on that transparency theme, because we all know that, you know, the very best fund managers are hugely secretive in terms of protecting their secret sauce, protecting their positions, protecting their portfolio. So when you're conducting due diligence, you know, how do you get comfortable that whatever liquidity terms the manager's providing to you, or that you're able to negotiate with that manager, line up with their underlying holdings if you don't necessarily have that level of transparency? Or do you now? I mean, are you able to command that, and are they willing to provide it?
Yeah, so I mean, I'm not going to tell you that I have every holding from a global macro hedge fund at the end of every day, right? Like, so, and you know, that, but, you know, basically beyond that, right, I can get any set of, I mean, you know, under legal rules and regulatory rules, I can get every single holding any time that I want, because I might be a, you know, my clients might be retail investors, but I operate, you know, a $60 billion private markets platform. So I'm essentially an institutional investor. So if you would like to have any of our capital, you can give us that data. So it's not that difficult for us. Now, for the average, right, for the average advisor, right? So now I'm talking about, you know, and I sign NDAs and all, you know, so I'm talking about my role, right? And I'm a gatekeeper, because the individual investor and the individual advisor, you know, is probably not going to get that kind of transparency. So my, you know, in the spirit of education, my role is to sort of take all of the data and all of the analysis that I do and translate it into very simple terms about, here's what you can expect, right? Here's the risk and return that you can expect, and if anything is going wrong, I'm going to tell you. And, you know, and that's basically my role. It's a translation mechanism. So the transparency is really not an issue for our team. But it is, I think there is a fiduciary responsibility, and I don't think there is a fiduciary responsibility that I have to translate that in a way that's simple to understand, right, and makes the advisor, the financial advisor, right, and the client really, really comfortable with investing and the risks of investing. And I think probably one of my most critical roles is to make sure that, other than, you know, trying to tell an investor that, a long short hedge fund isn't going to be up, 50, right? Generally speaking, I'm sure everyone in here runs a hedge fund is, but it's going to be up 50 when the market's down 4, right? Other than that kind of simple education, it really is talking about, here's a vehicle. Yes, it's printing a nice yield. It looks like a great investment, but it has an option for liquidity, right? So yes, you can get 5% out every quarter until probably things get pretty bad in the market, and the minute you want liquidity is when you probably won't get it,
right?
Or when it's going to be strained. So it's that kind of education, that may not be the first things that managers start with when they're out in the field talking with advisors. That is really sort of my role, and that's like so. My issue is making sure that I'm as transparent with our end client, right? Not sort of the other way around.
So Stephanie, at Apollo, you're obviously dealing with investors of all shapes and sizes, but you really are dealing with some of the most sophisticated institutional investors on the planet. So when we talk about product innovation, I mean, I remember growing up in the business and it was, fees are so high, fees have to come down. Then it was liquidity, right? I mean, how do we align liquidity, make sure that what we're investing in, when we need our money back, they're not going to put the gates up and all that. What are investors demanding of you now? Like, what sort of new, face has product innovation taken? What are the sophisticated institutional investors, the real money community, what are they demanding of you? What are they demanding of Apollo?
Look, as we think about it, there are so many elements that are in common, actually, with the wealth clients, and then there are kind of layers of pain points that are more specific to one audience versus another. And look, as we think about across the board, certainly inclusive of the institution, but also to the wealth community, your point around transparency, access to information, which we're committed to and have been for a long time, the access to the investment capability and kind of the risk return profile, alignment, the ability to own what we own on our balance sheet, for example, or have a heightened level of not a guaranteed outcome, but a shared outcome is something that institutions and wealth clients alike are solving for. What we have focused on in a very focused way over the last, call it couple of years now, really kind of 18 months or so, are the pain points that, in addition to those objectives, are felt by families, by individuals. And when we think about it, the innovation, I believe, is certainly in our part very much focused there, where we can not only deliver alignment, but we think about how do we avoid capital costs, the J-curve. How do we think about tax reporting that people will want in terms of options of tax reporting and the like? And so we have mentioned publicly a particular opportunity that we call AAA, which is interestingly, I think, taking a step back on portfolio construction, an opportunity to actually serve as an equity replacement or a core private markets holding, but you start to have a different conversation with a client. And that, frankly, could be institutional, it could be wealth, but ultimately, you're solving their pain points and creating options in their portfolio that are desperately needed, given all the references to the 60-40 model and kind of the demise of the return profile that an investor is looking for. So our view is kind of take the best of what we've done for the institutional clients, but now make it bespoke for the wealth channel by layering on kind of the answers to the pain points that we've heard over the last several years now.
So Matt, I mean, let's talk about alignment of interest and how it impacts you, because a lot of the funds, obviously, or fund families, fund managers for that matter, have certain relationships with certain clients. They may have most favored nation status with one client. They may have a side pocket with another. There's a lot of structuring, mishigas, so to speak, that goes hand in hand when you're trying to convince yourself that these fund managers have your clients in their best interest, right? That they've aligned whatever they're doing with the clients of Kais. How do you get comfortable with that? Like, how do you make sure there's nothing, in the bedroom that they haven't shared with you, when you're bringing them on the platform?
Yeah, let me just kind of take us back 15 years, and I think that, alts are risky, or alts are illiquid, or alts are less transparent, or that really has changed so dramatically in the last decade and a half. That's very much a kind of a pre-financial crisis opinion. The institutional quality of the asset managers who are delivering alternative investment strategies, whether to institutions or to wealth management or to individual investors, don't even resemble the asset managers of the early 2000s or 90s. So just from that standpoint, the amount of transparency that's brought to the table. It's also one reason, and this kind of goes over oversight, why the SEC has really progressed in their thinking. You remember the SEC's view on alternative investments forever is, I really hope that you're very rich, because if you lose all of your money, we don't want you to come to us to complain. That was basically their mantra. Okay, guess what that mantra is today? I think the bar is too high, and we're excluding way too many people from the benefits of having alternative investments in their portfolios. So when the SEC is making moves like that and creating new lanes for investors to be able to get access, not just because they're wealthy, but maybe because of an educational background, or because of a license or a designation, or creating products that allow distribution to more mass affluent or lower accreditation, I think they're really saying is that the industry has matured to the point where it's a lot closer to how a regulated mutual fund will look than necessarily kind of your 1990s long-short equity fund that no one wanted to talk about what the secret sauce is. So there's been a huge maturity in the industry, and I think that's had massive impact. Look, having the right funds on a platform, we're a neutral platform, we're not a CIO, we're not an RIA, we're a marketplace, and there is a responsibility for a marketplace. We have a partner named Mercer who has to go into an institutional rating process for any product that goes on our platform. That's very fundamental and key. We did a Morningstar survey, and something over 60% of financial advisors and end investors don't invest in alternative investments because they don't have the resources to do due diligence. It's fascinating. Who would have thought that? I thought initially because it was kind of hard to understand. No, they don't have the resources, and as fiduciaries, they have to have those resources. So we kind of alleviate that problem. But again, the world is changing. As we keep saying, the death of the 60-40 portfolio, but what we're really saying is the birth of the three-dimensional portfolio, 50, 30, 20, and 20 being alts. And that's going to equal trillions of dollars coming into play. And that's why you're seeing a lot of the best asset management firms, the leading alts firms, staffing up and investing to be able to take advantage of that market share. It's a big opportunity for them as well. So these two communities, individual investors, either direct or through their financial advisor, and alternative asset managers, are now really coming to a point where they're connecting in a major way for all the right reasons.
So the death of the 60-40, I mean, we're hearing it over and over and over again, and I think that has a lot to do with, the correlation across liquid asset classes, right? So, I guess, Milind, my question for you is, talk to us about diversification. Is that still the selling point when you're talking about alternative asset classes, and specifically the asset classes that you're dealing with out along the frontier?
Yeah, absolutely. So listen, I think diversification is critical in any circumstances, and so we obviously encourage that. We actually provide tools to our end consumers to kind of understand how to build their portfolio so that they have wide access across the food groups that I mentioned. And I think frankly speaking, just to kind of take a step back and talk about asset managers, I think Matt and Stephanie, the points that they made is very important. Today's world, all asset managers of various different sizes are very, very willing to play ball in terms of the information that they're willing to share. And frankly speaking, if you look at the lens from a consumer standpoint, they don't want the nitty-gritty details. What they want is that they want an overall perspective on how that particular investment is behaving versus the, the nuanced details of, how is it structured and what's happening within the 10 positions that a particular fund might have. So I think that's very important for consumers and I think for the industry to understand. And I think then the last point I'll make around diversification and regulation is that SEC has, is taking a much more holistic approach, and they should take that because I think a lot of people are getting left behind. But also the whole world has changed in the last, I would say, 10 years, especially with access to mobile and the type of information that we have. So I think that angle is not like completely, really kind of taken by SEC to say, okay, great, the world has changed. How do we now need to look at from a different lens perspective where transparency is now becoming much more of an acceptable norm? And if that's the case, how do we need to kind of then change the laws to get more people into the ecosystem?
So Anna, let's continue along that. I mean, we know traditional investment portfolios have not done well over the past few years. So from your perspective, to say the least, what alternative asset classes do you see LPs gravitating toward today? Is it long-short equity? Is it fixed income arb? Is it private credit? I mean, everything, everybody's talking about private credit. I mean, where are the funds, where is the incremental risk taker prepared to invest in alternatives today?
Yeah, so in alts, our platform, the flows are going towards these perpetually offered strategies, non-traded REITs, interval funds, BDCs, which, funny enough, like I think we were looking at these in 2012, to your point around regulation, and we were like, no, we don't want to offer these because the SEC is going to glom onto these during their next exam. But for a good reason, because of the fee structures and how they were structured before, and they're a lot better now, right? I mean, a lot better.
Can I just jump in on this one point, because I think it's really interesting. So you asked a question about strategy, and she answered a question with structure.
Yeah. I'm getting
you're getting the strategy in a sec,
but it allowed for
it's exactly my
what
point.
I'm going to say next.
It's a really interesting observation. I'm giving you a compliment because right now, strategy and structure from the lens of success of capital coming into a fund are tied. Believe it or not.
And distribution.
The best structures in the world with not average strategies or collecting capital, the best strategies in the world without the appropriate investment structures are not. So it's a moment in time on that too. Sorry to jump in there, but I thought your answer was totally spot on.
Great, that's a great observation.
I appreciate it. Yeah, so the alternative investment classes are, so yes, perpetually offered strategies, and then within that, real estate and credit. So, core strategies that offer a yield, right? And that's the alternative portfolio that I see, right? So for me, I see fixed income, alternative yield. I see equity and alternative, equity alpha or alpha, other than the beta, because everyone else, so basically you have ETFs, right, being complemented with alts, which is a really interesting portfolio. And so, and then Stephanie mentioned tax, right? For the tax is another whole humongous opportunity that the alternative investment industry is not taking advantage of yet. I know they will, but that is present company excluded, obviously. But that's the new portfolio, right? And so it is. How do we take our equity and fixed exposure, right? And then diversifying strategies, right, will always be, a portion of it. But really, the way that private clients are seeing this is has a huge income. Maybe in this cycle they haven't appreciated it yet. A downside protection angle. I think they'll come to appreciate that right now. But yeah, so income and tax, I think, are alternative investment classes in and of themselves.
Can I build on that first?
Please, absolutely.
So, building on your point, and actually what was said earlier, what's interesting is that the classic definition of alts and having kind of that, whatever it is, up to 20% of a portfolio, You know, in our view, the way we think about it and the definition of alts is simply an alternative to stocks and bonds.
Correct.
Right? At the end of the day, you can look at an alt that's AA. You can look at an alt that goes all the way through to private equity. And so kind of building on what Anna said, the range of alternatives that you can have today is simply at an excess return at each point of the risk-reward spectrum. We can move away from that narrow definition that we've used for so long. And then when that opens up in terms of the range of options, yes, you're taking more illiquidity, but then you should be compensated with that excess return, again, for each point of or unit of risk. So as we think about it, why not have 50% of a portfolio potentially in alts if you're getting kind of the right mix from your portfolio over time. So increasingly, as we think about the areas of innovation, and we're kind of seeing this already, it's fixed income replacement, it's equity replacement, it's ensuring that we have the tools from an inflationary environment, from a rising interest rate environment, and how that impacts each piece of the portfolio. So I think it ties into what has been said.
Well, I don't want to confuse things, Stephanie. I want to stay with you. You know, people are talking about perpetual structures. You know, I mean, I think of closed-end funds or whatever. But you know, when I think of perpetual capital, you know, the search for the investor who's willing to lock up their money for that much longer with you. Are you still seeing demand from that type of investor base? Are you still seeing investors willing to lock their money up for longer in the hope that you're going to generate a higher return for them over that time period? I mean, do you still see that? Yeah.
We see a full range. Sorry if my micro's not working well. So there are investors that think of an investment with us as long dated and want the return either from an income perspective or capital appreciation over the long term, and there's a role for that type of capital. There are others that look to invest their capital in perpetual vehicles, but do want the semi-liquidity that we've been speaking about, so having that available as a piece per quarter, a portion. So we see the full range, and often it can even be the same client, interestingly, that wants a mix of both.
Well, I mean, we only have a couple minutes left. I apologize, but we wanted to open up to the floor for questions. So I don't know if anyone has a microphone and is running around. And if not, I can still ask. Oh, we have a colleague over here. Somebody wouldn't. Here we go.
Hello. I enjoyed the conversation very much. Just want to bring out the point of strategy versus the structure. I just elaborate on that and ask the question as well. Because I feel we're talking about alternative asset class here. The mentality is about the credit rating. You know, you use rating agencies to credit rating. But my view, my palm opinion, credit rating is a centralized old way to I'm not downgrading the rating company, but the structure can solve the issue of credit rating when you want risk premium compensation. So that's what happened in Southeast Asia for credit. You can do structured consumer loans rather than ABS in the centralized way, but you can do a structured way in the private credit world. So I think I'm talking about this to introduce more investment opportunities in alternative asset class. You may not need a credit rating. What is AA here, you know? Because you cannot compensate what is AA rating. You know, so, but the structure can, structure can help that. So my question is, do you see that here in US? Because I see it in Asia Pacific, South Asia. Structured credit really big opportunity there. Infrastructure credit rating, consumer loan, structured credit, all different asset class. Thank you.
Matt, maybe your handle. You know.
No, I think that question is probably better for Anna or Stephanie.
Stephanie, Matt, Daniel.
So most of my purview is around funds. We are seeing more structured credit instruments being introduced into wealth management because we're a big bank. But I wouldn't say that they're all I haven't seen the U.S. credit agencies, really sort of dip into that market yet. So it's all non-rated paper.
Of course. please, I got you. Thanks.
I'm curious about how you would structure the portfolios, and obviously given if it's your company versus a smaller company, depending on the size of the assets under management by each individual organization, institution, whatever. When you see a situation occurring, such as the inflation going up, the credit market starting to tank, real estate going up, et cetera, and the Fed, especially the Fed, starting to move in the direction of raising interest rates, how much money goes into cash? How do you identify how much money you want to put into cash? Because I know I began to do that immediately in my own, because I handle my own stuff, management, and I began to move into cash, because I'm going to ride the yield curve up. And then and then hopefully, if I can time it correctly, move it. How do you guys handle the movement of capital to protect against the downturn in the stock market? Alternative, like life settlement is a perfect example. Doesn't correlate to that's an alternative, and it doesn't correlate to the stock market at all, or real estate.
So is cash trash is the question. Anyone want to handle that one?
It takes a sophisticated investor like you to know when to go out of cash back into the market. So we try to guide towards, more defensive, more quality. But, there are so many good investments out there, but I will tell you that trying to educate an advisor force while the markets are plummeting and the news cycle's what it is excruciatingly hard, right? And we know that alternative investments are, many parts of alternative investments is where clients should be and where they should actually be going to right now. Like, this is the time, right? Vintage year 2023, maybe 2024, 25, probably going to be a good one, right? But you've got to have a stomach for it. And so we might raise cash one or two sometimes, but that's not our hedge. Our hedge is more defensive, high quality, and then into alts, which is what we're saying now. I mean, different parts of the alts.
I think I'll offer, maybe if I jump in here really quickly. I think from an end consumer perspective, what I'll offer is that right now, as Matt alluded to earlier, the allocation is so small. So I don't think that you're playing the time game. And when it comes to alts, you're just diversifying your portfolio for the long run. And that's what we are educating our consumer base on. I think if the allocation increases, then the next question really is going to become is that what do you think of a model portfolio? And can you on the fly build a model portfolio that can take into consideration broad macroeconomic factors?
Great. Well, I think we've overshot our time here. Sorry. But thank you all for your attention here on a wonderful Tuesday afternoon. Okay. Thank you to our guests. All right.
Yeah, I was going to change my seat because I feel like I'm too close to the front right now. What did it say? Thank you so much.
What am I doing up here is the real question. Well, no, I saw you show you. That's okay. No, yeah, exactly. Yeah, because we're in emerging markets. Okay.
Shoe change. I like these. I can't deal with it. I didn't even bother. I don't know why I do it. They look good. Right, that's one.
Okay, thank you. So we're rounding out the day here with this is our last session before the fireside chat with Secretary Ross. So I want to welcome our next panel. Just a note, we did have one speaker drop from this session, and because we're running a little bit behind, this session is only going to be 30 minutes, so it's abbreviated, so there's a lot to cover. This is on how to detect greenwashing in this new era of ESG. So I'm introducing our moderator, Mark Kohler, who is a partner at Prosec. And I'll let him introduce the panel. Thank you, Mark. Give them a welcome.
But my panelists have ESG in their DNA. Along with ESG, in my DNA is media, because I was a reporter for a very long time. So I thought the best way to combine that and start this presentation is with some headlines that ran in the last couple days. U.S. Republicans pull $1 billion from BlackRock over ESG investing. Are ESG ETFs a gimmick? And the fundamental contradiction of ESG investing is being laid bare. These are just a few, like I said, that ran since the weekend, and it's a good example of how ESG is being portrayed both in the US and the world right now. There is little debate that ESG is a leading conversation between investors and managers, and this is why our panel today is so timely. We have a leading advisor on disruptive businesses who works in the EU and America, so we'll bring a good non-US perspective to the discussion. And we have a pioneer in stakeholder capitalism who's been in this space for quite a while, so look forward to his comments. I know the program says that we're going to talk about how to detect greenwashing, but I wanted to expand that a little bit and frame the conversation about how to detect and address greenwashing so that we can adopt a more positive and proactive approach to help move the sustainability needle forward. Although the concept of sustainability and ESG has been around for some time, the practice as a global program with allocators, asset managers, policymakers, and regulators is actually, in the big scheme of things, relatively new. At one time, the conversation focused on CSR, but fast forward today, and the conversation is more focused on climate, board governance, gender parity, human slavery, or cybersecurity. As the practice matures, and we're seeing that right now, as advocates and detractors battle in the headlines, old ways of thinking may eventually be rendered obsolete. Are these claims, these headlines, long-term threats, a political agenda, or just a rite of passage in what seems to be a growing industry? In fact, the amount of money invested in sustainable funds has increased by $1 trillion in the last 2 years alone. Against this backdrop, the claims of greenwashing still are on the rise. So today, I hope we tackle a few things. We'll define a bit this new era of ESG. We'll address how to best address and detect greenwashing. And finally, talk about how to be a good investor with, I hope, a few predictions from our panelists. We'll open up for discussion with questions at the end of our conversation, but let me just give a little bit of introduction of the two panelists. On my immediate left is Rafael Dornano, who's the founder and managing partner of Dornano & Company. As an entrepreneur, she operates her firm across 2 hubs in Paris and New York. We can be jealous about that. And is an active financial and legal due diligence provider for the world's leading investors on industry-defining transactions on disruptive technology businesses across private markets. We have further left is Martin Whitaker. He is the Chief Executive Officer of Just Capital. And besides being the founder of the firm, I would also say he's more or less a field builder, if I can say that, in the industry.
I wouldn't say I was the founder, because if the founder was here, Paul Jones, he'd fire me straight away. So I'm the founding CEO.
Founding CEO. All right, very good. He is also senior advisor to Edelman, a co-founder and board member of the CREO Family Office Investment Syndicate, a member of the Forbes Finance Council and Forbes Contributor, among many other things. So those are our panelists. I thought just to begin, we'll set the stage and talk a little bit about this new era of ESG and how actually did we get where we are today. So would you like to kick it off?
Sure, thank you. Very happy to be here and to be talking as a European on this topic that is highly politicized in the US. So it's just, I didn't prepare for this, but I'm very happy to be on this panel. So more seriously, ESG is something that is definitely not new, but I think COVID has definitely accelerated the trend. Now, COVID has not given birth to ESG, nor has it given birth to tech in general, but it has definitely accelerated these mega trends that we were seeing before and that have become these mega trends. So today, no one can ignore in the private markets the concepts of digitization, decarbonization, and sustainability, which are really defining and creating investment in these markets. And I think we talk a lot about ESG, but we should be talking about a whole new ESG/tech paradigm that is something new and that is creating a lot of opportunities for investors on top of creating maybe many constraints that we will address with the greenwashing that derives. But also we will try on this panel to look at the opportunities that are arising from this new paradigm that we are actually in.
Thank you. So Martin, where you sit at Just, you talk a lot about great companies and what Americans see as great companies. So with that lens, can you just talk a little bit about how we got here and how you defined this new era of ESG?
Sure. So I was here at this event, I think 2019, I think. And there was a panel on ESG, and it was like prime time, early in the morning. Every table was packed out. Now we're at the end of the day. And you good people are here. So thank you for sticking around. I really appreciate that. I hope that's not a sign of how ESG is going. Look, I got into this 30 years ago. I did my PhD at Edinburgh University on environmental risk assessment. I wanted to go into finance because I wanted to make money. And I felt like money in business was the greatest sort of positive transformative force. And I cared about the environment, but I also felt like it was a great place to invest. So that wasn't that much more complicated than that. And it wasn't called ESG back then, but I got a job working as one of the first ESG kind of, now you'd call it a rating company. We sold it to MSCI. It's called Innovest. And we were working with big pension funds who were really worried about environmental risks that they felt they didn't really get a handle on, and governance-related risks. And this is sort of after Exxon Valdez. This is after Brent Spar with Shell, if you remember that. The governance sort of challenges, let's say, of Enron, WorldCom, and so on. And so these disparate kind of things came together most recently, in the last five or so years, and then gained fame as ESG. Like everyone sort of realize this is what they want to do, and you watch the flow of assets into ESG. It's just a hockey stick. So it reminds me a bit of my teenagers. It's sort of no real standards, not a lot of transparency, too much money, and you wonder like what's really going on under the hood. And I in all seriousness, I think the ESG community has manufactured a lot of its own problems. And got caught up in sort of definitional, very, very technical definitional issues. And so it's not been made accessible. So you fall victim to the kind of attacks now, which I think are not rational or data-driven, but driven by politics. That's just my view. What Mark said about Just Capital, though, is really the point, which is we spend a lot of time and money, and if you know Just, you know what we do. We're a 501c3 founded by Paul Tudor Jones. We go out and talk to Main Street America, and we ask them, what do you care about? What are the issues that matter to you when it comes to business today. We don't talk about ESG, we don't talk about stakeholder anything. We just ask people, ordinary people, like, what do you care about? And we do that on a fully representative basis. And what we hear back is actually a very common sense, kitchen table set of things that people want from business. You know, they want to be paid a fair wage. You know, they want to be able to make ends meet after a hard day's work. They want to be treated with dignity and respect. They want to live in communities which are strong and healthy. So all of that is sort of packaged in an ESG label now, and to me it's a shame because you've got most Americans agreeing business and capitalism can and should be forces for greater good. You've got our own research which shows that businesses that create value for their stakeholders do better in the market. You know, our flagship index has outperformed its benchmark. Our Just 100 has outperformed its benchmark. I can give you the numbers. I'm happy to do that, but the business case is very strong. So Americans are in agreement. The business case is strong. And so I don't really get like what's going on here. But I think if you follow the data as a good investors, I'm sure you do that, and look for evidence, you can come to your own conclusions.
I think that's a great point, and I'd like to come back on the data because PitchBook just released a very interesting survey on ESG actually last week. And when you look at the numbers, I think some very interesting messages that we should be pointing out here. So first, there were actually 20% more responses in this year's edition than last year's, which is showing from a statistical point of view that there is more interest in the subject. That's point number one. Point number two, in the 2020 edition, there was one negative response on ESG. One North American LP, by the way, expressing a negative view on the topic. There were 50 of those in this year's survey. So you might think that this is bad. When you look in the numbers and you actually look at all these 50 negative arguments and what are they behind? What is behind them, sorry. Two come often, socialism, communism. Okay, I'm from Europe, you know, so I hear those terms. Second one, go woke, go broke. That's something we don't hear in Europe. And it's like that for the 50 of those arguments. So there is not one scientific or reason-backed argument that is showing that. And so you might think that there is a backlash against ESG, especially in the context. But when you take a look behind, in an absolute number, you have actually an increasing adhesion to the concept on behalf of GPs, on behalf of LPs, on behalf of service providers who are really integrating ESG in the frameworks for considering investment thesis, which is key. And there's a whole need for education that is behind. But ESG is moving forward, and I think that's a very good data that we have here. Again, in particular from North American LPs, who are the ones expressing the most negative views. But I know we're going to go down further on defining ESG, but I thought that data would be of interest for the room.
So both of you are kind of touching on the idea that part of the issue is maybe the packaging of ESG. Is that fair to say? Or is that being too general there?
I think that's very accurate. I think as Paul said on CNBC this morning, the emphasis is on the wrong syllable. So ESG has become about environment and climate. Actually, when you know, through our own polling, it's really about the S. We found worker-related issues to be way more important to most people. And I actually think that the whole area of human capital, how a company creates value from, you know, the people that work there and sort of generates a long-term competitive advantage and generates, you know, a profitable, thriving business. You know, if any of you run a company, you know that treating your people well is essential to that, you know, and treating your customers well, and trying to give back to the communities where you operate. I mean, this is not rocket science. So, and when we do our survey work, Mark, we don't use ESG. We don't talk about that. We don't talk about sustainability. No one has a clue what you mean when you say those words. We do talk about what is just, you know, what is fair, what feels right, and I think Americans have a strong sense of that. So I think the packaging of ESG you know, any acronym can be made to sound, you know, sketchy.
Scary.
And, you know, and I think, unfortunately, that's what's happened to ESG now. It's very hard to get that back. But I do think, we were saying earlier, I think it may be called something else in a few years' time.
I think one of the trending conversations
Right.
is,
Right.
will this become, will we replace ESG with resiliency? Or some term like that that's a little
Or just
more
good business.
Good business.
Or maybe just business, who knows?
So you were here 10 years ago, it was a packed room. Maybe one of the goals is in 5 years, there's not even an ESG panel because it is accepted and part of, integrated into the investing fabric. Is that too optimistic?
Well, I did hear that 10 years ago, so
Okay.
I don't know that, yes. I would say, look, to me, it's always been about how you build a strong, resilient business, how as an investor you seek to understand the drivers of risk and return in different ways. You know, how you are inherently a bit skeptical about whether companies can grow, can achieve their numbers. The problem with ESG has been a lot of it has been around promises. You know, if I was starting a company and said, I have a plan to be profitable, I have a policy that I'm going to be really successful, but you wouldn't trust me. We probably wouldn't trust me. You know, and we know trust is at an all-time low right now, you know, in lots of things. So I think it needs to show performance. You know, what are the underlying performance drivers? How do we know that a company that is investing in its people, which, as I've said, just makes total sense, is really outperforming? Where's the data? And this is why you need data you can trust, action, not words, right? Deeds, not words, action, not promises. And then we'll come back and say, okay, is it really moving the needle? You know, are we as a society getting better? Is capitalism better serving more people? That's what you would want. Or are we finding that our challenges are getting worse, not better?
So
maybe just to add on this concept, and so to actually define ESG, because we're talking a lot about the concept, but I think if we go into the terms, like environments, that's clear for everyone, and it is tricky because we're talking a lot about the path to net zero, we're talking a lot about climate, and even on that E term, which is really a big opportunity today, we're missing in assessing, for example, GHG emissions, everything around climate, the risk linked to biodiversity, energy risks, many other factors in the E. So the E on the one side. The S, I would say, is the one that is the most debatable. Do you put diversity, equity, inclusion in the S? Is that a whole separate subject that sometimes you put aside from ESG? In our conception at the firm and in our way of approaching businesses, we definitely put the DE&I at the core of the S, but many other aspects on that subject too. And governance, which is perhaps the concept that has been integrated the most earlier, it's been integrated since the 2000s in the concept of financial performance, and I would say that that's the most easy one. But now that we have defined those terms, how do we effectively measure what's behind and indeed link this to financial performance? Because given the current context, and again, okay, there was COVID, okay, we have a very bad macroeconomic, geopolitical environment, but what matters to everyone in the room is how do we link this to financial performance, and is integrating ESG in the financial frameworks linking to a better EBITDA in the end? Because that's what you measure and that's what you base your valuation on. And a lot of progress has been made here. If we look at the E, we now have very strong frameworks. The TCFD is one of them, and there are many others, to translate environmental factors into what I would call hard data. Today, you're able to measure GHG emissions and to quantify that in, for example, what would be the impact on EBITDA of a carbon taxation. There's still a lot of debate. Do you consider scope 1, scope 2? Do you go up to integrate the whole scope 3? That's the current debate that specialists are having which is a key debate, especially in the tech industry where all the GHG emissions are on scope 3, closing the bracket here. So on climate, that's where I would say we have made the most progress in terms of being able to measure things. But looking at DE&I, which is a core focus here in the US in particular, things are much more complicated because you have no direct correlation between having an effective DE&I policy and having a better performance, a better financial performance, again, that you measure in EBITDA. When you're putting equity, inclusion, diversity front and center of your business model, you're getting higher employee engagement, you're lowering your employee turnover, you're having better innovation, so you're having faster product to market development, many virtuous items. But how do you measure that? You cannot measure that on the short term, and there is no implication on the year's financial statements. So what this is bringing to investors is a major change in how you have to approach risk. And again, we're back on this concept of risk that is the core subject here. To truly assess risk, you have to look at risk from two perspectives. First, from a multidimensional perspective, considering the risk, like not just one risk, but the effect on the whole value chain that the company is operating in. If you have a bad supplier, well, the problem is not just on that supplier, and it's not just an S issue of having maybe child labor or a bad supply chain. It's your growth in the end that is not going to be good because you're not having a consistent supply base. So that's the impact on the multidimensional perspective. But I think the most difficult one, and sorry I'm a bit long here, but I'm very keen on this concept, and this is really what we're seeing today in how we investors are looking at companies, it's the multi-timescale perspective. So let me explain 1 minute. When you're going on the route to net zero, during the year you do that, you actually have a peak in GHG emissions. So if you look at the year where you're doing that, you're actually having more carbon emissions. When you're putting in a DIE policy in place, this is costing you a lot of money that year. And I have many examples. So you need to consider what will be the asset in a couple of years, and as an investor, are you producing a winning asset by actually investing in this whole ESG framework at exit and on a longer time scale? So it's a whole new approach to risk and resilience that is needed, and what is urgent today is to integrate ESG at the core of financial analysis. That's the only way that this will be serious and that it will be of consideration to the whole room, and that we will stop this politicizing ESG, because that's not the core concern.
We will get to greenwashing, I promise, because that's part of this conversation. But I do have one just basic crystal ball question. ESG has benefited from a bull market. Mm-hmm. If we enter a recession next year, which is widely predicted, what will happen to ESG programs? Will it become will it be placed on the back burner at firms, or do you think the train has left the station and we will continue at this positive pace?
Well, I think it's very company specific. It sort of depends on what your motives are. As Warren Buffett said, when the tide goes out, you see you swimming naked. I think those who are really doing, ESG because they really believe it's making them better, will likely double down on a lot of those initiatives, because the underlying issues that ESG seeks to address, investing in your workers, building stronger community ties, all of those are the things that see you through a recession, And so I don't expect that those companies that are truly committed to stakeholder leadership will pull back. What we've seen is companies fearful of speaking up on ESG issues, that's for sure. Mm-hmm. They don't want to get targeted. Mm-hmm. Nobody wants to be the next Bob Chapin. I would say, but if companies or investors are really trying to use ESG as a greenwashing label for raising assets, if you're an investment manager, yeah, you know, you're probably not going to go down that road if you really don't believe that it's creating some sort of advantage for you. So I think it'll be a shakeout. It's not necessarily a bad thing.
So thank you for the segue into greenwashing. And, you know, everyone's read all the stories about Deutsche Bank and Bank of New York, but is there really a systemic problem here with greenwashing, or is this just specific chapters from time to time? I think, Martin, you have a strong opinion on this, right?
Well, I look at it two ways. Greenwashing implies that there's some like level of thing you need to do to be ESG, and that's not true either. So, you know, is there like an intentional misleading based on misrepresentation, willful misrepresentation of performance against some standard? I'm not sure. Maybe there's communications that are overblown or promises that are kind of empty. It's very hard to know like who's actually performing well. This is one of the reasons why Just Capital is so focused on actually on the underlying data. But so I think it's more complex than simply, you know, someone, you know, stating we're ESG, and then, you know, having that be a sort of a, you know, just a misrepresentation. I think there's a lot of aspiration around what companies want to do, and because ESG is so squishy, it's hard to know. Well, is it ESG or is it not? And to some people, it might be, you know, no, they're not doing this, they're not doing that, they're not adhering to this standard or this framework. And yet you might get a company that's actually, you know, as we know, making great progress in certain underlying elements of ESG. So I think the premise of the title is, how do you really know what's going on? You know, what is actual performance and what is performative? And I think that's what's happening right now, and I think that's actually healthy.
So we just have a few more minutes. I just wanted to ask, how do we best prevent issues of greenwashing? Is it through regulation, through systematic reporting, data analytics, uniformity? How would you look at that?
I think, and so I'm taking the European perspective once again on this, but I think regulation, even if it's creating a lot of burden, has some very useful implications. Most of you are not aware of this because it's been a bit under the shadow, but the European Commission is passing a directive that many of you will hate probably because it's the most restrictive text that it has ever been produced. You will have to comply with over 33 UN PRI principles, and this is a big regulatory framework. It's in front of the European Commission right now. It's applicable for all the companies that are doing over 150 million of sales in the European Union, but it's concerning a lot of asset managers. And where this directive is very interesting, it's that it goes beyond all these ESG disclosures. It's actually putting an obligation for asset managers and their portfolio companies to take action. So for example, if you have a portfolio company that is having recourse to child labor, that is having bad environmental practices, that has bad pay practices, any of those, well, not only will you have to disclose, that's the easiest part, I think, but you will have to prevent, mitigate, and you will have responsibility as a director of that company if that is not the case. So, and this will be effective by the end of the year. Surprise, maybe beginning of 2023, at the worst, if it takes a bit of time, by the end of 2023. But this is a major step of a major regulation framework that should go much beyond just disclosures, which are already very painful, I understand, for many, and I agree with you, of course. But now it's putting ESG into something very concrete so that we stop with all these regulations. We actually take action to build these resilient companies, and we're again on the subject of resilience, companies that are able to weather market conditions like this, where you have an energy crisis, where you have deep problems on your supply chain. We just audited one of France's major leading digital native brands called Cézanne, and the whole due diligence was on the supply chain and the company's ability, and this was the financial due diligence, the company's ability to continue its growth in the current context of not being able to produce its goods in a traditional way. So a whole new context again.
Thank you. I think we're probably out of time here. I'm getting the nod. So thank you all. I think what was nice is we got to have a just and a technical point of view on the ESG landscape. Thank you.
Okay, so we're rounding. This is the last session of the day. I think all of you know this is a fireside chat with former Commerce Secretary Wilbur Ross. I'm going to make a quick introduction. He's going to be moderated in conversation today by Jerry Baker, who is editor-at-large at the Wall Street Journal. His weekly column for the editorial page, Free Expression, appears in the Wall Street Journal each Tuesday. Please welcome Jerry Baker and Secretary Ross.
You. Good evening. Welcome, everyone. Thank you very much indeed for being here. It's a pleasure to be here. Well, Wilbur, as you heard, this is billed as a fireside chat, but as far as I can tell from the schedule, we are the only thing standing between these good people and the cocktail hour.
Well, and I'm glad we don't have a real fire.
So we'll try to make it lively and stimulating, but not so gloomy given the current economic environment that everybody goes off to cocktails in desperate need of a drink.
Okay.
But look, you've had an extraordinarily long and successful career in investing and, of course, in government, most recently as Secretary of Commerce in the Trump administration. So you're very well placed to give a perspective on these macro and economic and financial trends that we've been talking about here today and that we're going to talk about in the next half an hour. So let me start, if I may, with you with the topic that's, I think, on top of everybody's mind, which is the economic outlook. The U.S. economy seems to be continue to grow. There's contradictory signals on this. Obviously, we had negative GDP growth in the first 2 quarters, very slightly, but the labor market seems in reasonably good shape. Consumer spending is still continuing. And yet, of course, we're all dealing with these remarkable financial developments, obviously financial markets itself, and of course, above all, the Federal Reserve aggressively raising interest rates, and according to Jay Powell, the chairman, set to do quite a lot more. So where do you stand on where the U.S. economy in particular is right now? I saw Jamie Dimon yesterday saying he thought a recession was likely in the next 6 to 9 months. Do you think the Federal Reserve can pull off this attempt to suppress inflationary pressures without tipping the economy into recession?
My best guess is we're in for a protracted period of stagflation. And I don't think it matters whether it exactly tips into a recession by 1 or 2% or goes a little bit above and is a little bit positive. It's going to be basically flat economy for some time to come. Inflation, I think, is a lot to the economy like what an infection is to the human body. If you deal with it quickly when it shows its first signs, very easy to get rid of it. Very simple medication does it. When you let the infection grow and fester for a long time, it gets hard. And sometimes the curative impact also has bad side effects. I think that's what we're going into here by analogy with the body. But is it Armageddon? Is it a Great Depression? No, I don't think so. I just think it's going to be very soggy but very inflationary. And the reason I think the inflation will be so hard to get rid of is we should really look at the components and think each one which is going to be strong in terms of inflationary pressure, which is not. I think to paint with a very broad brush and just say this is what inflation will be is really not the right mindset for looking at it. As you know, 32% of the CPI is shelter. Shelter costs are definitely going to go up in the next year or two. There's a lag factor between when prices of real estate go up and when they're reflected, because about a third of the home residents is divided into two categories, the rentals. Well, rentals have been going up at an enormous rate, but most leases are 3 years, so you're only going to start getting the full effect as you get out into next year. And similarly, while the prices of houses probably won't go up very much in the next year or two in general, the impact of the former increases and the fact that some folks still have variable rate mortgages, so their interest rates are going to go up, and property taxes for sure, especially in most urban areas, are also going to go up.
And the labour market still seems tight, right? I mean, again, there's no relieving so far of those pressures. We see the unemployment rate fall again last month. Payroll growth was down a little bit, but with average hourly pay rising at about 5% and core prices rising maybe at 6%, there's still a lot of pressure in the labour market on wages to catch up.
There is, and that will continue. You know, this isn't the first year where real wages have gone down. Real wages have been under pressure for quite a few years. And I think middle-class America is sick and tired of having inflation outpace nominal wage gains. So you're going to see enormous pressure there. You might have noticed today the railroad workers decided apparently to turn down what I thought was an extremely lush contract with the railroad. So God knows what they'll end up with for a new contract.
Where does this leave the Fed? The market again still seems to be thinking Fed funds goes up, another 75 basis points next month, and then another 50 at the end of the year, and then maybe we get to between 4.5 and 5, and the general expectation seems to be that's about as far as we need to go. The Fed thinks it does all that, according to its latest forecasts, with unemployment rising, to 4.5% by the middle of next year. I think all the evidence is, to just go back to our original question, that when the unemployment rate rises by that much in that shorter period of time, that's pretty negative for the economy. That does suggest a pretty sharp recession.
Well, it does. I think a buffer to that, however, is the big gap between available jobs and unemployed people. That's almost as wide as it's ever been. So the first million or so available jobs that go away, nobody's going to be bothered by them. Maybe even a couple million jobs can go away and nobody will be bothered by them. So that, I think, is a big buffer that has not typically been present at this stage in an economic environment. The other thing is labor force participation has been stuck. It's still no better than where it was a couple years before the pandemic occurred. Every percentage point in labor force participation is over 2 million people. So if the participation rate went up just 1 percentage point, that brings a huge amount of new supply of labor.
Do you think the Fed got this badly wrong? Do you think this talk all through last year that inflation was transitory, the failure to raise rates until the beginning of this year, they were still doing quantitative easing until the beginning of this year, even as inflation was hitting 6, 7, 8%? Is this going to rank as a really serious historic Fed mistake?
Well, I think one of the problems with the Fed is that it uses obsolete models. And it's a problem with models in general. The problem with all these models is they always make the implicit assumption that tomorrow will be a lot like yesterday. But at inflection points, exactly the reason it's an inflection point is tomorrow turns out to be very different from yesterday. And anybody in his right mind who would think that the same economic recovery that came from prior recessions, which were induced by economic causes, that the same conditions would prevail in this unique recession, which was not caused by the economy. The economy was very, very strong when the pandemic hit. This was caused by an exogenous factor, the pandemic. So what I could never understand is why the Fed didn't understand there would be a very big snapback. And I also didn't understand why the federal government didn't get it. Once you removed the singular cause, there was no reason for the jobs not to come back. And we didn't need the last $1 trillion or so of money coming in. So I think this is a self-induced stagflation that we're going to be going into.
What about markets, and how do you see the markets? No one in this room needs reminding. This has been a terrible year for markets, equities. You know, S&P, US. Just keep to the US for the moment. But you know, S&P down 25% now. The Nasdaq down more than 30. I think my newspaper reported that this has been the worst year for bonds. I mean, unusually at the same time as equities. I think in more than 100 years, we're seeing the 10-year Treasury, you know, back around 4% again. Do you think? I mean, where do you stand? Again, sorry to keep coming back to Jamie Dimon, but Jamie Dimon, I noticed yesterday, in addition to forecasting a recession, said he thinks the equities could have another 20% to fall. Do you think, you know, looking ahead to we've got an earnings season coming up, which is clearly going to be quite challenging. We've got this continuing uncertainty about what the Fed's going to do with interest rates. We've got some of these other uncertainties in financial markets. Are we past the worst yet, or do you think there's more to come?
No, but I think we're getting close to it. The market never discounts the same thing twice. And right now it's discounting bad times. Once bad times really occur, then it will start discounting the recovery to good times. So markets by their nature try to be anticipatory. And sometimes they get it right, sometimes they get it wrong. But as to Powell and the interest rates, I believe that he does not want to go down. Now here's a bug, clearly from the Federal Reserve.
Or maybe the Chinese. Maybe the Chinese will. But I'm going to get on to China
maybe
soon.
It didn't look Chinese, but anyhow.
I'm sure you've dealt with a few Chinese bugs in your time.
No, their bugs tend to be more electronic.
Yeah, sure.
Anyhow, Powell, having totally blown what he should have done earlier, I think is going to be extremely tempted to overshoot. And I don't think he wants to go down in history as the one Federal Reserve president chairman, who could not solve inflation. If it happens to cause a recession, well, so what? Recessions come every now and again. Been a long time since we had a true economic recession rather than pandemic. I think he can shrug that off from a reputational point of view.
How do you see the financial system, the stability of the financial system? Forgive me for saying this, but you're old enough to have lived through a few financial crises in your time. When you see these dramatic movements, particularly in interest rates, that is often a time that creates distress in financial markets. We've seen a little bit of this in the UK with the dramatic move in gilts in the UK, and the Bank of England having to step in to stabilise and help out some of the pension funds who are a little bit exposed there. You know, the old Warren Buffett saying about, you know, when the tide goes out, we see who's been swimming naked. Do you think we might be in for some of that in the next few weeks and months?
Well, I think the UK situation is a little bit unique in that the policies of the new Prime Minister and the policies of Bank of England were antithetical to each other. And if there's one thing the market hates, it's confusion and uncertainty. Markets can adjust to good things, they can adjust to bad things. They hate to deal with uncertainty. So I think that's a little more even of a self-inflicted wound than what we had here. But remember too, in the sunny days, there were great excesses, tremendous excesses. I have a SPAC, as I guess every living adult American does, and
I thought they'd all got rid of, I thought they'd all gone away now. I thought that was last year's Greenwich Economic Forum story.
At the Milken conference a year and a half ago, I predicted that SPACs would be where people would lose an inordinate amount of money, even though I was doing one. It's not that there's anything wrong with the SPAC concept, it's merely a mechanic. It was abused, and so was the general market. So part of the reason we've had such big declines is prices got to where they never should have been. And so a lot of the correction is not even economically based, it's just the psychology has changed. Because the way markets relate to inflation, for the longest while nobody talks about inflation, nobody cares. Then suddenly one morning everybody woke up and had a simultaneous nightmare and said, oh my God, inflation. And then everybody worries about inflation.
About the dollar, that's obviously causing a lot of distress around the world. A lot of emerging markets getting hit very hard by the strength of the dollar. There have been some calls in some parts of the world for something to be done, as there always is in these circumstances, maybe another Plaza Accord. Do you see this as anything that requires a policy response, or are we just going to have to suck it up?
Well, I think IMF, World Bank, and other such entities are going to do what they always do, which is bail the people out. And I think it's, in a way, sad that that happens. Not that I would like to destroy the emerging countries, I wouldn't, but we have done nothing, despite all the repeated crises in emerging markets, we have done nothing to reform their behavior. They continue to mismatch their borrowings with their own currency. And anytime you're in an inherently unstable, weak currency, and you choose to borrow money in dollars, you're looking for trouble. And until we teach those countries that that's a wrong approach, it's going to be the same cycle, same cycle, same cycle. Look at Argentina. I forget how many times they've defaulted, but sure enough, then a new face comes in, new central bank governor, and all of a sudden they're borrowing dollars all over again. So if we don't learn from history, as the wise man said, we will be doomed to repeat it.
Karl Marx, I think, was it? But anyway, he's coming back into fashion too in some parts of the world. What about taking a longer-term view? Do you think that we've seen this extraordinary period since the global financial crisis of extraordinary stimulus from central banks in particular, and to some extent from fiscal authorities too? But you know, the Federal Reserve's balance sheet hitting $9 trillion. We've got used to this era of essentially effectively zero interest rates. In fact, in Europe, they've had negative interest rates for quite a lot of the last few years. Is that, are we now, is this, what we're seeing now is not just a kind of cyclical reaction, but do you see this as maybe, you know, a resumption of what we used to think of as kind of financial normality? The days of free money are essentially now over.
Well, I think the days of free money probably are over, but they had to come to an end. There just is no free lunch. It's just not possible. And when you have every major economy operating at budget deficits, how you would think that that wouldn't percolate its way through into higher interest rates is just silly.
Let's look at some of the specific issues you dealt with as Commerce Secretary now. Let's talk about international economic and trade environment. Right now, I mean, the Trump administration, I think it's fair to say, was the first U.S. administration to take a pretty radical departure with regard to trade generally in the sort of Cold War, post-Cold War era, but particularly with regard to China. Took a very hard line with China, imposed tariffs on a lot of Chinese goods. It does seem as though the Biden administration came in saying it was going to undo a lot of that and that it was going to look for a more multilateral approach to dealing with China. But in practice, it hasn't. Now, I know the president is still considering whether to lift the tariffs on China, and we're going to maybe hear about that in the next few weeks or so. But do you think that we are now in a fundamental, US-China, the two most important economic powers in the world, are now in an out-and-out relationship of confrontation, if you like, of economic, I don't want to get onto the political stuff here, but of economic, of a much, we used to talk about economic partnership, previous administrations talked about partnership. Do you think it's now rivalry and confrontation? How would you characterize the relationship between the two most important countries?
I think the prior administration's characterization of it as a partnership were simply incorrect. It never has been a partnership. China is bound and determined to be the factory floor for the world. They are bound and determined to overtake us. So the idea that this was a cooperative thing is silly. It's just not corresponding to the facts. And I don't blame the Chinese. They've done a wonderful job lifting their people out of poverty into some semblance of middle class. And the job they did, going from 80% rural and 20% urban to being more or less 50-50 in such a few decades, is unparalleled in the world. So it's a great success story, and the only real success story of central planning that I'm aware of. The unfortunate thing is we were by definition had to be the main target of their efforts because we're the big boy on the street. And for example, when President Clinton supported China's accession to the WTO, that might very well have been a good idea, but the way it was done was wrong because he did it under the assumption that if they joined WTO, they would automatically play by the rules. Well, they didn't. And unfortunately, they never built in an enforcement mechanism so that if they didn't play by the rules, they would be punished. That was a grievous error and one that we're going to pay the price for decades to come.
Now, last Friday, the Biden administration announced new restrictions on chips and semiconductors, trade with China. Is it now in the U.S. interest? Again, it was considered for a long time in the U.S. interest to have a strong, growing Chinese economy. It was great for U.S. business. It was great for U.S. exports. It was great for investment. Is it now actually now, do you think, in this era of new competition, is it in the U.S. interest actually to try and keep China down?
Well, I think there are two, as you probably know, I spent a lot of effort during the prior administration campaigning for the CHIPS Act and imposing export restrictions on semiconductor and other high tech for two reasons. One is the economic reason. We right now in the US consume half of all the chips in the world. We only fabricate something like 13%. So we're around 3/4 dependent on imports of chips. Everything from the most simple commodity ones to the most sophisticated ones. That's a terrible point of vulnerability. And the best signal to show how vulnerable it makes you, I believe that a lot of the reason why the Russians weren't able to re-equip their tanks and their planes and everything else is we cut them off from semiconductors, because none of the modern weapons of war work without semiconductors. So that's one. Two, the next war, if there, heaven forbid, is one, I believe is going to be some combination of cyber and space, both of which are extremely dependent on semiconductor. So I think from a national security point of view, as well as from an economic point of view, we cannot be that dependent on foreigners. So I spent literally 2 years, at least a day a week, arguing with Taiwan Semiconductor that they should put their state-of-the-art fab, making the very smallest semi-chips, in Arizona. And they finally did, and we finally gave them the quid pro quo, which was the CHIPS Act. That's really important because they are the world leader in the technology. Close number 2 is Samsung, but in my view, TSMC is the most advanced. Well, we need not just a large quantity of semiconductors, we need to be the leader in the technology, because if we're not, it's going to restrict most other technological advances that we otherwise would make. So I don't like central planning. I don't like countries have industrial policy. But in this case, it was necessary because it wasn't an accident that we became so dependent on the outside. Here's what happened. The chips were invented. Remember back they used to be called transistors here in the US in the 1960s. But as other countries, China and others caught on, they decided to subsidize big time manufacturing of chips. So we're in the peculiar position, we still have the best design capability, but we lack the ability to implement the designs that we make. That's a terrible anomaly.
Is the last 30 years or so, we saw extraordinary growth in globalization, growth of global trade, direct and indirect investment, huge volumes growing at extraordinary rates. But in the last few years, obviously, political pressures, COVID and supply chain disruptions, some of the other changes that we're seeing. Have we passed the high watermark of globalization, do you think?
I think probably so. In fact, one of the many things that the left wing criticized me for when I was in office was saying that I think the advent of COVID will ultimately result in some deindustrialization of China. And it's turning out that that is the case. Because when you make these attenuated supply chains, where you make it here, you assemble a part there, another part here, another part there, every time you add a point like that, you've added a point of vulnerability. And I think that people, in the quest to save the last 2 pennies, overlook the problem of complexity and the inherent problem of supply chain vulnerability. I think what's happening now is a long overdue correction, and people are saying, well, maybe the last penny isn't worth the fragility that it creates in my business structure.
A quick question on energy. Energy markets, we've seen, I think it's fair to say, the folly of some of the policy making that's been going on around the world, particularly in Europe, but to some extent also in this country, with the disruption in energy markets and the very difficult winter that is likely to be in store. What do you think are the lessons of that? Do you think that how is that affecting governments? How does that affect businesses? We've just had a panel here on ESG. Do we need to has this been a wake up call for all of those people who've essentially been saying, no, we can, the US can, close down its fossil fuel industries and actually promote sustainable fuel? I mean, what's your overall impression of the implications?
I believe in climate change as a problem, so let me start with that statement. But one has to be careful about the timing of things. It is not rational to think you can get rid of energy from fossil fuels anytime soon. It just isn't going to happen, can't happen. So our policy of being very constrictive on fossil fuels is frankly what has led to a lot of inflation. Gas prices didn't just start going up when Russia invaded Ukraine. Now that exacerbated it, but it surely didn't start there. And now we're in the ridiculous situation. We have the self-created problem here and in Europe, and yet, what are we doing to solve it? We do tokenism things like selling off part of the petroleum reserves, the strategic reserves. We now, apparently, the government is talking with Venezuela, of all places, to ship us oil. Well, if we have complaints about China and their human practices, and we have complaints about Russia, why on earth are we toying with helping Maduro in Venezuela? This is totally crazy. And I think what it demonstrates, if you have one wrong policy, the way to correct it isn't to introduce another wrong policy that creates other problems. All that does is compound the original problem that we had. Further, I think it was very ill-considered that when this administration first came in the very first week, they canceled a lot of armament sales, particularly fighters and air defense systems that our administration was selling to the Saudis and other relatively friendly Arab countries. So what does that lead to? Now, when this administration called the Saudis to help out in oil, how do you think they reacted?
What we saw.
People don't think through that it was the right thing to be concerned about the terrible killing of that journalist, but I don't think the right way to solve that was to create a huge problem, a huge friction for a long time with an essential ally that we need to prevent drastic inflation in fuel prices.
Final question, Secretary Ross, and forgive me for asking you this, but you served obviously in the Trump administration. Perhaps we might call it the first Trump administration. I'm wondering, are you expecting the former president seems to be, as far as we can tell, very much intent on running again. Polling suggests he could probably win. Do you expect there to be a second Trump administration after 2024, and will you be a part of it?
You notice he saves the really tricky question till toward the end. That's a great journalistic technique. And I'm going to give the subject's response, which is ducking your question.
But no, I mean, just seriously, would you welcome Donald Trump, a second Trump term?
Well, I think we have 2 years till the next election. A lot of things are going to be different in the next 2 years. Things will be different in terms of the Democratic side. They'll be different in terms of this side. It's too long. It's an eternity to go that far ahead.
You ducked that question as effectively as you've been ducking that fly that's been stalking you throughout the whole of this session. Secretary Wilbur Ross, it was dubbed a fireside chat. We didn't have a fire, but we had plenty of heat and light thanks to your intellectual candle power. So, ladies and gentlemen, thank you for joining us.
Thank you. Thank you. Thanks, Joe.
Thanks very much for that session. Thank you, Jerry. Thank you, Secretary Ross. So we're going to have some closing remarks by Jim ALO to round off the day. We do have cocktails outside. Before we close, we did just want to thank our sponsors one more time, as I said at the beginning of the day, for those of you that were here, and their logos up on the back and around to the side. They are true intellectual partners in putting this program together. So I'm going to read their names briefly. You can hold your applause until the end. So our diamond sponsor, Churchill. Our platinum sponsors, Apollo, Aries, Circle, Golub Capital, Surfin, and XPO Logistics. Our gold sponsors, Abacus, Case, Diornano, General Atlantic, High 2. Thank you for paying such close attention. MFA, NOAA, Standard Chartered, Thoma Bravo, UBS, Wafra, and Yield Street. And our silver sponsors, Shellion, Connecticut Insurance and Financial Services, Hancon, Rover Trophy. How many of you had a chance to check out the cars outside? A few of you, good. And our bronze sponsors, Bank of America, Connecticut Hedge Fund Association, eRiver, FinCity Tokyo, and JP Morgan Chase. And our breakfast sponsors, these are the last three: Cambridge Associates, Hong Kong Exchanges, and our cocktail sponsor, Proto. Thank you again for being such a lovely, attentive audience. And Jim will be up in just a minute for closing remarks. Thank you.
Just a couple of quick comments here. Thanks everyone for their patience today. It's been a wonderful day. We have a special presentation. I don't know if any of you have noticed, there's a box outside that is 7 feet tall, 4 feet wide, 2 feet deep. And it's actually like a Star Trek experience. It's a hologram experience. We're going to have, it's called Proto Technology. We want everyone to go outside in a couple minutes. We're going to try to get people to stop drinking. We're going to have the president of this company come in. It's an amazing video technology that we'd love for you to see. It's a very state-of-the-art new communications tool. So try to pause on the drinking, 5 minutes, walk over there, just 5 minutes. We're going to hear the president of this new cool company, and then we can drink. Okay? Is that fair? Stephen, is that fair? Can you do that? 5 minutes. Okay. So let's go outside. Let's meet the president of the company, and then we'll go from there. But thanks, everyone, for being here today. We're thrilled to have you.